So now, my dear friends, we are going for another interesting area called options. My dear friends, these options are coming not just a 7 mark compulsory, it is also very useful for in MCQs. MCQs minimum 1 or 2 questions, sometimes even 3 questions also coming from 2 mark question. 2 question if you take 4 mark. So 7 plus 4, you will get 11 mark. That means minimum 10 mark weightage. Around 1 or 1.5 hour preparation, you can able to score this mark. And it is very certainty. It is a formula based approach. So you can easily able to score it very well. So with your permission, we are starting this session. So my dear friends, options, as you know, comparing to futures. What is futures? Futures, whatever may be the market price, if you go with a buy future contract, generally we call long position, you have to buy it. When it is a short position in a future, that is sell future contract, whatever may be the market, you have to sell it. That means when the market price is very low, if you have a buy future contract at a higher price, irrespective of the lower market price, you won't get the benefit. You have to buy at the higher price. That is the main disadvantages of what? Future contract. So you can manage it through hedging also, but however, this future is having that challenge. Now, coming into your options, this kind of disadvantages is overcome under options, because option will give you the right but not the obligation. Option will give you the right but not the obligation. As all of you know, we have two type of option. So what is our strategy for this revision is, we are going for a fast revision of all the concept, because I want to ensure that you are able to get the 7 mark. You might have been to refer your revision classes or your regular class schedule or problem for a better, deeper understanding. But if you already gone through the base concept, it will be very easy for you to revise everything in a half an hour. So let us discuss. As you know, options we have two type. We have call option and we have put option. What is call option? Call option will give you a right to buy. So whatever may be the market price, if you want, you can buy, or you can put it as what? Labs. So now everything I am giving you a small note, like for us I have given. So call option, there are two parties involved. One is called a buyer of the call option. Generally, we call this person having called what? Long call. Another one is called a seller of the call option, which we call short call. So you have to be very clear in every option question what position. They will tell you Mr. X is having a long position, X is having a short position. That you have to think. You don't think that option is always you brought it. Sometimes you may sell it also. So you have to be very clear whether it's a short call or a long call. If long call means he brought. So what the buyer of the option, he has to pay the premium. He has to pay the premium. Pay the premium is the amount for the benefit he is enjoying or the rate he is enjoying. Here is what called, he will receive the premium. Same way, call option, we have another one, it is called a none other than what? Put option. What is put option? Put option will be helpful when you want to any right for selling. So both will not, you don't want to go. If you have an asset and you don't want to sell today, you want to sell in a future date, you can go for a put option. Or if you want to buy something in a future date, you want to buy something in a future date, you can go with a call option. So I hope you are clear when you have to go for a call option, when you have to go for a put option. If you want to buy something in future, so you have to go with a call option. If you want to sell something in a future, since you are holding today, so you have to go with a put option. Are you clear? So put option will give you right to sell. So what is the buyer of the put option? The buyer of the put option is called as long put. Similarly, the seller is also called a writer. The technical term is a writer only, which is called a short put. Here, he will receive the premium. He will receive the premium, and buyer will make the pay the premium. See, both parties have thinking, because see, we can't say that the buyer is a loser or a seller is a gainer, or buyer is a gainer, seller is a loser. It is depends upon the situation. If you are a writer of the option and you feel that price will go against, price will go in favor of your planning, then you are going to gain it. It is not that loser or gain. It is getting a right for you. If you want, you can exercise, or not, you can lapse it. You just want to incur the premium only. That is the logic behind the options. Now coming to the point, options. We have call option, we have put option. So in this option, there are some general perspective are there. We have to find out the what is the value of option. This is the main point we have to find out. We have different scenario are there. I am going to discuss everything for you. So before going to value of the option, generally coming for the exam is profit and loss of the option. That is, generally they will ask you position of the option. If you go through your previous year question, even MQP, they have done more of what? Position of the future. That is to compute the profit and loss. To compute the profit and loss. If you want to compute the profit and loss, first you have to identify what is the value of the option. What is the value of the option? See, the value of the option, I'm telling everything shortcut method for you. First, if you go for call option, first you go for, see, call option, you will get only value. Your exercise price is less than market price. That is, your market price is 250, your exercise price is 200. So when the market price is 250, you can buy at 200. Will you buy or not? Yes, you will buy it. This will helpful for you to score 2 mark questions. But generally, we discussed everything, all these concepts by conceptual way in our regular class. But I am linking the concept plus shortcut in this revision session. So exercise price always greater than, that is, exercise price must be less than the market price. At the time only call option will exercise. So call option will get value only exercise price greater than market price. Otherwise, it is out the money. So when exercise price greater than market price, it will be in the money, and value will be different between both. That is your market price minus exercise price. We learned in our regular class difference. You learn such a way only. No need of mugging up any formula. The technical formula is market price minus exercise price. This is the value. If it is in out the money, all other situation, that is, if exercise price, if your exercise price is greater than market price, it is called out the money. Generally, you will go with a strategy called a lapse. If it is in the money, generally you go with a strategy called what? Exercise. Here you will do what? Exercise. So in the money, you will exercise. Exercise means you will take the right. If it is out the money means you will lapse it. Hope you are clear on this. Now we can go for what? Put option. I am telling everything single material for you to revise the concept. That is the main agenda for this revision. So when it comes to put option, it is ulta. If your exercise price is greater than, because you have a right to sell, you can sell higher than the market price. So you can say exercise price is greater than the market price. It is called in the money. You can exercise. This you can write another way also. Maybe in your regular class or maybe in your notebook, you might have later this market price is less than exercise price. That is also correct. Either you can write market price is less than exercise price, or exercise price is greater than market price. That means you can sell at a higher price. So here also, what is the value, friends? Your exercise price is more. So exercise price minus market price. This is the formula. But in regular class, we discussed it. If it is a in the money, if it is a in the money, different between exercise price and market price. That's all simple method. But technically, this is the formula. You have to make it. If suppose your exercise price is less than market price, then it is called out the money. Generally, we do lapse. Sir, there is something called at the money. What is that? If exercise price is equal to market price, it is called a at the money. If both are same, it is called what? at the money. So I hope all of you clear what is meant by at the money, out the money, and also in the money. So you can get the value of option, both call option, put option by this method. Now, my dear friends, we are going to find out the profit. What is a profit for the buyer? Profit for the buyer is nothing but what is the value? Value formula I have given, value minus premium you paid. Now, sometimes they will ask you profit for the seller. In the regular class, I have discussed a detailed conceptual problem and told you the shortcut method. So in the revision, I am giving you shortcut method. No need of taking the effort. See, one person is getting a gain of 5, another person is suffering a loss of 5. That means, my dear friends, seller, otherwise called rater, no need to do any problem. Find out buyer perspective, just opposite. This is a shortcut method. Think buyer perspective. Buyer is getting 10 rupee loss. That means seller is getting a 10 rupee profit. Are you clear? So this is what is called profit for the seller or writer. So which is called a, what is the just opposite of buyer profit. So no need to mug up anything. So my dear friends, a essay question is over with this. Any question you can able to solve with this concept. Any profit and loss question you can solve to this. Whether it is a buyer of the option, whether it's a buyer of the writer, whatever it is. So here, anything, whether it is a call, whether it is a put, anything you can able to apply with this profit. Relating to this, there is a one concept called a break-even price. What is a break-even price? Break-even price is nothing but there is no profit or no loss. That is your another shortcut. Your value is equal to premium money. This is the logic. So if your value is equal to premium money, it's all helpful for 2 mark also. So if your value is equal to premium money, it is called a break-even price. There is no profit or no loss. So my dear friends, this entire concept of profit and loss of the option is over. Relating to this topic, there is a one concept called a intrinsic value and time value. See, what is intrinsic value? My dear friends, the same thing, only intrinsic value. The only difference is what? If it is a call option. See, you have already identified here. Excess price greater than market price only will come. What is the formula? Market price minus exercise price. See, if it is an intrinsic value, you take current market price because future price is not in our control. We can't predict what is the future price. So future price is not in our control. So intrinsic value, current market price minus exercise price, provided, this is the point that you forgot, provided exercise price is less than market price. This is very, very important. Provided exercise price is less than market price. What about put option? Same way. Put option, what is the value? EP minus MPS. So same thing. Exercise price minus current market price. That's all. Here also one condition. Provided your exercise price is greater than market price. See, my dear friends, these kinds of shortcut we are not discussed in detail in our regular session, because regular session we went with a proper conceptual understanding. With that you can solve everything. But this is what a, just like I want to recall in the forex point, I want to make you ensure that you can able to one line revision for everyone, so that even if you forgot the concept or if you forgot the problem, basic clue will give you to solve any kind of problem. Now there is a concept called a time value. What is time value, my dear friends? Time value is nothing but your intrinsic value minus premium. Intrinsic value minus premium. Here one more thing, provided up to 0. That means sometime if your intrinsic value is 0, that is once again your premium minus intrinsic. Premium, what you paid, minus intrinsic value. Sometimes your premium is 10, your intrinsic value is 5, so your time value is 5. Sometimes your value is 50, so 10 minus 15 you will get what? Minus 5. It won't go minus, provided up to what? 0. That means no negative. That is no negative. You can go 0 or greater than 0. So that is 0 or greater than negative. So my dear friends, in the money, out the money, exercise, labs, call option, intrinsic value, time value, every concept is over, friends. Within 5 to 10 minutes revision, we finished. Now another 10 minutes, if I complete this value of the option, chapter of option is over. You can go through n number of questions we discussed in our regular class, whether it is 45 or 65, you can able to solve. Any previous year question also you can able to solve, my dear friends. That is the shortcut we are able to give you for your benefit, my dear friends. So hope you noted the same. If anyone still want to copy this, I'll give you a small time for you to copy. Please utilize the same if you want it. Now another 5 to 10 minutes, entire area is over. Then we can directly, because I want to give you option 7 mark pakka, conceptual clarity I want to give you. That is why all the area we are revising it. Shall I proceed? Shall I proceed? Yes. Now, my dear friends, we are going for value of option. Any question you can solve with this concept, friends. Value of option. We have multiple case. Case 1, no risk-free rate. Case 1, there is no risk-free rate. This is for the normal case, which we have already discussed. Call option is equal to value is equal to what? Market price minus exercise price. Call option is equal to call option value is equal to market price minus exercise price. What is the point? Market price minus exercise price. Put option means what? Exercise price minus market price. But generally, this will come only if greater than less than concept is there. Now, case 2. In the regular class, we have discussed everything with a risk-free rate only. With a risk-free rate. See, this market price is the on expiry, but market price is the expiry, whereas exercise price is what? So what you have to do? You have to bring market price, current market price only, because you don't know what is future. So exercise price you are paying on a future date. So the exercise price you want to bring into present value. So if risk-free rate is given in the question, if risk-free rate is given in the question, we are giving the clarity. Maybe when you are referring ICMI material self-study and all, you may find difficulty on when to apply RF, when to apply RF, or what is the logic, what everything will be confused. So that is why if RF is given, excess price is on the expiry date only you pay. So you want to bring into present value. So no change in formula. Same thing. I am just copy paste only. I want to make you easy for you. So call option market price minus present value of excess price. Here put option, what will happen? So wherever come your RF, you have to make it present value of excess price. Clear, friends? Now case 3, which is called if either call premium or put premium is given. Call premium or put premium is given. This is we apply a concept called a put call parity theory. This is regularly a 2-mark question. This is regularly a 2-mark question because we told minimum 2-mark question will come. One question coming on this put call parity theory. What is put call parity theory, friends? If you know put call parity theory, you will get the formula very well. Can you anyone tell what is the put call parity theory formula? What is you have to do? Value of call plus present value of exercise price is equal to value of put, because in the regular session we have discussed that if it is call option is exercising, put option will lapse, put option is saying call option will lapse. So in this case we can make it from this maturity you can get reverse calculation over the point. So what is the value of call? Value of call is nothing but, so you can take what is the value of put. See, actually value of put is nothing but what is the maximum price we can pay for put option premium. So question they won't tell put option value. They will tell you that put option premium. Put option value means premium only. The value means what is the, why we want to find out the value? Because if you pay higher premium, I will tell you a very small example so that you will understand the concept behind value. Though it is a revision session, I want to give you why we find out the value. See, exercise price is 200, market price is 220. See, my dear friends, when the market price is 220, I can get at what? 200. So I will exercise. I will get a value of what? 20 rupees. How I get a 20? When the market price is 220, I can get for 200. So the value is 20. But for getting this value, let's assume I paid a premium of 30. If I paid a premium of 30, what is the profit or loss? 20 minus 30, I am suffering a loss of what? See, my strategy is correct, but I am suffering a loss. Why I am suffering a loss? Because I paid an extra premium. So the point is what? Everyone, those who are going in this option market, they want to know what is the correct premium I have to pay. Because if you know theoretical value of premium or the correct value you have to pay, then you can earn a benefit out of this. That is how we have to find out the value of options, which is $1 million question. As you know, one of the method called Black-Scholes even won the Nobel Prize also. So my dear friends, here suppose if you don't paid it 30, you paid 15 rupees only. What will happen? You could have been get a profit. That means if you know the correct value of the option, you won't pay any excess money, you will pay the correct money. For that, you should know what is the value. The value nothing but the maximum price we can pay for premium. So the purpose of finding value, I hope now you are clear, because you can analyze that this is the maximum price I can pay for premium. How interesting, friends. So there is a very good logic behind this. So value of put plus, what is put option premium? Or you can make value of put, or simply you can make it put premium plus current market price minus present value of excess. All the present value you have to know e power of RT, unless otherwise question is not mentioned. Now value of put. What is value of put, friends? Same way. What is the value of call? Always call premium plus present value of exercise price minus current. See, there are questions for finding current market price also you can apply here. 2 mark question on current market price. In our regular class, you have written that formula also. But here our area is value. I don't want to go for that. So this is the case 3. Now case 4 is a superb method which is coming lot number of time for exam. We are going to practice. In our previous year also it came binomial model. It is there what? Binomial model. See, my intention is what? I am giving the revision of all the method. Though maybe previous year the question is may not be there. Maybe MQP the question may not be there. So we won't practice the question. But by this revision, you can able to recall all the question we discussed in our regular session. So that will boost your confidence and you can recall those regular session question very easily. So binomial model, we have discussed 3 methods. First one, it is called a delta root. So delta root, we can go for value of call. What is the value of call formula? Option delta into current market price minus present value of FMB lower. So this is the shortcut formula, friends. So this is the shortcut formula you can get for FMB lower or FMB down, whatever you call. In the material also you can able to get down also. So whatever you call, you can make it. So option delta, we have to find out current market price. You know what is the market price right now? Present value of FMB. FMB means this binomial method will come. See, you know, this market price currently no use because your entire exercise on the basis of expiry. So the question, they will give you 2 price. One price will be higher one, another one will be lower one. So higher one we call FMB upper, lower one we call is what? FMB down. So accordingly, you can able to go for it FMB down. So that FMB down number, you have to take present value because that is a future rate. You have to take present value. What is option delta? Option delta, another interesting area. So option delta is nothing but change in value of call divided by change in FMP. That is, you have to take what is the value of call, you have to find out. So generally one will be 0, another, so you have to find. Then value of the FMP, this is one. So this is one of the easiest method. This is one of the easiest method. We have also discussed a equation method. We have also discussed what? Equation method. Equation method we can do different way. If you want me to do the proper lengthy method, I will do that also. So equation. See here, some friends may ask, what is the value of put? We can apply put call, parity theory and find. That is a shortcut method. Value of put also, they will ask what is a value of calls. So value of call, how you can do? You can apply put call parity theory. Now equation method, which is very rarely comes for exam, but you can find in CA final material or all other material. But when it is binomial method, this delta root is very easy only. But equation method will helpful for decision making, reverse calculation and all. So what is equation method? Your value of call is equal to value of call at upper level into. You have to multiply the probability of upper level. What is probability of upper level? F minus D divided by U minus D. What is F? F means e power of RT. D means your current market price to FMP down. Coming to U, already we discussed, instead of current FMP down, you take FMP upper. This is the point. This is one part only. This is value of call at upper level. Same thing, value of call at down level. You can take L or D, whatever you make it. What will be the multiplication here, friends? U minus F divided by U minus D. You can remember U, D, U, D. This both are same. Only this area only changing. This you have to take present value. So whole divided by U. So this is F minus D by U minus D. This is called probability of upper level. U minus F minus U minus D is called probability of lower level. So this probability sometime required for doing reverse calculation of decision tree. We discussed lot of question of decision tree in our regular class, but there is no MQP question here. So we are not applying those questions in the session, but we are revising this one. Clear, friends? After this, we have another one is called decision tree. The decision tree we have to draw. That is, we discuss single binomial model in your study material. We discuss in our regular class also. If you go on for to option questions, if you go with option question, we did n number of question on options. Around 75-60 question we did it. I'll show you. See, this is the point decision tree. Question number 51, which is also your ICMA study material question. There's a single stage binomial. What is in a single stage? That is 50 rupees is the current price. It will go up by 20%, down by 50%. So decision tree only. That 50 will go 20% up. So it will come 50 plus 20 is 60. Here 20% down 40. So you get FMB up and FMB down. This is one method. Next is what? Two-stage binomial model. This is also your ICMA study material. We discussed in our regular class in detail. So how it will be? Here 50, 20% up in a 6 months. Again, it will go for another. See, two-stage. That is, you have to work out for a two-stage. Correct? So this kind of question. But there is no MQP or previous year, so I am not doing. But in regular class, we did it. I hope you can post the video and you can revise it very fastly also. So this is the area you can. If you have those friends who are attending live, you can just post the video. You can revise the regular class material also. I have shown you the question number. Or if you don't have the workbook, you can follow your ICMA material, your ICMA question only. Because we did all these questions. Close to how many questions we did in this Forex? These options close to around 70. These are all previous year question. Apart from this reason question, around 82 questions are there. Now coming to next area, with your permission, we have very interesting. See, I would like to say very proudly that, see, there is no question in your ICMA study material, but we are following from 12 syllabus onwards in our workbook, which came recently for your ICMA material. That is none other than you have to approach under what? risk neutral method. Risk neutral method. What is risk neutral method? A superb method. We have discussed a shortcut. Actually, formula only this only. Value of call is equal to value of call at upper level into probability of upper level plus value of call at down level into probability of down level divided by f. F means e power of rt. Even if you go through probability of upper level only, we have to approach the formula. I hope you remember. I will tell in 1 minute. Risk neutral method tells that your risk free rate will be equal to probability of upper level into percentage change in upper level plus probability of lower level into percentage change in down level. So you have to assume probability of upper level is x, probability of lower level is what? 1 minus x. So what is the risk free rate you have to approach? Then you don't know what is the x and 1 minus x, you have to solve. Percentage change in upper level and lower level, you have to find out. What is the current market price? 100. Future price will be 120. So percentage up is what? 20 percentage. FMB down is 90. So 100 is come to 90 means 10 percentage. So 20% up to 0.2. Here it is 10%, 0.1. So you can approach this. This is a very good question. You can just revise. You can just pause and you can revise it because we are focusing only on previous year question, current syllabus. So if it is there, we will do. I think we have one question on risk neutral. Let me check on that. We can able to do. But I have revised it very well. Finally, the golden fish. Finally, the golden fish, which is the last topic in your options area, which is nothing but Black-Scholes model. This was regularly coming question for your CMA final exam up to 12 syllabus. But nowadays, this weightage has been reduced. Maybe this answer, everything is coming. But this is a very interesting area. We have to apply the formula method. I don't want to make the bigger formula on the board. But let me tell you, you can get this from your normal formula. Normal formula is what? MPS. So call option means what? Your MPS into ND1 minus present value of exercise price minus into ND2. That is a formula. What is D1, D2 only? We have to approach natural log of spot price. If it is a dividend is there, adjusted spot price divided by your current market price plus R plus 0.5 standard deviation whole square, then divided by your standard deviation into root of T. So this kind of problem we did, so which is very good area. This is the main area we have to learn in our options. So what I request you now, I just request all of you. I believe that we have gone through the majority area. Now one and only area is that you have arbitrage course of action. That arbitrage course of action is nothing but you find out the value under risk-free rate or put call parity theory. That is the maximum price you can pay. So they will given what is the price in the market. So you have to go for whether to what course of action we can take so that we can take a profit. So it's a very good question. So I'm not drawing that on the board based upon the previous year MCQ. We'll preface that. The point is what? If it is undervalued, anything undervalued. This undervalue arbitrage course everywhere it is there. So let me tell you one thing. If it is a call option, or else I will make you know itself. Why should you want to wait? So your arbitrage course of action, because you can able to recall everything very fast. Arbitrage, because in a half an hour discussion, I want to boost your confidence in your options area. So arbitrage course of action, if a call option, if undervalued. So when you call, your theoretical value of call is greater than call option premium. See, your theoretical value is more. You can pay up to, but this less. So which is called a, is we call position is called a undervalued. See, if it is anything undervalued, what will be your action? So we discuss it now. This is a very good point. But action is anything undervalued. Is call option undervalued? You will buy. So buy a call option. Buy a call option. Anything undervalued. So what is the same thing? You can go for put option also. What is put option, friends? Put option, again same thing. Theoretical value is nothing but what is the value you found out under put call parity theory or case 2 or case 3. So theoretical value of put is greater than put option premium which is available in the market. So all are theoretical value is great is always called a undervalue. Always called a undervalue. Anything undervalued, what you will do? Buy. What is undervalued here? Put. So buy a put option. Now very interesting. What is buy a put option? You have a right to sell. If you have a right to sell, something you should have in your pocket. So what you have to do? You have to buy share now. My dear friends, share means majority. Example, I am telling share. But we did in the class, not other than share also we did it. Metal, steel, example also we did it. In the classroom example, we did motorcycle, car example also. So you can buy anything. So I am discussing buy the asset now. Buy the asset, buy the share now. This is here you gonna buy on a future date. Then no need to hold now. Then only you can get a profit. So sell the share now. See, this is the two strategy will come if it is a case two situation. Because I told it we can approach put call parity. We can approach this arbitrage course of action either by case two or case three. So case two, these two action only will come. But when it comes case three, if the question is given call option details or put option details also, we did one study material question, that is our workbook question. Shuaib Limited, one question we have did. That is Sanju Manju question. Sanju Limited, Manju Limited. That Sanju Manju question, if you are able to recall, I will show you the same question. They are given put option, call option, everything. So we discussed the put call parity theory. Call option exercise, put option labs, put option exercise, call option lab. So if you buy a call option, it is going to exercise. So put option will lab say. So sell put option. So this can be done only if the question put option data is there. Otherwise, this will not be given. That is the reason in our regular class, we change the color also. That is a different color. Here, you are going to buy a put. So put option is exercising, call option will lapse. So sell call option. So if you sell a call option, the benefit is what? You will get a premium. If you sell a call option, you will get the premium. So my dear friends, overvalue just ulta it will come. So no need to make it question are coming undervalue. My dear friends, entire options are over. If you go through this entire 82 question, whatever it is, we discuss, majority questions are covered in this topic, my dear friends. So that is the speciality of option. Options and all, you never make a mistake. You can able to score good mark if you're conceptually very clear. So I will give a small time for you to just analyze this type of question and revise it. Then we'll go for previous year question. So you can just revise these points and go through your regular workbook, just brush up. Then we will start with the selected question for our revision session. All the best, my dear friend. My dear friends, we'll go with the problem. See, before going to the previous year question, there is a one base question in MQP. We'll do that fast. One of the base question we discussed in the money, at the money, out the money, that concept only. Question number 14. This is just taken from your study material. I don't think this much easy question will come for exam since it is a MQP, because MQP there is only one question so far. MQP one question so far for your exam came for this June. So I want more of question coming on forward. So I just want to make it this question to be solved. That is the reason I taken. They are given 5 put and 5 call. They are asking what is the investor position and date of exercise, and what is the action will make it. So we can go for it. First we have call option. So security PQRST. We have exercise price. What is exercise price? 370, 450, 1790, 135, 953. What is the market price? 376, 444, 1700, 140, 953. Now you can go. It is a call option. First you can do position. They're asking position and action only. Position means in the money, at the money. That is base concept only. When the market price is 376, will you buy at 370? Yes. So it is called in the money. When the market price is 444, will you buy at 450? No. Out the money. When the market price is 1700, will you buy at 1790? No. So that means higher price you won't buy. I have discussed one single mantra. That is enough for you. That is excess price greater than market price, only the value, otherwise out the money. So that concept itself enough for you to understand. When the market price is 140, you can buy it 135. So in the money. When it is both are same called a at the money. So what is the action? So they are not asking value and all. What is the action? Action is in the money na we'll go for exercise. Out the money na laps. Out the money na laps. In the money na exercise. At the money either exercise or laps. See, they are not even asking value also. But for a better understanding, we will do value also. So that we'll get one more concept. Value. Premium is not given. Otherwise, we can do profit also. So what is the value? Value out the money, at the money, value is 0. Out the money, at the money, value is what? 0. So out the money is 0, at the money is 0, because there is no benefit. In the money, the difference. Yes. So we have our call option value also we did. Same way, we have to go with what? Put option. Can you please complete, friends? Exercise price 118, 758, 350, 65, 230. What is the market price? 122, 758, 340. This is ditto from your material. We did in our 16 and 220. Now you can go. Here it is put option. So put option just to ulta. When the market price is 112, you won't sell at 180. You will sell at higher price only. So this is out the money. This is both are same at the money. When market price is 340, you can sell at 350. So it is in the money. 69 you can sell at 65. You won't sell it out the money. 220 you will sell it in the money. Out the money, at the money. Value will be what? 0. So you can just go with the value also. In the money at the time, the difference only. So you can aim. We have already discussed the formula, but this is a shortcut method. Now value they are not asking, we are doing for a better understanding. So when it comes to the action, out the money, we'll go with what? Laps. At the money, either exercise or laps. In the money, we'll go for what? Exercise. Here also we'll go for what? Exercise. Here we'll go for laps. So this is how you have to approach. So hope all of you are clear on this concept. Suppose if profit and loss is nothing but you have to just reduce the premium. That's all. If it is a buyer now, same thing only. If it is seller now, ulta. What is buyer? We have to make it. So hope all of you are clear. Suppose if premium is 4 rupee. Let us assume premium is 4 rupee in all the case. Your profit or loss to the buyer will be what? 6 minus 4. So if you want profit and loss to the seller, 0. Just to ulta. That's all. Buyer is getting profit, he will suffer a loss. Here, no value. So entire premium is a loss. He is getting a gain. That is why. So you can take just ulta. So one of the shortcuts. So we did a majority concept a revision with this question itself. We'll go for next question, friends. So we'll go for next question, which came for same profit or loss. December 24 question. Similar question only. They are asking what is the position if it is 145, 110, 150. That means three price. Both put and call. Can you just start, friends? You can just post the video and try. Let's see how many of you will complete. Same concept only. So let's see how many of you will complete so that you will get a better revision. Because I have discussed everything. Three price you can. So let's start the question. So first case, market price. Market price is what? 145. Market price goes to what? 145. So we have call option. You can do vertical any order, no problem. We can do put option. So what is the market price? 145. What is the exercise price? See, call option exercise price is what? 150. Here the exercise price is what? 140. So for a better understanding, you can check your position. Because in the last question also, this is not required, but it is a safer zone. So what is the position? See, when the market price is 145, will you buy at 150? No. So the position is out the money. When the market price is 145, will you sell at 140? No. So out the money. So both the cases, value is what? 0. So what is the premium you paid? Premium you paid is 10 here, and here it is 6. So what is the profit or loss? So some friends may be done different vertical order. So whatever it is correct only. So here he purchased 1 month call option and paid 6 premium for the both are he purchased only. There is nothing. So how many of you got the correct answer? Please raise your hands. Good. Now for me, since I am using Excel, just changing this. We will change the market price into what? 110. So market price will go to 110. Now, when the market price is 110, you can buy it 150. You won't buy it out the money. When the market price is 110, you can sell at 140. You will sell in the money. So you will get 30, 24. Here the same. Hope you are clear. Congrats. So previous year question only getting over. Next year, same thing. Call option, put option. You can make overall point also. Here overall, what is happened? 60. Here overall you can make it 40. Now here, what is the market price? 153. When the market price is 153, you can buy at what? 150. So it is in the money. When the market price is 153, you can sell at 140. You won't sell it. So this will be out the money. 0. This will be 3 rupee. So 7. So this is the case. So congrats for those who got the answer. See this option question, you will take one of the lowest time for your exam. Option question will take one of the lowest time for exam. Clear? Yes. If the final answer 100 shares, you can multiply with the 100. That is, he purchased 100 shares for call and put option each. So whatever your final answer, you have to go for 100. That is, we have to make it. Whatever your final answer, you have to make the 100. So this is a shortcut method. So final answer, we can able to multiply with the 100 each. So this is the overall position. So profit and loss is over. Now with your permission, we can go with valuation. So this is the valuation question, binomial and risk neutral. Now only we discussed binomial and risk neutral question. So it is a very good point for you to revise. June 24, you are going to return June 25. Generally June 24, June 25, there is some parity is there. So this type of question may be chances of coming for exam also. So binomial, we have delta root. So current market price, strike price means exercise price, maximum price after 3 months, then 3 months. So this is FMP up, FMP down, compounding rate, e power of RT, everything is given. So we'll start. First, we can go for binomial model. So we have already revised all the formula. So we can just approach. See here, assess 3-month call option. They are not even asking put. They are asking only what? Call option. So we can go for question number 12. We can go for question number 12. So first we have to go option delta. So what is the value of call? See, you know your exercise price is what? 462. 462. So market price on the expiry can be either 537 or it can be 390. So you know one thing. When the market price is 537, you will buy it 462 here. So here the value will be 0. Here the value will be different. So what is the answer? 537 minus 462. You will get value as what? 75. So what is the difference? Change in value is 75. This is your FMP. What is the change in FMP? 537 minus 390. It is 147. Correct, friends? So you can go for option delta. What is your option delta? Change in value of call, which is 75. Change in value of FMB 147. So 75 by 147, you will get. You can take a 3 decimal, that is enough. Dear friends, now you can go for value of call. 1 minute answer is over. Option delta 0.51. What is your current market price? 432 minus present value of FMB down, which will be where FMB down is 390. Discount rate they given already. You can counter check it. 9 into 3 months. So it is correct only, close to correct. So if it is there given, we can take it 1.0228. They have given, we will take it is. So generally slightly will change, but question what is given, we can take, or we can take the correct one. Is the number is correct? 225 only comes. So exact number is 225, but printing they given 228. So you can go with 228 or 225. Maybe printing error only. So we'll go for 225 or 228. We'll go for 225. Maybe printing error. Exam purpose, if you take 228, nothing wrong. You will get the mark. Even 225 or 228, both are same answer. See, both are 381 only. So whatever you take it, no worry on that. Answer is same, 381. So 225, 228 decimal mistake, no problem. So 381. So whatever you take, not an issue. So you can just make it 381.44. See, value of call is over. My dear friends, value of call is over 25.79. You can take 2 decimal. So this is a 7-mark question is getting. So it's a very good point. So this is next method. They're asking under, I told risk neutral will do previous year, so it will come. As I told risk neutral model, there is no question in your study material. But in regular class, we do lot of question on risk neutral, so it will helpful for you to do. Already formula I have done, so you can go for what? Percentage change in FMB upper. What is percentage change in FMB upper? Current market price 432. So 537 minus 432 divided by 432 into 100. What is the percentage in FMP down, which is 390 minus 432 divided by 432 into 100. So can anyone tell me the numbers? If I am not wrong. So one is 24.31, another one is 9.72. Okay, friends. Now you have to take your RT. What is your risk-free rate? Risk-free rate is 9%, and we have told risk neutral. Your risk-free rate must be equal to your period. So it is for how many months? 3 months. So for 3 months, what will be the rate? 9 into 3 by 12, 2.25. So 2.25%, you can make it into decimal. So those friends who are learning this first time, I'm going little slow also. We don't know what is a formula. This is the answer method. Value of call at upper level into probability of upper level, probability of down level. So we don't know probability of upper level and lower level. That is only we are going to compute with risk neutral. So I know all of you are ready. So what we will do now? So let probability of upper level as X. So lower level or down level will be what? 1 minus X. So you have to approach your formula 0.0225. 0.0225 is equal to what you have to do? Probability of upper level, which is X into percentage change in upper level, which is 0.2431. This is the first one. This must be equal to. So I will recall the formula first. Probability of upper level into percentage change in upper level plus probability of lower level into percentage change in lower level. So upper level is 24.31, lower level is minus. So it will be 1 minus X into minus 0.972. If you solve this, 0.0225 is equal to 0.2431x plus, here it will come minus 0.0972, minus will become plus. So you will get 0.0972 x. Can anyone tell what is the answer for x? Can anyone tell what is the answer for x? Come on, friends. In the regular class also we discussed this question. You can just solve the maths formula. I have already simplified the formula. So that minus you will get the effect of what? Plus. You can take your own time. So very good question, only risk neutral. So what is the probability of upper level, friends? What you will get? Point 0.35. 0.35. 3 decimal you can tell. 352. What is the answer, friends? 0.352. 352 will take. So probability of lower level will be what? 0.648. Correct? Now you can approach our formula. What is the formula? Value of call is equal. You can counter check whether your answer is correct or not, because both the method you should get correct answer, same answer. So value of call is equal to, see, upper level value we already got 75. So you got already upper level value. So you got 75. So what you have to do? 75 into probability of upper level 0.352 plus 0. Why 0? Because value is 0. Probability of value, already value upper level, down level we got. This is the upper level value 75, lower level 0 we have already. So 0 into any probability you do 0 only, divided by your e power of RT, which is given in the question 1.0225. We have taken 225 only earlier. So what is the answer, friends? You will get 75 into 0.352 divided by F. F is the present value only 1.0225. See, you got 25.8. See, same answer. Here you got 24.82. See, if you are getting the same answer, that means your answer is correct. See, you are getting the correct answer. Small 8182 difference because of the round off. We taken only 2-3 decimal. Actually, the answer is a lengthy. Hope all of you are clear. So, my dear friends, in this revision session, we have also discussed a concept which is not in your study material, which is came as a previous year question. The regular class we discussed multiple questions, but however, we revise the risk neutral also. I request you to revise Black-Scholes model also, though it is not came for a previous year recently. You can expect such type of question also for exam. So this is how you have to approach. So you have to solve this formula. Formula already you know 0.0025. You have to minus 0.092. Here both you have to plus. Accordingly, you will get the value of x. So this is how you have to approach. Now going further, we have next question number 13. So here same thing. They are asking what is the value of a call option under binomial model, value under put call parity theory, what is expected value of option stock price at the end of 3 months. So it is same data of our previous year question. That is previous question what we did it. So I think that question you can able to do it yourself. It's the same question. I hope you can able to do it. So that means option, this is the one line mantra. That is this entire concept is covering your value of option, case 1, case 2, case 3. So we did this method for the purpose. We did this method. This method and all very interesting. We have discussed the question in your study material also. Then we have discussed a very good question on computation of profit and loss on buyer perspective, seller perspective. In the revision session, we haven't done anything about intrinsic value of time value, but this can be comes as a question for your exam also. This table will give you clear-cut idea about what is buy, what is sell, what is put call parity theory, a one-shot shortcut for revision. Because these kind of points, the regular class, I have not given a shortcut method because I want to give you proper concept. So we have did concept base lengthy, but this will give you clarity on all the concept of base. This is which you have might have already in your note how to compute these values. This you will have already, you will have note how to compute the value. So I think with this you can able to score very good mark in these areas. This arbitrage and all, though we have not done the question, but it is coming for exam. As I told you now, Sanju Manju question I will highlight. It is in your study material also. We discussed in our workbook also. This is the Sanju Manju question. Where is the Sanju Manju question? Yes, Shuaib Limited. See, Manju question, Sanju question. A very good question. You can practice this for an arbitrage. This is a very good question for you to practice arbitrage question. Even if you want to practice on, see, this is what under put call. This is the question, 74 question. We did in the regular class 74 question. Same thing, ditto only came here revision. See, 3-month call option put call parity theory. Same thing only came for the 74 questions or repeating only. So this is on arbitrage. So this is also Probability based question also sometimes comes. What is probability? They will give 180 to 60 all these price. So you have to find out what is the value at all the level. So you will get the value. You have to multiply the probability. That is what expected value. So this is our previous year question in our regular class workbook. From page question number 79 onwards up to that 80 to under all our previous year question under 16 syllabus. All our previous year question under 16 syllabus. So apart from this 22 syllabus previous year, you can practice those type of question also. You can shine very well. So please take your own time and copy. Hope all of you are clear under. So now, my dear friends, we are going to a one of the super duper area where you can score 14 mark very easy. See, for it a portfolio management or for a forex where you have a 14 mark weightage, you have to learn lot number of concept and lot number of practice. But here, as per the current weightage, you have a 7 mark for value of shares, 7 mark for value of bond. So you can score same 14 mark here also. That is a super bumper for you. So we are going to discuss today how to crack those areas and how can you score good mark in this. So the first one, it is called a valuation of shares. See, these two pick mostly the area discussed in your study material only coming, but sometimes some points are coming from BVM paper of group 4 also. Same way, valuation of bond, sometimes it will come from your study material perspective, sometimes it will come from CA final also. So we are discussing all those area so that you never miss any mark from this valuation of share topic. So shall we start, friends? See, valuation of share. Generally, in your syllabus, only one point is discussed, which is called a dividend discount model. Dividend discount model. This is the method discussed in your material. Very easy area. In the regular class, we discussed the formula ways. You can open your material and you can just revise the formula we discussed it. Normal, which is the useful method, market price. If dividend is a constant, that is constant model. Constant model, everyone very clear. That is what is the dividend per share divided by K. Very rarely this comes. If it is, it comes, it will come for a 1 mark or 2 mark MCQ. Then growth model. Then we have a growth model. This is first one most thing. It is Gordon's growth model, which is every one of you aware that D1 by K minus GR. Then from here onwards, exam relevant. We discussed that. What is the next method we have discussed? A two-phase growth model. Two-phase growth model. What is two-phase growth model, friends? That is your dividend will grow 1 to 5 years or 1 to 3 years, 5% or 8% growth. Thereafter, infinite growth. Thereafter what? Infinite growth. So here the value of share. Value of share, otherwise we call market price, nothing but present value of dividend place, present value of annuity or terminal value, present value of terminal value. What is your terminal value? Terminal value is nothing but what is the dividend of nth divided by that is dividend of 5 year or 6 year, whatever it is, into 1 plus growth rate divided by this is, that is here, if it is 5th year, so 5th year dividend, you have to into your growth rate. What is coming for infinite? Divided by K, cost of capital, minus your growth rate. This is the formula for what? Terminal value. We have good question on this. Next, we have most number of time came question for your exam, three-phase model. Here, what will happen now? Value of first 5 year, there will be one growth. After that, 6th year may come down, 7th year may come down. Finally, it will go infinite. Here also the same formula, value of share or MPS is equal to present value of dividend of phase 1, present value of dividend of phase 2, plus present value of terminal value. That's all. The same thing, same concept. This is the area. With this, you can able to go all the question. This is how the point of dividend. Then coming to bond, valuation of bond. See, bond, there is no infinite period. You can't issue bond for n number of period. Bond can be max redeemable only. That means you have to issue maximum 20 years only. So the value of bonds, normal formula is nothing but which is present value of interest plus present value of redemption. This is the simple perspective. Apart from that, we have discussed a concept called a yield to call and yield to maturity. What is yield to maturity? What could be the return you can generate? That is just like IRR formula you have to apply, that it will be equal to your current market price you pay. Yield to call means if you call before the maturity, that price only we have to consider. So depends upon the question, we will practice these areas also. You can revise in regular class the question we did for yield to call and yield to maturity. Our focus is today on solving all the previous year question, including recent December 24 question, And my dear friends, in this bond area, we have some more additional concept from CA final that also we focused in our regular class. That is, they're asking conversion, they're asking parity price, they're asking what is the changes in the price, all those concepts also discussing. So we will focus those points also. So with your permission, shall we start, friends? Are you ready? So with your permission, we are going to discuss those areas. So let's start the game. Let's start. So before doing December 24 question, which is very easy, we'll do one June 24 question. Accordingly, we'll come. So June 24 question on valuation of shares. A very good question. Shall we start? So June 24 question on value of shares. I know you are ready. I am also ready. The earning of dividend equity share of Rexel Limited has been growing at a rate of 10% per annum for 4 years. So first, so how many stages you see? Up to 4 years, 10%. After the 4 year, rate of expected to decline linear. It means every year it will come down up to 7%. After the 6th year, growth will fall and stabilize at 7% forever. The last dividend is 3. Investor required rate of return is 16%. What is the value of stock? So they are told 3-phase model. We can easily work out on this. I know you are ready. I am also ready for this. So let's start. Year 1, 2, 3, 4. Then we have 5, 6. Then terminal value. What is the dividend rate? See, right now you are getting a dividend of what? 3. So it is grow at a 10%. So 3 into 1.1, you will get what? 3.3. Again, it is grow at a 10%. Again, it is grow at a 10%. Again, it grow at a 10%. After this, from 5th year onwards, what happened? It come down to 7. So how it will be 7? That is from 10, it will come down to 1%. It will be 9. Next year, it will come down to 1%. It will be what? 8. Then after the 6th year, it will come 7. That is 3 year, 3%. Suppose if it is a 6, every year 2 will reduce. Depends upon the situation. So we can able to grow with this. So you can go for your discount rate at 16%. So we are doing a shortcut. Though we discussed formula, this method, we are doing in a table method, which is very rarely in your study material. This method will help you to recall your capital budgeting concept and able to crack very easily. One method, one format, you will get the mark easily. In your study material, we have done division method. So we do easy method. So we will find out the terminal value. What is terminal value? We have discussed the formula for terminal value. That is dividend of nth year 1 plus growth. So 1.71 into growth. So here it will come what? It's come down to 10, 9, 8. So it will come 7% divided by KE, which is 16%, minus growth, which is 7%. So what is the terminal value, friends? Your terminal value 61.48. Now you can go for your discount rate. What is the discount rate, friends? Each year they are given 0.862, 0.743, 0.641, 0.552, 0.476, 0.41. See, terminal value, always we have to take what is the previous year. So same 0.1. So here come the value of share. You have to just multiply. That is the only point. So you have to just multiply, you will get the present value. So if you take the grand total, you will get the value of share. So what is the value of share, friends? Which is 40.13. We have round off. Depends upon the mark in the exam, you can round off. Okay, friends. So this is how the value of share will come. They very interestingly have taken directly the amount. See here up to this 10%, then linearly reduce. So every year. So fifth year it will reduce 1%. So 9 will come growth. Next year 8 will come. Then finally only that 7 will come. So hope all of you are clear. See, if the question instead of last year dividend, expected dividend, if they use the word, or dividend for the first year, if they mention, we have to take directly 3. Whenever they give last year dividend, old dividend, we have to take growth accordingly. So shall we go for next question, friends? Please take your time. This question we have also discussed in our regular session also. Proceed, friends. So once you completed, I will proceed. So very interesting concept. Now, I prefer to take another one model, question number 19, which came for December 23. Superb question. So every year valuation of shares question is coming. Fizzy Limited earning and dividend has been growing at a 18% per annum. So dividend is growing at a 18%. The growth is for 4 years. So 4 years only 18%. After that growth rate will fall to 12%, not linearly. Not linearly means what? Every year 12% only for another 4 years. Thereafter growth is expected to be 6% for that is for terminal value 3-phase mode only. Here also they use the word called last dividend is 2. Required rate of return is 15%. Assess the value approach under 3-step approach. So we can go for the question number same manner. So this is which question, friends? Question number 19. So what is the dividend? First year it is 2. So they are growing at a 18%. So last year 2 growing at a 18%. So it will keep on growing every year 18%. For how many years? For the next 4 years. So once the 4 year is over, there onwards next to 4 year, it will grow at a 12%, not linearly. That means 12% will continue for the next 4 years. So you have to take the same. How interesting, friends. Here onwards, terminal value we have to approach. Terminal value how 6.10 into it will grow at what? 6%. So 1.06 divided by K. What is the K? 15% minus the growth rate. How interesting. So this type of question we can easily complete fast also. $71.84. Here we can take 3 decimal, that is fine. Now discount rate. Generally discount rate will be given or else you can find out. We can take 3 decimal or a 2 decimal. Generally discount rate will be in the question. Now here terminal value, just like our previous question, what is here? The same thing, only we have to take it. So 0.327. Now what is the value of shares? We just, how interestingly we are completed, friends. So it depends upon the decimal. You can take 2 decimal or 3 decimal. Answer is over. The value of share is what? 40.33. The value of share is what? 40.33. Okay, friends. Now we'll go for December 24 question on value of shares. So every exam value of share question is there. So we'll go for December 24 question. So let's start. What is December 24 question? So December 24, Pulse Limited issued a, this is the question, 16. Textone Limited is a major player in the textile industry of the country. They expect to maintain a high growth for a 5%. Expect to come down. See, high growth only they are mentioned. Growth rate they are not mentioned. We have to find out. We have discussed a growth rate is not given. We have to find out by dividend payout ratio. We can get what? Retention ratio. So retention ratio into ROI, you will get the point. So we'll see it. The dividend payout ratio remained at the current level for the 5 years. Expect to increase 55% after that. Net profit margin is 8%. Expect to remain at the same level for the next 5 years. After that, it is expected to decrease by 5.7. Currently, this company is able to generate a sales of 2.5 for every one asset employed and is expected to remain for the next 5 years. After that, companies expect to generate a sale of 3.5 for every one sales. 50% of the assets of the company is financed by equity and is expected to remain the same in future also. At present, risk-free rate is 7%, market risk premium 15.5, beta is 1.2. So it's a clue for finding out K. Calculate the net worth of the current net worth of the company is 250. Number of the shares outstanding is 2 lakh. Assume the market is in equilibrium. They given discount rate 20, 24, 25, 25.6, everything. Analyze the price of share using dividend. See, it is same of previous year question. What we did previous two questions. The only difference is that in this question, they are not given what is a dividend amount, what is a growth rate. That we have to get it from the question data. That we have to get it from the question data. That is the only difference. So first we will compute what is the dividend. Computation of dividend. So how you will compute the dividend, friends? Very easy. They given net worth of the company. What is the net worth of the company? 250 lakh. And they said that 50% of the assets is financed by equity capital. So debt equity ratio, or we can say equity to total asset 0.5. So what will be the total assets? 250 by 0.5, which will be 500 lakhs. Your total assets is what? 500 lakhs. They said that asset turnover is what? 2.5. Asset turnover ratio 2.5. So what will be the net sales? 500 lakh into 2.5. 1,250 lakh. The question is given, you are getting a profit. So what will be the PAT or EAS? Nothing tells about preference. So PAT or EAS is same. 1,250 lakh into 8%. What you will get? You will get 100 lakh. What is the number of shares? 2 lakh. So what is the dividend per share? 100 by 2 lakh. Rupees 50 per share. Both are lakh. 100 lakh by 2 lakh. That's all. Now you have to find out your ROI. What is the return on investment? Return on investment is PAT is 100 lakh. Your investment is 500 lakh. So it is what? 20%. What is your retention ratio? Retention ratio for 5 years. Retention ratio for 5 years is, they said dividend payout ratio is what? The company's current is 40% profit. So 40% profit they are distributing. 60% will be the retention ratio. So what will be the growth rate? The growth rate will be 60 into 20%, which will be 12%. So you get the growth rate is what? 12%. So you go to your dividend, everything. Now you can go for year 1, 2, 3, 4. How many years this is continue? For 5 years. Here terminal value. What is the dividend per share? 50 plus there is a growth of every year what? So 50 into 0.12. This is how you have to make it. Now you have to find out terminal value. So terminal value growth rate will change. So come on, friends. I request all of you to try. So this is the way you have to compute it. So same of what we discussed the previous case only. The only difference is what? You have to identify the data. So come on, friends. Let's see how many of you will complete. So you got PAT or EAS 100 lakh. Number of shares is what? 2 lakh. So you won't get not DPS. It will be what? EPS. So EPS will be what? 50 per share. So what is the dividend payout ratio? which is 40%. So dividend per share will be what? Dividend per share will be 50 into 40%, which will be what? Rupees 20 per share. Now, very, very important. This is special discussion for those who friends who choose the group for BVM as a choice paper or already learned. See, what is the formula for growth rate? This growth rate formula very interesting. See, if you do FCFF, yes, FCFF means free cash flow to the firm. That is, you're going for the whole company. At the time, you have to take ROE. That is return on investment because you're doing for the firm. But when you are doing FCFE for the equity shares, see, we are doing now here for equity share, value of share only. When you do equity shares, we don't want to go for ROI. We require is what? ROE. Return on equity, because value of equity or share only we are finding. So you will take ROE. What is your ROE? PAT by equity into 100. What is your PAT? Your PAT is 100 lakh. Your equity is 250 lakh into 100. You will get 40%. So what is the growth for the first 5 years? Growth for the first 5 year. Retention ratio into ROE. What is your retention ratio? Your retention ratio. Dividend payout is 40%. So retention will be 60%. So 60 into 40 percentage. You will get what? 24 percentage. You will get what? 24 percentage. Now you can find out value of share under dividend discount model, year 1, 2, 3, 4, 5, terminal value. What is the dividend you have to return? Discount rate. Discount rate, you have to compute the K. They are not given. We have to approach KE under CAPM approach. So RF plus beta of RM minus RF. So K is equal to, what is the RF, friends? Your RF is 7%. So RF is 7%. What is the beta? 1.2 into RM minus RF. They're given already risk premium 15.5. So what is the answer? 25.6. So you can approach here. So 25.6, no need to struggle. They given question itself. 0.796. 0.634, 0.505, 0.402, 0.302. Come on, friends. I want you how to compute the balance. Let's see how many of you will complete the same. This is December 24 question. The only difference is what previous question and over. In your study material also this much good question is not there. Here growth rate is not there, dividend is not there. Everything we are computing. So we can able to do it. So we can able to approach the same. So what will be the first year dividend, friends? I know you have already done. So first year dividend will be, we have did already. So the growth. Right now your dividend is what? 20 rupees. So there is a growth of what? Growth of what? 24%. So the number will be what? 24.8. So this will keep on going. So 1.24. Now this will come only up to 5th year. After the 5th year, what will happen? We have to find out what is a new growth rate because the data is changing. What is the changing, friends? Dividend payout ratio is changing. What is the dividend payout ratio? Dividend payout ratio 50. Dividend payout ratio expect to increase 55%. Moreover, lot of other changes also there. Asset turnover ratio 3.5. So you have to come the reverse way here. You have your net worth. Is there any changes in the net worth? Is there any changes in the net worth? No. That is remain same, correct? But asset turnover ratio changes. What is the new asset turnover ratio? 3.5. So your net sales will be 500 into 3.5. Here 500 into 2.5, that will change. So 500 into 3.5, 1750. What is a new PAT? 1750. Profit ratio is changing. If I am not wrong, it will come down to 5.7. So 5.7 percentage. So what will be the answer? You will get 99.75. So what will be the ROE? 99.75 divided by 250 into 100. You will get 39.99. Shall we round off into 40%? 39.99. Shall we round off into 40%? Are you ready, friends? Same 40%. So now what will be the revised growth rate? Your retention will be DPR is 55. So retention will be what? 45. So you can just apply the same formula. That is ROI is what? 45 into 40%. 45 into 40%. You will get round number. That is 18%. You will get what? 18%. So you can go for terminal value. What is your terminal value? You got 58.63 into 1.18 divided by KE minus GR. Your KE is 25.6 minus GR, which is 1.8. You will get your terminal value. We did lot of terminal value question, so you will be easy for you. We have done in this revision itself 3 questions, so you can able to get the terminal value easily. So what is a terminal value? You will get it. You will get a number of 910.35. So 910.35. So same number. So what is the value of share? We will get it, friends. We have to multiply. That's all. So if you compare the previous question and this question, both are same question. The only change is what? The only change is what? That growth rate and what you call dividend is not given. That we were found out. Growth rate and dividend not given. That we were find out. Hope you are clear. So please take your own time and complete, friends. Yes, I will answer. Yes, friends. It is discount rate is 3.2. Okay, so we'll make it 0.32. Correct, friends? So we'll make it. It's a discount rate. We have a small correction. It is 0.320, not 302. So you will get a number called a 387. You can write it. Generally, once you get the final answer now, you can return like this. Value of share is equal to rupees 387.58. So our own method, we can solve all the question. If you refer the suggested answer and all very complicated. So you can go with one method. you can hold the question, but final answer will remain same. So please take your own time and copy, so you can able to solve the value of shares very easily. Now we'll proceed next question, friends. Okay, please take your time. So we have did all the new syllabus question here. Okay. So this is how we have to approach, friends. Now we can go for value of shares MQP. See, MQP is not up to the standard. This is your MQP question where they are asking the same point. ROI is there, record return 40, calculate the amount stock if retention is 60, ROI is what? 90. So the same thing we have done now, a very good essay question. Comparing to that, this will be very easy question. So we have two questions from value of shares. Set one question, set two question. So I will discuss this. Let us see whether you will be able to do. See, this 23 is a ditto of our second question. Expect to pay dividend fourth at the end of the first year. So directly you have to take dividend of 7 at the end of the second year, 11 at the end of third year. Fourth year what you expect to grow at a 4%, record rate is 40. So what I will do now, we'll do this. It's a small different question. Sometimes it is recently released. May 4th week only it is released. Ditto question will come for exam. So we'll do this 23. There is a point is the 23 and 22 will do value of shares, which is MQP question. So no need of taking the time. So we'll go for question number 23. So how the question, friends? We have year 1, year 2, year 3. Then we have terminal value. See here the very important point. Lot of friends are asking, sir, when we have to take, lot of friends are asking when we have to take D1 or D0. See here, the dividend pay 4 at the end of the first year. Means first year is 4. No need of taking the growth. See, so far past dividend they said we added the growth. But here you don't want to add the growth. Already the question they given 4 rupee. Next year, what will happen? At the 7th at the end of the second year. So here also the amount is directly given. Here 11 at the end of the third year. So terminal value we have to find out how they will be grow at a 4%. So 11 into 1.04 divided by K. What is the K? Required return is 14 minus 0.04. So if you apply this, you will get the terminal value. So how interesting. See the 7 mark essay you are doing in a small time. 7 mark essay you are doing in a small time. 114.44. See how interesting. So you can go for your discount rate at 14% because they said it. Discount rate at 14%. So what is the discount rate at 14%? The same manner. One divided by so 0.877, 0.769, 0.674. This is also 674. So what is the value of share, friends? We just want to multiply. See, this can come if you take the previous question trend and all. This can even come for what? 7 mark. This can even come for what? 7 mark. The value of share is what? 93.41. The value of share is what? 93.41. So how easy, friends? This is the question for set 2. So one concept, you can able to solve this very easily. Now, this is also same point. Currently retain 90% of the earning. That means 10% only dividend. 5 rupees, ROE is 30%. So growth rate. Same kind of question only. So that you can able to solve it. If you want, we can just tell you the final answer. You can try it. You can just try it. Come on, friends, that question. For time saving purpose, I am just doing that. Final answer only I am just showing. Already growth rate, everything is there. So same question, same manner we can able to do that. So it's a set 1 of your June 25 question. So this share question, one of the pakka question you can able to solve it. Share question, one of the pakka question you can able to solve it. Question number 4A. The question came for 4A. So the required return is 14, ROI is 30, retention 10. So your earning is 5, they said. So if your earning is 5, your dividend will be what? 5 into 10%, 0.5 only. 90% is the growth rate, ROI is 30. So now only we discuss the formula. That is the reason I am not solving this. Same thing. You discuss a December 24 essay question. Comparing to that, this is a very base question. So what is the answer? 90% is the retention ratio into 30%. So 9 into 30%, your growth will come 27%. So accordingly, you can able to go for the answer. So second case, it will change it. So they are asking only growth rate. So in small answer, small point. So hope you are clear. So what is this point for? Don't. This is actually don't go through with the institute material, always will confuse you. This is market price only. So 5 into 0.1, accordingly you get the answer. So you go for the price only. Okay. So dividend by KE minus growth rate. K is 14%, growth we got it. So that application only it came. Now I want to highlight one thing. See your BVM model, one question came. This we discussed in the video session also. I will attach in this. So we will discuss this. They're asking one question on value of share based on what? The share price. We will go on to discuss on this. So hope all of you completed. Now, my dear friends, we are going to do a very good question which came for December 24 on valuation of bond and conversion. These kind of questions are not directly coming from our study material, which is coming from mostly from CA final model question. So I have already highlighted you to revise CA final practice manual also for better understanding so that you can get a more practice. So we are going for 15A. Paulson Limited has issued a convertible bond with a face value of 1 lakh. Bond pays a coupon rate. Coupon rate is a another rate name for what? interest rate 6% per annum with a interest payment semi-annually. What is in by semi-annually, friends? Every 6 months. Every 6 months. The bond has a term of 3 years and it will be redeemed at 1,10,000. That is at the end of the third year, 1,10,000. Alternately, the bond holder has an option to convert the bond into 50 shares at the end of the 3-year term. The required rate of the bond is 12% per annum. Currently, the share price is 2,000. Shares are expected to grow at a annual rate of what? 8%. Shares also will get a dividend of every year what? 50 rupees. They are given all the discount rate 3, 6, 8, 12. First, they are asking what is the value of bond if it is redeems at maturity. You know what is the formula for value of bond. You know what is the formula for value of bond. What is the value of bond formula? Present value of interest plus present value of redemption. So we have to find out this. So we have to go for here it is not year, it is month wise every 6 months. So 6 months, 12 months. So 18 months, 24 months, or else you can make year, but in your mind you can do 1, 2, 3 period, or we can better way period, first period, second period, third, fourth, fifth, sixth. This is the best way. That is every period is a 6 month. Okay, so you can able to, so 3 year 6 period will be there. So what is the interest rate? See, every year same interest rate, so we can do easy method. Present value, what is the interest rate? Don't want to do this statement. Every year same interest rate, we can do annuity factor. So what is the interest rate? Your 1 lakh into 6% into 6 by 12, you will get 3,000. So what is the present value of interest rate? You have to get you have to put the interest rate here, or else I will just put it. Why we want to make it? We'll go proper way. So you will get what? 3,000. Now you can go for it what? Discount rate. Here the very important point, it is 6 month. So annual required return is 12%. This is annual. So if it is a 6 month, we discuss semi-annually lot of bond problem in our regular classwork book. Correct? Remember, if it is a semi-annually, you have to change into semi-annual rate. So it will become what? 6%. It will become what? 6%. So 6% discount rate is given in the question itself, 0.943. So are you clear why we take 0.943? 0.943, then 0.89, 0.84, 0.792, then 0.747. See here, though they mentioned year 1, 2, 3, 4, I think it is correct. 6%, the effect will be remain same, because 6% that each period it will be correct only will come. 747 next 705. So what is the value of bond? Just like present value. This total is called present value of interest rate. Last 6th year, you will get your redemption value. Generally in share, we call what? Terminal value. Here you will get what? Redemption value, which is given in the question itself. It is not interest rate. It is redemption value only. So I am, though interest column I am written, it is not interest rate. 1,10,000. So what is the number, friends? So if you take the sum total, this is your value of bond. Answer is all. How superb? This is your value of bond. So answer is all. So how superb? Question may different you feel. That is why I discuss. Earlier model, this model entirely different. This is our normal point, but little interesting way they are asking. Next is a new concept that is not in your study material. It is convertible bond. We have discussed earlier question on convertible bond. So the same question only. Shall I proceed for that, sir, friends? Shall I proceed? All of you ready, friends? Thank you. So when it goes for convertible bond, value of share at conversion. So value of share only they're asking. So value of share at the time of conversion. So value of share at the time of conversion, which is nothing but, as you know very well, they given very well that 2000 is the share price, expect to grow at a 8%. So what is the value of share? Value of share will be present value of dividend plus present value of share on conversion, both together. That is what is the value of the market price, what is you got the value of share. So first we will go for share price at conversion time. Right now the share price is what? 2000. This is going to grow at a 8%. So how many years? 3 years. So 1.08 for 3 years. So what is the answer, friends? Can anyone tell? You can take in your calculator 1.08 into 3 times into 2000. What you will get? 2005 90. No. 3 times you have taken 2000. This one? Correct. 2000 519.424. So total for 50 shares. Logic clear? So we have to take for total 50 shares. These are all the value. So what is the dividend for 50 shares? Before that, we'll take it first one. Present value of 50 shares. What is the present value of 50 shares? 125,921.2. It is a price now or price after 3 years? After 3 years. So 12% is the expected rate. So 3 years, 12% rate is 0.712. So you have to take that present value. So what will be, you got it? 86. See why we take here two price. This is the share price. Apart from the share price, every year you are getting dividend also. So you have to take what? Present value of dividend. You have to take what? Present value of dividend. So for a better understanding, what I can do now, I can make a table presentation so that you will be able to recall this in a proper method. This is called a, so that you will be able to recall a normal hour method. I will change this into. So if I do table method, you will be able to interrelate very easily. So I will prepare table method. So every year you are getting a dividend of what? 50 each. Every year you are getting a dividend of what? 50 each. How many shares we have? 50. So 50 into 50, 2500. Here, this is the value of share which we found already. This is the value. Now you can take discount rate at 12 because your share price is 12. So same thing, you have to make it required rate and 12. So 0.893, 0.797. Answer is over, friends. 0.797, 0.712. This same 712 will taken. So what is the value of share? That is after 3 years, what is the value? After 3 years, the value nothing but sum total of what all you are getting. Present value only. So what is the value of share at conversion time? So at conversion time, your value will be this one. So table method, you will be able to interrelate very well. That is why I have done a table method. This is what? 95,660. See, the same thing only I have thought of here. Present value of dividend, which will be what? 2,500 into annuity factor. This 3 annuity factor is 2.402. 2.402. So whatever the method you feel good, you can take it. It is comes 6,005. So this two total only this one. So whichever you feel easy, you can do it. Both are same thing. Because we did all the question in a year 1, year 2 perspective. So I have done. All of you clear this number? It's a very good question. This type of question is not in your ICMA material. That is why bond question always is coming from old syllabus EA final or some other material, because in our book they are discussing only base model question, yield to call, yield to maturity only. Yield to call, yield to maturity and all easy only. IRR model we can able to solve it. Now tell my dear friends, which is best for you? See, assess the value of conversion option. Which option is more advantage? Assess the value we have done. Which option is more advantage board? So bond is go, you will get value 92. Share you get 95. Which is best? Share only. That means you go with the share. After 3 years, you will convert into what? Bond. Now, if you buy bond, after 3 year bond value only what? 92,301. But if you go with share, after 3 years, if you convert, you will get the value of what? 95,660. So this is how you can able to go for it. This is how you can able to go for it. So very interesting point. So very good morning, friends. This session is exclusively for as per the latest trend of your question paper. Syllabus 2020 latest trend. See, in your syllabus, you have a topic called valuation of shares and bonds. In the regular class, we discussed how and all you can find out value of share. Value of a share, we discussed different methods. Which are all the methods we have discussed? The first one is constant dividend model. What is in by constant dividend model? Dividend by KE into 100. Then we discussed dividend growth model. What is dividend growth model? D1 by KE minus GR. Then we discussed the two-phase growth model, three-phase growth model. Three-phase growth model not regularly coming area for your exam. Coming next, we will discuss the value of bond. The difference between value of bond and share is what? Share is infinity, but bond for a fixed period of time. So generally, the value of bond we have discussed is what? Present value of interest plus what is the present value of redemption price. This is how we discuss the value of bond. In value of bond, we have also discussed a concept called a yield to maturity and yield to call. All the video are uploaded in the drive also. Now, what is special session? My dear friends, if you go through the 22 syllabus, first 2-3 attempt question paper, they are asking questions from preference share conversion, debenture conversion, all these conversion based questions. Generally, this is only in CS syllabus. It is not in the CMA syllabus. If you go through our CMA study material, you can't find any question about straight value of bond, conversion parity price, conversion price, nothing. But the questions are coming. So what is our strategy? We can't say it is out of syllabus. We will get the full mark. That is no school class. Now we are in a professional knowledge, so we have to learn everything. Those friends who already learned Group 4 CFR, they might have been learned this. Or some of the friends that are intermediate also, they might have been learned the same concept only we have in our SFM also. It is we are taking as a special session to cover the additional question of valuation of shares and bond. So we'll start with that. Are you ready, friends? So let me tell you, since this is not a topic, not exclusively your syllabus, first we will discuss what is this all about. This all about is what? See, it is all about convertible debenture and convertible preference. See what is happened, convertible debenture and convertible preference. That is convertible debenture. See, if your debenture value may be 1,000 rupees, your debenture value may be what? 1,000 rupees. This debenture may be listed. The market value may be what? 1,200. This 1,000 rupees, let's say, at a interest rate of what? 10%. So the company is planning to go for convertible debenture. You might have been learned in your accounts class what is with a convertible debenture. This can be convertible into what? Share. So generally how it will be? There will be a conversion ratio will be there. Because your share price may be 100 rupee face value or not. There will be conversion ratio. What is conversion ratio? Let's say 20 shares for every one. That means what? You will get 20 share if you hold one preference. It can be another way also. One share for every 5 debenture. That means if you have 5 debenture, you will get what? One share. See, this kind of will come if the company market price is very high, where debenture is what? Very low. But if your debenture is high, share is less like this. This is what conversion ratio. This will be what? Conversion ratio. So let me tell you what is this all the concept. Let's say your 20 share for every one. 20 share for every one. See, now let us tell you one point. Right now, the market price is a constant or it will keep on changing. Market price will keep on changing. So let's say on this day, your market price on the day is, let's assume it is 40 rupees. What is the price? 40 rupees. Or we can give 52 rupees. We'll make it as what? 52. See, you will get what? If you convert, you will get what? 20 share for every one share. You will get what? 20 share for every one share. So how much is the value if you convert 20? You will get the value of one share right now is what? 52. If you convert after the conversion, the value will be what? Can you just take your calculator and tell me what is 20 into 52? 1040. My dear friends, if you compare this with your current market price, your current market price of your debenture is what? 1200. But if you convert into share, because company have an option for convert, company if you convert or if you convert, the value right now for you in equity share will be what? 1040. You are getting a discounted value or a premium value. You are getting a discount. That is your price, market price of your debenture is right now what? 1200. Right now the price is only what? 1000. Now, same way, if you compare with your straight value, what is straight value? Straight value is your face value. If you take your face value, what is your face value, friends? What is your face value, friends? What is your face value? What is the face value? Face value is what? 1000. In that 1000, you are getting what? 1040. Is it a premium or a discount? It's a premium. Correct? So you can compare the premium or discount on your market price, or it can be able to convert on what? Your straight value also. Correct? So these kind of analysis only we are going to learn in this chapter. This kind of analysis only we are going to learn in this chapter. Similarly, see if you go through, if your market price, let's say if both are same, we generally call parity. What is parity? The parity means what is it by parity? If your market price is 1200, if you are getting 20 shares, can you just take your calculator? 1200 by 20, you will get what? 60. If your market price is 20, you could have been get what? Same. That is right now it is a parity price. What is parity price? No premium or no discount. No premium or no discount. So these kind of concept you might have been learned in your accounts, in your group 4 or in your group 2. The same thing is coming in your SFM. This is there in the CA final group, CA final SFM. So the trend if continue, this kind of question will come for our exam also. So what we are going to learn is we are going to discuss the same thing will apply for what? Preference shares also. Preference share will have a market price, that will have a conversion price. Both are there. Conversion value of preference is what? For one preference, how many shares? When it comes to debenture means what? One debenture, how many shares? Like that you can able to go for it. Are you able to understand? There is a next level analysis also you can do. If your preference share is converted to equity, what will be the effect in EPS? Actually, these are all comes under your FR only. That is diluted EPS. If there is no share as issued, what is the EPS? If you convert, then what will be the EPS? Change in EPS. We generally call in our FR as what? Diluted EPS. So those kind of question also can testing. So what we are going to do, my dear friends, now, this is the additional topic. So we are not restricting to discuss recent CA final question. We are taking selected models of our CMA final question. Let me show you. This is the workbook. I hope all of you consider. This is one of the CMA exam. This is one of the CMA exam came recently. They were asking what is the shares of conversion, what is the straight value, what is the current market price. So they are asking the question. Are you able to get my dear friends? They are asking the questions. So how we have to approach this? How we have to approach this? That is what we have to learn. So in order to solve these kind of CMA questions, if you take ICMA material of your SFM, you type a straight value of bond, you cannot even get one sentence on this. But this is a previous year SFM question. So in order to crack this type of question, see, if you go through, this is comes under a chapter called security analysis in SFM of CA final. So if I want to take all the chapter of CA final, then there is no meaning of CMA course. Better we can go for CA course. See, in our course, there is a trend of coming what? This type of conversion model question. So we are learning. So because of the importance, every exam one question comes, we have taken around, because of the importance, we have taken around how many questions? 5-6 questions on this. That is what we are going to do. So initially, some of the friends may not be learned in detail in your FR class or maybe in your intermediate company accounts. I'll give you some formulas, basic formulas. Balance you can able to get it. So this is not your SFM syllabus. Safer zone we are taking it. So we are just our strategy is what? If at all coming, the same trend continue. If the same trend continue, how to manage? If same trend continue, how to manage? Are you ready, friends? So first we have discussed the conversion value of debenture. We discussed one concept called what? Conversion value. What is your conversion value of debenture? Market price of one equity share into conversion. So let me discuss all the formula, then you can copy it. We'll go directly. Because for time saving purpose, I am not making. So this is what is a conversion value? See, in this case, if you go on this example, we are getting market price is 52, 20 for every one share. So 20 into 52, you're getting a debenture value. What is the value? 1040. That 1040 is called conversion value. So one example, we're discussing everything. That is, if your market price is 52, you're getting 20 share, then the value, if you convert, it will be what? 1042. So that is what is called market price of one equity share in your conversion ratio. See, one CMA exam, they come reverse way. What is a reverse way? You have to learn reverse way also. They will tell you conversion value. They will tell you market price. So reverse way, you can get what? Conversion ratio. So this formula you have to understand reverse way. That is what I have discussed one example and interrelating the same. Next day, market conversion ratio. Market conversion ratio, I think what I have discussed the example. If your market price is 1200, if you are getting, how many will be there? That is how the point called it. Yes. Now we have one share for every 5 shares. Now here you want to identify the point called a market conversion ratio. What is your market debenture divided by conversion ratio? You have 1200 divided by your conversion ratio is 20. What is your code? 1200 divided by 20, the parity. You have to what? Market price must be what? 60. Already we take. That is what is called what? Market conversion ratio. Now going conversion premium or discount. Just now we discussed a. See here you have 1200 is the price A. Right now the conversion value is what? 1040. The difference is what? Premium or discount. The difference is what? Premium or discount. Why I use the premium or discount? Sometime it will be positive. Sometimes it will be what? Negative. That will be what? Discount. This is amount in absolute term. If you want in percentage, you can able to make it. This is in what? Percentage. Then premium or discount. See, what is this premium? What is this premium? I have told you from 1200 you can check it, or at 1000 also we can check it. If you are checking with what? 1000, that is what straight value. So on 1040 we discussed it is a premium. So you want to convert in percentage. See, the previous year one question, they given the percentage, the reverse way we have to convert. See, they given the conversion premium is given. We have to go reverse way. They given what is the current price. So you have to go what? Reverse way. So for that we have to apply premium, that is market price of convertible debenture minus straight value. Straight value nothing but what your main point. Next is what? Favorable or unfavorable income differential. This additionally is asking you have to go. So how much years you will get for this? Finally, conversion parity price. Just now only we discussed what is a bond price by number of shares for conversion. Most of the formulas are discussed there. If any formulas additionally, we can add in this formula page. Now let me tell you, here whenever I use the debenture, same will applicable for what? Preference also. If exam asking conversion value of preference, conversion value of preference, market value of one equity share into conversion ratio, the same effect only will. Yes or no, friends? So please take your own time and copy, friends. So, shall we start, my dear friends? So, since already we discussed the concept, already we discussed the formula, now we can easily approach the problem. So, my strategy for this is since it is a new topic, since it is a not a syllabus based topic, additional we are taking. So, for the benefit of everyone, I have shared the answer also there. We can directly get the answer directly itself for time saving purpose also. You can copy in your notebook also as you wish. In the material I have given the answer also, because see we are doing this topic for a safer zone purpose. So preparation also we want to complete very easy. We can't go detailed like our regular class. That is why I have given with answer also in the material, so we can save a lot of time. Otherwise we keep on doing everything. We can do more practice. We know the formula, just apply the formula. If you are very fast, you can also copy it together. Yes or no? So the first point, conversion value of debenture. Tell my dear friends, what is the formula for conversion value? Market price of equity share into conversion ratio. You have 25, conversion ratio is 30. What you will get, friends? Come on. 750. See, already for me, Excel is very easy. Already it is there. So you can directly do it. So you can also parallel rate also, that is used. Then market conversion price. Can you recall what is the formula for market conversion price? What is the market price? This is the market price, this is strike price. So market price is 30 divided by what? Conversion ratio. Conversion ratio is 30. What is the market conversion price? It will be 30. That is, if 30 is the market price, your both value will remain same. I hope now you are able to recall it. Now conversion premium per share. They are asking what per share. So you have 30, you have 25. The difference is what per share. 30 minus 5, you will get an answer called what? 5. Next they are asking what is the ratio of conversion premium. That is, you have already you have your 5. That 5 out of 25, you will get a ratio. This is the percentage you have to do. 5 out of 25, you will get what? You get what? You get what? Ratio, which is 20%. Next thing, premium over straight value of bond. See, what is your straight value of bond? Your straight value of bond is what? What is your straight value of bond? Your straight value of bond is, let me see. See, the straight value of debenture is given in the question itself, 700. So very, very important. You just listen. This straight value premium normally coming for exam. So straight value is 700. What is your market price? 900. This difference only premium. So 900 minus 700 divided by 700 into 100. What you will get, friends? 900 minus 700 divided by 700 into 100. What you will get, friends? 2857. See, I just copied the suggested answer from CA final. They did another one formula, small formula, maths formula only. But you don't do that. You do conceptual way. You do conceptual way. We discuss the conceptual formula. You have already written the formula. Next, favorable income differential. How can you get favorable income differential, friends? Your conversion price interest is how you will get it. See your income. Income means what? See, as a shareholder, what will be the effect? Very, very important. Let me tell you in detail. As a shareholder, if you holding a debenture, listen very well. As a shareholder, if you holding a debenture, 1000 is the face value, 8.5, you could get a interest of what? 85. You could get an interest of what? 85. Now you are a shareholder. You will get only what? Dividend day. Dividend is what? 1 rupee. How many shares you will get? 30. So you will get 30 rupees. Out of 80, you 85, you will get now only what? 30 rupees. So can you take the point 85 minus 30? What you will get? 55. 55 you will get. They are asking per share. They are asking what? Per share. So in that 55, you have to divide your conversion ratio. 55 by 30, you will get an answer called what? 55 by 30, you will get an answer called what? 1.83. That is what they made. See here, listen. 1.83. Now, 1.83 means what? When you will cover it, it's direct question. That is, you are getting a conversion premium of what? 5 rupee. This 1.83 you will able to recover in what? 2.73 years. This premium you are getting, the premium you can able to get in what? 2.73. So this is how you have to make it. So if you wish to write, you can write. I will wait, my dear friends, without referring the answer. Answer I given just for taking the time for me typing in the Excel, but I haven't refer the answer at all. Just showing we have done all the answer here directly only. For me, when you are typing it again, it will take time because we have to do more number practice. You have to do more question practice, similar model. So what I request you that if you wish, you can copy very fast, or else we'll go for the next question. Now, we'll proceed for next question. Hope you are all completed. See here also reverse calculation. Here comes a little bit reverse calculation. See, they are asking face value is given again bond rate 250. Coupon rate is another name for what? Interest rate. Number of shares per bond, that is conversion ratio. They are given for every bond you will get what? 20. Here and all reverse calculation will come. Market price is 12. Strike value of bond is 235. Market price of convertible bond is what? 265. They are asking what is the stock value of bond. What is the stock value of bond? Number of shares is 20. Stock price is what? 12. So 20 into 12. What is the stock value of bond, my dear friends? So here we use the word called a conversion value of debenture. The same thing only stock value. Both are same meaning only. Stock value is conversion value is also called what? Stock value. If you convert, so you can also written in your formula page. Both are same meaning only. Both are same. If you convert into stock, what is the value? 20 into 12. What you will get, my dear friends? What you will get? Can you please tell me what you will get? Come on, friends. Come on, friends. 240. Next, very important point. They are asking percentage of downside risk. Very, very important point. Very, very important. This will have reverse calculation. Downside risk, I don't think I have it written now. If I will write now itself. See, downside risk is nothing but downside or upside, upward risk. This can be either upward. See, this is the changes in. This is what your changes in straight value and your market price of convertible security. This is what the change. What is in the downside? It is reducing effect. So downside or upward means changes in straight value and market price of convertible securities. You can just add in your equation page, because if you add in your equation page, one equation page, you will be able to solve all the questions, just like we approach in our portfolio chapter, mutual fund chapter, in all the chapter. Yes. Now coming back to my dear friends, see your downside risk. What is the thing? See 265, it can go up to what? 235. The difference. So 265 from 235 by 235, it will go up to what? 11.36. How interesting, my dear friends. 265 minus 230. Difference. The difference only called the point. Are you clear? Yes or no? So very important. Downside risk or upward risk, you are comparing it to what? Straight value with the market price. You should not change that. So this is nothing to do with your conversion. This is nothing to do with what? Conversion. Conversion premium you are expert in. What is the conversion premium, my dear friends? You are getting 240. What is the right now the price? 240 only your conversion price. Right now the market is what? 265. Our Dheeraj is asking the same doubt only. 240 is the conversion rate, you got it. But market price is what? 265. So the premium will be what? 265 minus. Yes. Now, are you able to recall conversion parity price formula? What is conversion parity price? Your mark. What is a conversion parity price formula? Can you recall the formula? Market price 265 divided by number of shares is 20. 265 by 20. What you will get, friends? 13.25. 13.25. How interesting, my dear friends. So please take your own time. You can just copy or not the important point you can able to do. So my dear friends, if you are able to recall the formula very well, solving these kinds of problem are just a 2 minutes or 3 minutes effort only. Not at all a 7 mark effort. And I will show you the recent previous year CMA final question within 2 minutes. Shall we start, friends? Okay, you just take your own time. Now, my dear friends, we'll go for next question. I think it is time for you to approach our CMA question. It's reverse question it came. We have direct question also came one time. Now we go for reverse way. They tell convertible bond which is currently priced at 1060. My dear friends, 1060 is the market price of bond. 1060 is the market price of bond. They tell conversion parity price. That is, if 53 is the price, your parity will be what? 53. Conversion premium they have given. Then percentage of downside with respect to straight value of bond also given. Shall we start, friends? Are you ready? So let us start first. First, calculate number of shares of conversion. How to do, friends? Can you please tell me? Market price of bond. What is your market price of bond? Divided by 53. You will get an answer called what? 20. How easy, friends? I haven't given no working at all because it's CMA question. I have just done final answer only there. Next thing, analyze the current market price per share. This you have to apply your concept of what? Premium. You have to go with the concept of what? Premium. How can you go for the premium? Your conversion premium is what? 10.441. So let me tell you how it will approach. Your premium is 10.41667 percentage. Correct? So your conversion parity price is 53 into 20. This is what parity price. So what is the premium? How you will able to get it? One second. They are asking per share. Per share. Shall I discuss step by step, my dear friends? I have done directly the answer. Some friends may have doubt. I'll give with a working note. See, I willfully not given any working note here because some friends, because the CMA question, some friends are over confident of this method. This come reverse way. This come what? Reverse way. This question is a reverse way question. We can solve in 2 minutes, but we have to properly approach. How you will do? See, listen very well. They given premium is what? 10.41. That means your parity price is what? Or your market price is what? 1060. Your market price is 1060. So your premium right now, we know what is the value you are getting. That is 960. How you got this 960? I am doing it very well. They don't give 960. Reverse way given. From the price, the right now it is a premium is 10.41. So how you will do this price divided by premium? So what you take 1 point. This we will take 10.41667. So you will get the price. If I do what? 960. This is the total. They are asking in the question what? Per share. So how many share for conversion? Divided by 20. So you get what? 48. Are you clear? Next is straight value. Tell my dear friends, downward risk, upward risk, you take straight value with the conversion price or trading value. Which price you take? Trading price. What is your trading price? 1060. 1 minute answer is over. 1060. They are asking that. See, they assess straight value. They are given straight value differential. What is straight value differential? 12 points. So we don't know straight value. From straight value differential is what? 12%. The 12% answer is what? 1060. So your answer you know 1060. Straight value we don't know. You can go reverse way. This is 1.12766. You will get answer called what? 940. It's everything reverse way. If you want step by step with working note presentation, I will give it. But I think it's the reverse way calculation only. That is from straight price, the difference is 12.76. Price. If that 12.76 is differential, so you have to do accordingly. If you want proper formula, na, I will tell you like this. This is a proper formula. Let us straight value is XA. Differential is what? 0.01276 XA. Your trading market value is equal to x plus 0.1276x. This is all different way. I think you are able to recall the relationship. So your market value is 1060. So 1.1276x. So x is equal to 1060 by 1.12. Because some friends are little slow. For their benefit, I have given proper working note also. Here, because for your benefit, I have given the proper working note also. So later you get benefited. Yes, sir, I have written everywhere shortcut name. Here I have given what? Straight value. You don't give SV and all. You have to put full name. Then only you will be able to recall. What is this difference? This don't take simply market value. You have to take market value of debenture. I have taken everything shortcut. Are you clear? Concept clear? So this is fully based on the concept you have to practice. Don't refer the answer. I haven't referred the answer. I am just doing directly for you. So you have to make it. If you want the working note, I have given the working note also for you, my dear friends. So only the formula which we discussed in this base only all the concept. Reverse way or direct basis. Apart from this, nothing is there, my dear friends. Shall I proceed, friends? Shall I proceed? All of you ready? All of you ready? Thank you. Now, we'll go for fourth question. See, fourth question. Shall I start, friends? Here come preference share. See, whether it is a preference share, debenture, we have told all are same formula. All are what? Same formula. XYZ company has a current earning. Current earning means EPS of what? 3 rupee. They have a our shares outstanding is what? 5 lakh. The company plan to issue 40,000 7% convertible preference shares of what? 50 each. The preference shares are convertible into, see the point, 2 shares for every 1 preference share. Understand very well. If you hold a preference share, you will get what? 2 shares. So conversion value is 2. The conversion rate is what? 2. 2 for every 1. The equity shares are currently traded at what? 21. Directly we can do. Preference share conversion value. Equity share value is 21. You are getting 2 for every 1. So 21 into 2. Answer is what? Over. 21 into 2 you will get what? 42. What is the premium? Now only we discuss the premium. The right now the price selling at right now is what? 50 rupees. So don't do their formula. We have our own formula. What is our formula? 50 minus 40 divided by 50 into 100 or 40 into 100, whatever it is. The same answer only you'll get it. That is 42 only. Na? 42 only. The price, this is 42 only, not 40. I taken wrongly 40. So 42. See, the same answer will get it there. Just minus 19.04. So if you want working note, that working note is what? 50 is the right now market price. You are converting at 42. So what is the premium on that? This is the working. See, they have done a shortcut formula. Maths based students will be very easy. But for the everyone benefit, I have written on the board itself. Are you clear? So now we are doing preference A. But my dear friends, do you need any other new formula? No, not at all. That is the speciality of this area. We can able to score maximum marks. Now with your permission, I will proceed to next area. Assume the total earning remain them. Calculate the effect of the issue basic before conversion and after conversion. Please stop rating and listen here. This is all about your group 2 FM. Group 2 FM. I have told you the EPS effect. Let me show you on the board very well. Are you ready, friends? It's group 2 FM. Shall you ready? So first one, before conversion. What is the path they are given? The path they are given is what? 1 million. 1 million is what? 10 lakh. Am I right, friends? 1 million is what? 10 lakh. So company has 3 lakh shares of 5 lakh. So you have to first settle what? Less preference dividend. What is the preference dividend you have to settle? 40,000 at what? 7 percentage. So how much you have to pay? 40,000 into 7 percentage into 50 rupees. What you will get? You will get what? 1 lakh 40. Listen very well, because some friends say group 3 only learning. They might have been learned very long back. This is called EAES. Now you have what? Number of shares. Number of shares before conversion. Before conversion, how many shares you will have? Right now shares only. Right now shares we have what? 5 lakh. So what will be the EPS? EPS we know, earning available to equity shareholders divided by number of shares. Now next one, after conversion. How you will do for after conversion, friends? After conversion, let me tell you, same thing, PAT is not changing. They said the same. What will happen? There won't be no preference, because entire preference is what? Converted into what? Equity shares, because preference are converting into what? Equity shares. So you will get what? EAES also the same amount. Here comes the point, number of shares. Can anyone tell me what will be the number of shares without referring the answer in the book? Can you tell me what is the number of shares without referring? It's very easy. You are giving 2 shares for every one. You're giving 2 shares for every one. So right now you have 40,000 shares. So 2 for every one, it will be 80,000. So it will become what? 5 lakh 80. So you will get what? This is what called diluted EPS. That is after the effect, what is the change? Which is what? 1.72 forward. That is what here it is there. Okay, this is 1 second. The part, okay, 1 second. Let me do one small point. We did now fourth part only. We did now fourth part. We did now fourth part. You can just, we are not in third part now. We did a 1 second. One small correction, let me tell you. See, one small correction. Here, EPS is given 3 rupee. What is that? 5 lakh. So you should not want to this third part, this PAT is not given. So don't go through this. I have wrongly taken fourth part answer for 3 part. Here 3 into 5 lakh, you have to take what? 15 lakh. This one only. Now, this is how you will take 3 into 5 lakh. Because for solving the third part, I have wrongly taken fourth part answer. So we should not take fourth part. Let me tell you, you have to take the 3 into 5 lakh. Let me tell you how to do fourth part. Actually, fourth part, it is not 1 million they're telling. It is increased by what? 1 million. So don't want to copy. Let me tell you. Now you go to what? 15 lakh. You will get 2.72 is the current EPS. Its diluted EPS will be what? 2.59. Why this is getting reduced, my dear friends? Why this is getting reduced? Please stop rating and listen here. Why it is getting reduced? Because as our friend said, you are getting lesser the value. Because one equity share, two only you are getting. 2 into 21, the value is only what? 42, but here it is 50. That is why it is coming change. Now, this is for the third part. This is for the third part. Earlier we did fourth part. Now we are going for the fourth part. Fourth part, let's read the question. What is fourth part? Fourth part, they are telling that assume that after the change, your earning increased by what? 1 million. So your PAT, what will happen now? Earning not to 1 million, increase by 1 million. That means this 50 lakh, it is going to increase by what? 1 million. That is another 10 lakh. So this is the amount. For me, since I am using Excel, balance everything same. I got the answer directly. This preference is same. EAES is same. Shares is remain same. We'll get what? 4.72. I did copy paste. Yes, correct. Now when you go for here, the same point will come. Here what will happen? My dear friends, here it is. The PAT alone will change same amount. Balance and all, just copy paste. Hope all of you are clear. So this is why I told you don't refer the answer because you have to recall your group one. If you already learning group for BVM, it will be familiar for you. Otherwise, it will be a new topic for because you learned little longer back in your group two. That is why listen here. What is PAT? What is EAS? EPS? So this is also in the introduction time I have told you. They will ask you what is the effect on EPS after the conversion. I think this is covering in your accounting standard. Yes or no? Accounting standard or in the AS or AS? Yes, AS. In your intermediate AS, correct? So you can just copy this, friends. Same thing, only the material also there. Once you complete it, now what I have to tell you, my dear friends, now see fifth question also same part two thing. Sixth question also same part reverse way. So what I request you now, I want you have to try yourself fifth and sixth yourself. I have given the answer also. I have want you have to try fifth and sixth yourself. You have to try yourself without referring the answer. You have to try fifth and sixth yourself. That you have to try yourself. With this, we were approached the all the similar problem of the trend. I have repeating again in your this is came from CA final chapter called security analysis. They have a lot of topic, but the trend is coming this kind of question only. That is what you are covered. See, if you for your better understanding, if you want, let me show you. If you go for ICMI, if you go question paper, see, let me show you one thing. June 2024, they have removed that paper. You have June 2023 also same question came. Let me say here SFM. Is this SFM? Yes. Here the trend is like this. They are asking. See, first as we have told different time. First chapter, second chapter, that order only they are asking. See, this is in this question. They are not asked any question from this year. Yes, see this question 4A. See, there is a one question. Market price, conversion ratio, straight value, market price, expected. I think we did the same question. Favorable. That is this question. Here in CA final, I have discussed this question. Now, straight value, conversion premium, percentage of downside, conversion parity risk. So the same point only is coming. It came for what? 7 mark. Which question paper is this, my dear friends? December 2023. I want end, my dear friends. If you go for December 22 syllabus, again if you take SFM, the same trend. If you take your ICMA material, it is not coming. That is a problem. Now again, I am taking here fifth. Here comes fifth. Come back. See, this question now we did already. This 4 year. Yes or no? That means in June 23 also came, my dear friends. They removed June 23 question paper because that is a different format. They want to not to misguide the students. That is why they removed June 23 question paper from the site. You can't get June 23 question paper. See, you have June 24, December 23, then they don't have no question paper. June 23 is an offline exam only. Because of that different format of question, they removed it. So what I have to tell you that this is how the questions are coming. So my intention is what? See, are you able to solve these two previous year question now? Yes or no? That is the reason we taken this class. But I'm telling again, if your institute taken security analysis, lot of other topic, that is not different. We are doing all 100% of our syllabus. Plus, if anything outside they follow any particular trend, that is also we are covered. That is more than 100 enough. Whenever you are getting any any confidence, any issue, now you just go through here. All are our class ditto question. Mutual fund, our class ditto question. If you go Jensen Alpha, our class ditto question. This portfolio covariance. In the portfolio revision, we did total 5 variants. Recently, we did reverse calculation, portfolio beta, residual variance, chart ditto question. That means, see, in one particular chapter, also there is a chance of coming from outside. That is also we are covering. But I'm telling, still there is a maybe they may ask, but let us assume it positively, they won't ask it. Are you able to see? So here and all before beyond, these are all our class ditto question. Beta of portfolio, theoretical value of ditto, nifty. If you go through our study material, it's ditto question. You can February 2023. If I just enter in our class workbook, this what happened. February itself you will get it. So you have some positive, more positive, some negative. The negative only we are trying to overcome. You're getting my point or not? So now if you go through the recent MTP release, this is very, very interesting. See, if you go through the MTP, see if you go through the recent MTP released final SFM, one set is released there. See, here also the same trend goes. Now, very interestingly, let me tell you. See, here I am telling this particular chapter only. See, if you gone through here, if you gone through, they were asking our class model, value of stock. This is a two growth model we did in the class. Here they ask again normal question. That is in MTP, they are not asking that model question, but they are asking in the main MTP, they are asking study material model only. So we have to be safer zone. Previous year trend also we are following. If it is coming like MTP, we don't know. But you know, we have taken almost an effort of 45 minutes or 1 hour. You have to able. Now, if you want to revise it, only the formula you have to revise. Standard one or two question only. So you take your own time and just try question number 5 and 6 yourself. With this, we'll wind up this topic and we will move to the next topic. So, very, very good morning, friends. Today, we are going to start the revision of our mutual fund chapter. See, the main advantages of mutual fund chapter is comparing to all other chapters. You don't want to learn much extra concepts. If you have a little bit base from the portfolio chapter, you can easily able to crack. Moreover, if you are going to revise, as I told last class in itself, you can able to revise very fast. You can able to revise very fast. In this session, we'll also discuss how to revise very fast. Shall we start, friends? Yes, I hope all of you returned equations already in your notebook. See, if you go through the mutual fund area, we can able to classify mainly into three categories. Mainly into three categories. The first category is what? Return. The first category is what? Return. In return area, what role the concept we were discussed, my dear friends? We were discussed a first holding period return. Holding period return. How to compute the holding period return? There are mainly three types of return for a mutual fund. So we have dividend plus capital gain plus. Then mutual fund, we don't have no market price. We'll have what? NAV, net asset value. So NAV 1 minus NAV 0 divided by NAV 0 into 100. NAV 0 into 100. NAV 0 into 100. See, next is all 2 mark adjustment. This is not a essay model question. These are all 2 mark adjustment. Next, they will come for monthly or annual return. Monthly or annual return. Monthly or annual return. See, I don't want to recall all the formula on the board directly. Because as all of you are aware about how to compute the monthly or annual return. Let me tell you very simple way. If your holding period is for an annum, then your holding period return will be what? Annual return. If your holding period is a month, your monthly return is what? Holding period return. That is the first point. Second point, if your holding period is for 24 months, if your holding period is for what? 24 months. How to get annual return? 24 is for, your holding period return is for 24. What will be for 12? Otherwise, holding period is written for 2 years. What will be for 1 year? Your holding period return is for 6 months. How to convert into annum? What is your holding period return? Divided by 6 into 12. Already you have written the formula. Understood? These are all 2 mark question. Getting computation of monthly return, annual return, all these points comes under this. Clear or not? So this is the first area we were discussed. While we discussing this area, another one more 2 mark we were discussed. So we are revising 2 mark also how to approach. You might have been able to recall what is the desired return a mutual fund to earn to patch up with the return of a share or an investment in bank. Correct or not? So desired return of a mutual fund is equal to what is the return of if you are comparing with equity, it can be bank deposit anything. So what is the return of equity? What is the return of equity divided by very good. Divide 1 minus initial investment plus recurring. This can come reverse way also. We discussed 2 mark question on reverse way. What is the reverse way? They will be given the desired return. They will be given return on equity also. They may asking recurring expense or they may asking initial expense. Clear or not? So these are all the way we can able to approach what 2 mark question. So these all are what 2 mark question. These all about are what 2 mark question. 2 mark. Though in the regular class we discussed a different order. If I want to take 2 mark again, another area will come. Money weighted rate of return and time weighted rate of return. Sometimes it may come for a because right now our syllabus there is no 4 mark and all, 7 mark and 2 mark. This is the only area. So money weighted time is not a 7 mark area, but it can also. What is in by money weighted? What is in by time weighted? Can you able to recall, my dear friends? Time weighted return, if you go through that simplified note you have already prepared during our regular class, as the name itself indicates, it doesn't consider any interviewing inflow and cash flow. If you invested 1 rupee, what is the position of 1 rupee after 1 year or 2 years? It doesn't consider interviewing inflow and cash flow. Whereas money weighted rate of return will consider interviewing inflow and outflow. That is the point. It is money weighted return, but regularly how you compute, we consider the dividend, everything. That is what is called money weighted. We discussed that. So we'll do problem also. Year 0, if you invested an amount of what 100, year 6 months 50% growth. So 50% growth, it will become what? 150. At that time, if mutual fund is given a dividend of 20, in time weighted return, we won't consider it. We just take. Then 12-month period, it doubled. So 300. time weighted return will be what? Your 300 minus 100, your 300 minus 100 divided by 100 into 100 will be 200%. The same thing, if you are finding the money weighted return, what will happen now? There is a slight change will be there. Here 0, you have what? NAV of 100. 6 months, it reaches to 150. At that time, there is a dividend outflow of what? 20. So the amount has to be reduced. It will become what? 130. Now, if it is double day, it will become only what? 260. How you will find out the return? Here you have two type of return. NAV 1 minus NAV 0 also there. Apart from that, you have a dividend also. So what will come? 260 minus 100. Then you have one more item plus you have a dividend outflow of what? 20 divided by your initial investment of what? 100 into 100. Here 160 plus 280. So it will be 190 percentage. Whatever it is. So this is what the difference between time weighted return and money weighted return. So these are all 2 mark concepts. These are all two mark area generally. So holding period return, how to compute monthly return, annual return, the relationship, desired return, money weighted return, time weighted return. These are all comes under 2 mark. So I am giving mutual fund. There is a very good weightage for 2 mark also. How to approach 2 mark, because more 2 mark mutual fund only one 7 mark question. Generally, one 7 mark. If you are too lucky, then you will get two 7 mark questions. That is what the specialty of mutual fund. Generally, will be 1 2 mark only will come. So now this is the first area, computation of return. Now 2 mark area is not over, but another topic which I am going to discuss, which can come either as a 2 mark question or it can be a essay model question. Another one which I am discussing is which can be considered as a either is a 2 mark question or it can come as a what? Essay model question. That is 7 mark question. What is that? Performance of mutual fund. Performance of mutual fund. See, in return, risk is not considered. In mutual fund return, you are not considering what? Risk. So how to consider the risk? Here it is come. Risk return both is considered under what? Performance. This can be considered as a 2 mark question. Probably only 2 mark it comes. Or else, sir, you are telling money weighted 2 mark, monthly return 2 mark. See, everything will not come. Any one or two only will come for it because these are all keep on changing. We'll show you the questions also. Today my net is very perfect. So we can able to go for what? Performance of mutual fund. Performance of mutual fund. So we'll consider both what? Inflow and that is risk and return. There are different methods are there. The main method is we start with what? Sharp ratio. Sir, how this as comes as a 7 mark question? In one question, they'll ask all the three or all the two. That is how it will come as a 7 mark question. Or in the class, we discuss reverse calculation. There are some reverse calculation we will discuss in this revision session also. Those type of question also will. So what is the Sharpe ratio formula? My dear friends, wherever you put RP means return of portfolio. What is portfolio? Mutual fund is a portfolio only. It's a collection of security. Mutual fund is a collection of security only. So we follow the return of a mutual fund as what? RP. So what is the Sharpe ratio, my dear friends? RP minus RR divided by. Now, my dear friends, what is this RP? RP may be given in the question, or you have to find out. It is nothing but return of a mutual fund, dividend plus capital gain plus NAV 1 minus NAV 0, whole divided by NAV 0 into 100. Are you clear? Now RF is risk-free return may be given, or we have to find out as we discussed in portfolio management what is the interest by trading value accordingly. Standard deviation of portfolio, it may be given. If it is not given, what you have to do now, they may be given which are all the security they invested, three security. So you know how to compute return of a portfolio of three security. Root of weight of A into Chinese of A whole square plus weight of B into Chinese of B whole square into weight of C into Chinese of C whole square plus 2 into weight of A into weight of B into Chinese of A into Chinese of B into correlation of A. The same thing, 2 more. This has to come. These are all extreme level if they want to test you. Because you want when you are revising everything, you have to revise it. So you have to in this revision of first overview of 20 minutes, you should be able to understand what all the area we have to learn. Then we just want to practice. Even if you are not practicing later, also no problem. This area you should be very clear. Then you can able to time manage better. effective preparation will be able to. Next one it is called, when we discuss Sharpe ratio, here we consider the total risk. Now we are having what? Systematic risk perspective, we have what? A trainer's ratio. So this 1 mark, 2 mark also it comes. Why 2 mark? Only one question. If it is a SNR, 4 5 companies are there. If 4 5 companies are there, you have to rank which is best. You have to rank which is best. If market is there, you can consider market also. So now we have what? Trainers ratio. How you find out trainers ratio, my dear friend? Same point. The only difference is what? Here you consider the total risk. Here you consider the elevation systematic risk. You have only what? Beta. So beta of portfolio. Same thing, RP same, R same. Beta portfolio may be given, or else they are given 3 4 security. Security, they might have been given the stock of beta of security. Weight will also given. Weight into beta of security. You get beta of portfolio. This is what is called what? Trainers ratio. Next one, it is we called as what? We have what? Jensen alpha. Jensen alpha. This we were discussed in our capital budget, our portfolio chapter also. Here, actual return minus CAPM return. Actual return minus CAPM return. So CAPM return, very, very interestingly, very, very important. CAPM return is a standard 7 mark question, not a 2 mark, 7 mark question. For CAPM, beta will not be here. So how to find out beta? Beta, you have learned the formula in your portfolio management. Two formula mostly will come. One is standard deviation of stock will be given, standard deviation of market will be given. You have to multiply the correlation. You have a lot of questions. Or else covariance of stock the market will be given, variance of market also will be given. You have to apply it. Are you understand? So this is how you have to approach the each scenario. This is how you have to approach the each scenario. So that is what I just want to tell you. Are you clear? So this is in our discussing each formula. I'm discussing how and all they will test for you. So we have our Sharpe ratio, Trainers ratio, Jensen alpha. Then we have our fourth one. What is the fourth one, my dear friends? Yes, PharmaNet. In PharmaNet, selectivity. Generally, PharmaNet is nothing but PharmaNet in the sense it is that is net PharmaNet. PharmaNet. Sometimes net gain, whatever they ask. Pharma net or net gain is nothing but same thing. Actual return minus CML return. Actual return minus CML return. Here, actual return means return of a portfolio, return of a mutual fund. That is dividend plus capital gain plus NAV1 minus NAV0 whole divided by NAV0. Here also the same thing. Actual return, don't get confused. What is RP? RP, the same RP only. Actual return, I just mentioned it for. Here it is. If you want, you can just also given as what? RP. Here also you can just given as what? RP. So if you don't want to get confused also, whatever you wish. Now sometimes there is a one previous year question in old syllabus. If they ask a total gain, if they ask total gain. In PharmaNet, if they ask total gain, then there will be small point. This is what our Jensen alpha only. This is our Jensen alpha only. That is, if they ask specifically total gain, 2 mark or essay model PharmaNet, if they ask just PharmaNet, then you have to apply only the this formula. This is what PharmaNet formula. Actually, these three only discussed in your current study material. This is we discussed from old syllabus. Apart from this, we discussed one more method. The last method, which is called Morningstar Index. It's very, very rare chance to come. It's not at all new syllabus, but it is called a Morningstar Index. What is Morningstar Index? Average return minus average risk of loss. Average return minus average risk of loss. So this is the 5 area. You have to compute the performance of a mutual fund. So my dear friends, this also we discussed one question. So my dear friends, what I have to tell you that this area, what all we discussed, the return and performance, all are generally practical perspective. Because my intention of this revision is want to reduce your study burden. That is also one of the arguments. So how you have to concentrate when you go for mutual fund in our class workbook, or maybe ICMA material, you will find a lot of questions, 50, 60 questions will be there. How to focus the question will be there. Correct? Because 7 mark, how to crack. If you want to crack on 7 mark, then the main area is coming. Here comes the point. That is NAV computation. NAV computation. This is the main essay model area. NAV computation. This is what our main essay model area. NAV computation. What is what? NAV computation, my dear friends. You have to compute the NAV. Here we have lot of NAV computation and other essay model question. NAV computation and other essay question. This is what main interesting area. So what is NAV, my dear friends? We will discuss that in a mutual fund. What is their total net assets divided by how many units they have? Total outstanding unit. That is what is called a NAV. So NAV is equal to total net assets divided by total outstanding unit. Then the question will come, what is in the total net assets? Then the question will come, what is in the total net assets? Total assets is nothing but what all the investment they have. That is what is called market value of investment. Then any receivable they have, then accrued. Sometimes they use the word called accrued. Then they have what are all the payable, or otherwise we call outstanding. This you have to adjust. This is what is called a. Then other assets. I will use better one more word called a other assets. Other assets in the sense cash in hand, whatever it is, you have to reduce minus payables outstanding. They have some outstanding payment. If it is there, what is all comes to receivable? They get dividend, they will get interest. All comes under what? Receivable. This is how you have to find out what. Sir, what is in by outstanding unit? Outstanding unit, when you are finding your NAV, that day how many units you have? When you are finding your NAV, that day how many units you have? That is what is called what? Outstanding. Are you clear? So this is how you have to find out the NAV. Sir, how this can come as a essay model question? We will discuss today also. They allow different investment. We have to compute all the market value of investment. Cash we have to compute. Receivable we have to compute. So based upon that, this will become a essay model. Clear? This is how we have to compute the NAV. Is this only the NAV computation? No. We have reverse calculation will come. We will do that. That all very important question. I will tell you some question. You can put it as very highlighted mark. That is very important for exam. Then another one point is in essay, other essay model. In other essay model, what comes now? In other essay model, NAV model is essay model. It is essay in the sense 7 mark. Now right now we have only 7 mark. So another essay model 7 mark question is what? Computation of return of dividend reinvestment plan, growth plan, and also bonus plan. We discussed few essay on this. These are regularly coming on questions. We will give Saurav, Sachin, we did some questions. 2-3 questions we did. That kind of question only called dividend reinvestment plan, growth plan, and bonus plan. This is one type of essay model. Sir, what is meant by dividend reinvestment plan, my dear friends? Dividend reinvestment plan is whatever the dividend capital gain you are going to get it. You are going to reinvestment. You are going to what? Reinvestment. So if you go reinvestment, what is the benefit, my dear friends? You will get the additional units. You will get the additional. So there is a one formula for that. What is called units eligible? Units eligible. What is the formula for units eligible? What is the amount of dividend, or if it is capital gain, that is reinvestment amount. What is the sometimes dividend and capital gain you will reinvest. Some friends are very keen on mug up formula. So if they mug up formula only dividend is required, capital gain they won't consider. Actually, whatever the amount you are available for reinvestment, you will take for numerator divided by NAV on the date of dividend. Sir, if it is a capital gain, that is on the date of dividend in the sense that is reinvestment date. Simple formula is what? You might have been written a simple formula called the amount of dividend divided by date of NAV on the date of dividend. That is what simple formula. But sometimes what happened now, you may have capital gain, you may have other reinvestment or so. So in such a case, I am giving a bigger formula that the amount of dividend plus capital gain, that is reinvestment amount, divided by NAV on the date of dividend. That is what is called reinvestment date. Are you clear? So this is the very important essay model question which comes. Next question comes in essay what? Reverse calculation of NAV. Reverse calculation of NAV. What is reverse calculation of NAV? We'll do that question also in the practice. In the class, we need some reverse calculation. Let me show you. See, this is what similar few more problem are there. Question number 18. They have given some data. They have given some data. They are asking what is the NAV on 31.3, 31.3, all these date. They will give 50,000 invested, dividend paid, analyzed. Question is look like 4 line, but this is a multiple time essay question came for CA final, CMA final. CA final will come lot number of times. So this is example. I have just written question number 18. So these are all the major essay model or area you have to learn from the chapter called a mutual fund. My dear friends, in the last session I told mutual fund revision of all the concept will take just half an hour only. But actually it not even taken half an hour also. That is what special. It is taken now close to 25 minutes. Not even 25 minutes, only 22 minutes. I take my recording effect now 22 minutes. That is not even half an hour. Entire area is over. If you go through this entire mutual fund concept, your all the formula will be covered. It is not very easy area only. So 2 mark there are areas, same model areas are also there. This area performance of mutual fund it may comes either as a 2 mark or it may come as a what essay model. So I will just give you 5-10 minutes for you to review very fast. Then we will start selected essay model question will show. I think not selected. We can able to do good number of question also. So come on friends. Before you gone through, we have small 2 mark area also there. Apart from this, we have a small 2 mark. If I discuss that, it will reach our exactly half an hour. So, what is that concept, my dear friends? One small area called expense ratio. This comes as a 2 mark question, or this comes as a separate part of a essay question. It comes as a 2 mark question or a separate part of what essay question. What is that point, my dear friends? Expense ratio. Expense ratio we can find out 2 ways: total approach or unit approach. If you do total approach now, what is your total expenses divided by average value of portfolio into 100? What is average value of portfolio? Your NAV, that is your net asset in the beginning, net asset at the end divided by 2. This you can do under per unit approach. Expense per unit divided by average NAV into 100. Both are same. Both are same. Another one more area. This also can be come as a 2 mark question, or it can come as a part of essay model question. That is what is called a portfolio turnover. Portfolio turnover. Can you tell me what is a portfolio turnover? What is a portfolio turnover? Lower of sale or purchase. You have some sale, you have some purchase. So lower of sale or purchase divided by average value of net assets. Net asset only. That is what your net assets. That is what is your net asset into, no, not into net assets. To convert into percentage, it will come what in times now, not into 100. If you want to convert into 100 now percentage, you can able to multiply it to what 100. What is the lower of sale of purchase? You might have been done during the year some sale, some purchase. You have to identify what is the sale amount, what is the purchase amount, what is the lower amount. That only you have to take it. That only you have to take it. This is also one of the area comes under what mutual fund. This also this all comes as a 2 mark part. 2 mark mostly these are all not favorite 2 mark question. It all comes as a part of essay sometimes. That is how generally comes for exams. Now, my dear friends, how we are going to revise today is we are revising from the backward. What is backward? Essay model question we are facing. That is more important. 2 mark and all, if you're taking that value addition, that is separate strategy we have. We are going to go with essay model question. First, we are going to discuss. This is a very good essay model question. Reverse calculation. 20. Reverse calculation, a very good question. It's a previous year question also. Question number 20. Mr. Z has invested 3 mutual funds as per the following details. What is the amount of investment? 2 lakh. Net asset value at the time of purchase is what? 10.3. Dividend received up to 31.3 is what? 6. NAV as on 31.3 is what? 10.25. See how to compute return. That is what direct question. That is already in this model we have discussed in the class. I am doing reverse model, which is good for exam. Effective yield is given in the question itself, which is what? 9.66. They said that 1 year is what? 365 days. Mr. Z has misplaced the document of his investment. Help him finding the date of his original investment after ascertaining the following. What would we have to ascertain? Number of units in the scheme, total net present value, total yield, number of days investment held. Shall we start, friends? So we can do for X. If you do for X, same pattern only we have to do for what? Y and Z. So since the revision session, we'll do for only one. See how can you able to get number of units in each scheme? So it's a reverse calculation. Some of them are direct. The amount of investment is given. What is the NAV at the time of purchase also given. So what's the number of units? How can you get it? Number of units. Your investment amount is what? 2 lakh. At the time, the investment amount is what? 10.3. So tell my dear friends, 2 lakh divided by 10.3. What you will get it? 19,000 or 4. See, in units, it will come in decimal also. Units, it will come in decimal also. Shares will not come in decimal, but units is a technical number, so that will come in decimal also. Next to what they are asking, total net present value. See, dividend, this is not a dividend reinvestment plan. So your total net present value is nothing but total NAV is equal to, they are asking, total net present value is nothing but, you know, your unit 19,417.4 into how many, what is the NAV on the closing date? 10.25. This is how you have to find out the total NAV. What is the answer, friends? What you will get it? 1,99,000 0 2 point. This is your total NAV. Yes or no? Now, next day, total yield. Very interesting. Total yield. Can you recall the formula for return? Dividend plus capital gain plus NAV 1 minus NAV 0. So that is only we are doing dividend. They are given in the question 6,000 plus NAV 1, no capital gain. NAV 1 minus NAV 0. NAV 1 is 1,99,028 minus NAV 0 is 2 lakh. What is the total yield difference? Sorry, 5,028. A small round off is there. 5,028. Yes or no? Yes. Next, we want to find out number of investment held. This is what reverse calculation mainly. What is number of investment held? You have effective yield. Yield is what? Effective yield per annum. That is annual yield, which is 9.66. So what you have to do now? First, you have to find out what is your holding period return. I will do slowly step. We can do one step itself. some friends who have very longer gap learning mutual fund, for them it will be little difficult. So I will go step. I'll go holding period return. We know what's the formula for holding period. Holding period return is nothing but your yield, which is 5028 divided by your NAV1. Correct? NAV1 is 2 lakh into 100. This is what holding period return. What is that? 2.51 percentage. This is what your holding period return. This is what your holding period return. Now, what is happened? Now, holding period is not given. They given only what? Annual return. What is the annual return, friends? What is the annual return? The annual return is nothing but what is your holding period? We revised today also holding period in months. Or here generally we give months, but here they said what days already. So holding period into 365 days. This is the formula for what? Annual return. You know your annual return. What is your annual return? 9.66. Holding period return is 2.51. Holding period you don't know X into 365. If you multiply this, apply this formula, you will get your X what? 95 days. So your holding period is what? 95 days. Hope all of you are clear. Now answer is not over. They were asking what is the original date of investment. Now what you have to do? Your original. This is a very standard essay question because I told you we are going reverse calculation. Last to last exam question only. So original investment date they are asking. What is the original investment date? Today 31/3/2018. You have to take reverse calculation. From 31/3/2018, you have to reduce 95 days. What will be the date? 31 days in March. Then we have February, we have 28 days. It's not a leap year, so 28 days. Then you have January, you have what? 31 days. Total is what? 90. Correct? So you have 5 more days. So it will be 26th, 2070. Correct? 26th or 25th? 26, 27, 28, 29, 30, 31. It will be 27. It will be 27. 27/12/2017. In the regular class recorded video backup, we have in 10 up to the final level. Some of the things we are given as a homework because we did similar question already. So now in the revision session, I am discussing to the original investment date also. We have discussed how we come reverse way. That is 31st March is the current date. If 95 days is the investment period, you have to go reverse way. You have to go what? Reverse way. This is how you have to get 27, 28, 29, 30, 31. You have 5 days. So then plus 90 days, you have 95 days. This is how you have to get it. Hope you are clear. Yes or not? So very standard question, a very previous year question. Same way we have to do what? Remaining part also. Shall I proceed next question, friends? All of you ready? Shall I proceed? Next essay model will proceed? Yes. So you can also parallelly work out. It's always good only. This is not a essay model question, but it can even test. It's a previous year question only. Came for 4 mark for 12 syllabus. What is this 24th question? Because we can able to recall 2 mark concept also. Because as the strategy is what you want to recall all the formula. So what is this? Orange purchased 200 units of oxygen at a price of what? 45. In 2010, they received 1 rupee as a dividend. Capital gain 2. Calculate return for the year. December is what? 40. This is basic. But here comes dividend reinvestment for learning the B part. Because of the B part, it comes as a slightly 4 mark question. Even it can be tested as a 7 mark also if they want to make your exam easier. Okay. So first one is normal return. So what is the return, my dear friends? Holding period return. Return. Here normal return only. Dividend. Your dividend is what? 1 rupee. Dividend is 1 rupee. What is your capital gain? So this is question number 24. Previously, what is this question number, friends? 20. 24. So what is the return? Your dividend is 1 rupee, capital gain is 2 rupees. So 1 plus 2 plus what is the NAV 148? What is the NAV 0? Divided by 45 into 100. What you will get, friends? 13.33. This is what concept of our first formula we discussed. The main intention we discussed for B part. Calculate the return for the 1 year, assuming NAV on 31st is 48 only, but dividend and capital gain has been reinvested at what? 46. My dear friends, very, very important point. If it is a reinvestment, if you are calculating the NAV, you can't do per unit. You have to do total approach only. Why you can't do per unit? Per unit, if you do, beginning unit and ending unit must be same. When it's a dividend reinvestment scheme, original time in units and end of the year units will be different because of the dividend reinvestment. So you can't do per unit approach. You have to do what? Total approach. What is total approach, friends? That is what we are doing. NAV 0. NAV 0. We have beginning. They said 200 unit at 45. This is what total approach. So 200 into 45. See, you have received a dividend and capital gain. 3 rupee into 200, you have got 600 rupees. This you have units eligible. Today we have discussed what is the formula for what? Units eligible, which is 600 divided by what? What is the dividend at the rate of investment? 46. You will get an units of what? As I told you, we will get decimal. We have to take decimal as it is. Now, what is the outstanding unit? Outstanding unit. Already we have 200 unit. Now we got 13.04. So total unit is what? 213.04. 213.04. Are you clear, friends? Yes. What is next, my dear friends? Now you have to go for NAV1, which is 213.04. Now on the date of valuation, what is the rate? 48. So you have to go for 213.04 into 48. This is the value. Now, if you want to find out return, see if a dividend reinvestment plan, the formula for return is NAV1 minus NAV0. That's all. Because no dividend, no capital gain, because all are reinvested. So your formula will be 10,226 minus 9,000 divided by 9,000 into 100. What you will get, friends? 13.62%. For this purpose only, we revised this question. So we were learned how to compute return concept and also how this reinvestment structure also. Are you clear, friends? Thank you. Now we will proceed next. This is how we have to approach. This is also a previous year question, came for 12 syllabus. See, we did the question number 20, correct? We did question number 20. This question number 20, direct model only, this 26. These are direct model. What is direct model? They given all the data. They were asking what is the return per annum. These are all direct formula. So generally exam very rarely comes direct. They will come what? Indirect. They will come what? Indirect. So I'm just telling you that it's a direct model question. Here comes the essay model. This is what I told you, main model essay model question. I hope all of you are ready. It's a very, very interesting question. See, generally, let me tell you one fair factors. It's a 14 mark essay question generally come for old syllabus CMA, CA final and all. Right now, what happened? Our institute is bringing down to 7 mark format for mutual fund chapter. Since it's a 7 mark, this kind of question, this question is 14 mark previous year. So this is having 3 plans: dividend reinvestment plan, growth plan, and also bonus plan. So if for your exam, any 2 only will come if it is a 7 mark question. If it is a 7 mark question, any 2 only will come. Or else, maybe if they want to introduce this, they will ask you this is for 14 mark. This is how the pattern. Shall we start, friends? So this question is for question number 28. So here, first point you have to understand is what? What is the unit at the beginning? This is students always will make mistake. See here, there is nothing tells about value on the investment date. NAV on the investment date not given. If NAV on the investment is not given, then only you can take the net asset value of what? 10. If value on the investment date is given, then you have to take that only. So the first step we have to go for this. We have question number 28. The first step we have to go for this called a units in the beginning. Units in the beginning or outstanding units, whatever it is. Here investing is 1 lakh. See, when you are investing on the date, what is the NAV only we have to take. In this question, it is not given. That is why we taken what 10 rupee because face value. But this will not should not take always. I will show you another one question also. So this is what units in the beginning is what 10,000. They said that this S plan is a dividend reinvestment plan. Now only we told dividend reinvestment plan. Whatever the amount dividend we will reinvest. Now only we are. Then another one plan is called bonus plan. Another one plan is what growth plan. So how we will do it? Because of this important, we will do this very fast. So what will happen now? These are all the date. So you have to take the date. So come on, friends, which are all the date we are getting dividend. Only dividend date only we have to look into 28/7 2010. Next 31/3 2011 2014 15/3 2015 4/3 2016. Now you have to take what is the dividend in percentage, which is given in the question 20%. See, actually, these are all we are giving just for the format purpose. Actually, we know just now in the previous question what is the dividend amount divided by NAV only we required. If you do table method, time we can save a lot more. 40% next is 25%, then last 40%. Correct? First step, you should identify what is the dividend. For that, I have just making one column. What is the units available with you? Units in the beginning or outstanding unit, whatever the name you can make. 10,000 units. So what is the dividend amount? You have 10,000 units. Face value only dividend will declare. Dividend will declare on what? Face value. So face value is given as 10 rupee into what is the dividend percentage? That's for me, just Excel, I can just scroll down. Now, what will be the NAV on the date? Here, the NAV particular date only you have to take. Can anyone tell me what's the date in each day? 30.7, 58.42, 42.18, 46.45, 48.10. This is what NAV. So what will be the units eligible? We discussed a concept called a units eligible. What is the formula for units eligible? What is the dividend amount divided by what is the NAV? This is what is called as what? Units eligible. Now you go to unit. What is the outstanding unit? Outstanding unit is called closing unit. You can give any number. Beginning we have 10,000. Newly we got what? 650. That's all. Now it's scroll down. What is your closing unit here? That will become what? Opening unit. So I can just scroll down. Dividend and all, I can just scroll down. Units eligible also, I can just scroll down. Outstanding units also, I can just scroll down. So we'll get a closing unit of what? 14,906. I know in your notebook, you have already the answer. So this is what is called your closing units. Now question is asking what? Question is asking you want to identify the annual rate of return. You want to identify what? Annual return on when 31st July. Some condition is there. Long-term tax is exempted, but short-term is what? We know shares and mutual fund of short term is 12 months. So 12 months any buying and selling that will attract short term capital gain tax 10%. Then security transaction tax also 2%. Now only we discussed a question on dividend reinvestment return formula. We learned that dividend reinvestment return formula is what? NAV 1 minus NAV 0 divided by NAV 0 into 100. That's all. So how can you do, friends? Very simple. Your NAV 1 you have to find out. Your NAV 1 is nothing but if I gone through this 2 decimal, NAV 1 will be 14,906.15 into what is, my dear friends, that NAV on the closing date? They said 31st July. We have to take 31st July NAV, which is 53.75. So you will get NAV, that is 14,906.15 into 53.75. Actually, this is the NAV one, but here you won't get everything in your pocket. There are some outflow that you have to reduce. What role you have to reduce? Short-term security transaction tax. What is security transaction tax? 0.2 percentage. 0.2 percentage on the value of sales. So this is the value of sales. I have to put 0.2 percentage. Then I have to reduce short-term capital gain, if any. Short-term capital gain, is there anything? Is there? Yes. What is short-term capital gain? We are selling it on 31st July. The last purchase you made on what? 4/3. Here it is 15th 2015. There is no. But this 4/3 is within 1 year. Whatever within 1 year purchase, that will come under what? Short term. That will come under what? Short term. Yes or no? So this you have to consider for what? This you have to consider for short-term capital gain. So how can you do this very well? See, you are purchasing how many units? 1144.44 units only you brought it. What is the price you brought it? You brought it for 48.1 if I am not wrong. Now what price you are selling? 53.75. So this difference only your capital gain. This you have to pay a tax of what? 10 percentage. The given question itself is given what is the percentage. So what is the amount? This is the unit you have brought it into the selling price is what? 53.75. Purchase price is 48.1. This is your capital gain. You want to pay a tax of what? 10%. Your net NAV in your pocket, you will get only what? After this outflow only this. What is your investment amount? Your NAV is 0. Sir, why you do total approach? Just now only in the previous question I have told you, dividend reinvestment plan, everything you have to go only total approach. So you can go for, it's one line itself we can do. I am doing the shortcut notebook, or in the regular class we did step by step. But here I will do what? Shortcut. I'll go directly what? Holding period return. What is holding period return? Same thing. NAV1 minus NAV0 divided by NAV0 into 100. This is what holding period return. But actually the question is asking not holding period return. They are asking what? Annual return. So how can you get the annual return, friends? Annual return is nothing but you getting 698.96 is for how many months? Your starting of your investment, if you gone through, it's first for 2006. Now it is when first 31st July 2016. 10 years plus 4. So 10 years means 12, 120 months plus 4. It will come 124 months. What will be for 12 months? So this is for 124. What will be for 12 months? You will get a percentage of what? 67.64. We'll get a percentage of what? 67.64. Are you clear, friends? So this is how you will get an annual return. This is which plan? Dividend. This will be little lengthy. All other plan will be very, very easy. Next is what? Bonus plan. Bonus plan also, nothing tells about the NAV. So same thing, 1 lakh divided by 10. You will get what? 10,000 units. You will get what? 10,000 units. I hope all of you clear on this. Yes or no? You will get what? 10,000 units. So how you have to proceed for this 10,000 units, friends? How can you proceed? Same thing. Here it is a bonus plan. Bonus plan also first we have to give what is the date. What all the date applicable now for bonus we have to check it. Not all the dates. Only 3 dates only we have bonus. So we have to take the notes. Can anyone help me the dates, friends? 2011. Yes. 4/3/2000. You can take what is the bonus ratio. What is the bonus ratio? Or we can make units in the beginning if you want. You can make one column. That is your wish. What is the bonus ratio? 1:4, 5:4, 1:3, 1:4. See, lot of friends may be confusing this. What is this meaning? 5 means 5 bonus shares for every 4. 4 means 1 bonus share for every 3. 1 means 1 bonus share for every 4. This you should be very clear. Now, what will be the bonus units? Your bonus units will be 10,000. For every 4, you are giving what? 5. So, what will be the closing units? 10,000 is the opening. Now 12,500. What is your closing? That will become what? Opening. Here what? 22,500 is for 3. You're giving what? 1. So you're getting what? The same point. Are you clear? Again comes here the same point. What is your closing? That will become what? Opening. Here for every 4 you are giving 1. This is how you will get the closing units. Understanding? Then after that, this return, same format. The return, you have to do what? The same format. Since I am using Excel, for me it is very, very easy. Here NAV, this units is changing because we are getting the unit of what? 37,500. Here, it's plan T, you have to take the plan T value, which is 22.98. How interesting, friends. 22.98. So you have to multiply the same 37,500. 37,500 into 22.98. STT, we know what is the value. Accordingly, automatically will come. Short-term capital gain, there is a small point here. So first you have to check, is there any short-term capital gain? Yes, 4.3, which is 1 year only. So how many units we have, friends? 7,500. What is the sales value? 22.98. Your taxation class, you might have been learned that bonus where the cost of acquisition is what? 0. So you have to put 0. In that you have to pay 10 percentage. So what you will get it? 7,500 into 22.98 minus 0 will have minus 0. You pay. This is what your amount. Balance everything is over. This is your holding return. Investment is 1 lakh. Holding period is 74.22. Annual return is what? This amount. Are you clear, friends? This is how we have to approach what? Annual return. Are you clear? So it's a 14 mark essay. That is only we are solving in 10 minutes with the help of what? Excel sheet. But in the exam, it is very difficult for you to complete in 10 minutes. So you have to manage some area, especially forex, derivative, and other area note, lesser time only you will take. So you have to capitalize your concept on that. Recently taken those area, you have to capitalize. So you can save time there and you can able to manage. All of you clear, friends? Now we'll go for the last part. This is the last part, friends. What is the last part? Growth plan. What is the last part? Growth plan. All of you clear, friends? Shall I proceed? Yes or no? So if you go for growth plan, how it will be the growth plan? No bonus, no dividend. It will go directly this stage. It will go directly this stage. There is no bonus, no growth. That is what is the name it's called a growth plan. So NAV1 will be, units will be what is the beginning, the same will come. Into what will come? Unit. This is the value is getting increased. See, the growth plan because no outflow, NAV will keep on increasing. The amount will be 82.07. 82.07. So 10,000 into 82.07. STT the same. There is no short-term capital gain. Why? Because there is no purchase in between. For me, since I'm using Excel, 1 lakh is same, return is same, annual return is same. Higher the return, better option. Here 716 and here 71, here 67. Higher is what? In this example, boss. That's all. The essay problem is over. The essay question is what? Over. So this is how you have to make it. Are you clear, friends? So this is how you have to approach the essay. Now, if you go through your material, let me show you. We have some another one similar essay question. I think I have brought in the last 50 page number or not 8. See here 57, similar one question only. The 7 mark also you can take it. Only 2 plan, bonus plan and we have dividend plan. See here, if you go 57, I'm not solving again. I'm not solving, but I'm doing 1 point units eligible. Here, when we are conducting class test and all, lot of students, what is the amount you are investing? The amount you are investing is 2 lakh. They are mentioned. Students, what they do now, they divide with a 2 lakh. Here they said in the question that face value of the unit is what? 10. Students will do 2 lakh by 10, 20,000. This is wrong because date of investment NAV. See, they said that plan D and plan B, the NAV is what? 38.2 and 38.6. When you are investing, the NAV is not 10 rupee. In the previous question, it was not given, so we assume it is 10 rupee. But here the amount is mentioned. Generally, it will be given for exam. So here 38.2. So what you have to do? Here you should not take 10. You have to take what? 38.2. So your units in the beginning should be 2 lakh divided by 38.2. This will be 5236. So this is very, very important. That is a formula itself. I have given what is the NAV on the date of investment? NAV on the date of investment. Are you clear? So this is how the questions on what? This return essay model. Now we'll go for NAV calculation. Now we'll go for what? NAV calculation question. Hope all of you are ready. We'll go for what? NAV calculation question. Hope all of you are ready. My dear friends, now we will do next level discussion on mutual fund. It is we are going to discuss NAV computation. We'll go for what? NAV computation. We'll start from a middle level model question to very, very advanced question. We'll go from middle level question to very, very advanced question. We'll start with very, very middle level question, then we'll go for advanced question. This is a very, very basic question. A fund has issued a 20 lakh units of what? 10 each. No entry load was charged. Following details are given. This is the amount during the year. Operating expense is 10 lakh. In addition to interest, dividend also received. You are required to calculate net cash balance and NAV per unit at the end of the year. See, they are given our formula for net asset is market value of investment. Actually, this is the value of the investment on the date of investment. But what is the closing value? They are not at all given. If the closing value is not given, we have to assume that this is what market value at the end because it's a base level question. This is a base level question. So how you will go for? We have our formula, my dear friends. First they are asking, we know NAV, you have to find out what net assets. In net assets is nothing but what is net assets? Can you just recall, my dear friends? What is your market value of investment plus your receivable, whatever it is. So in this case, you can say everything under cash. What is your cash? Or you can go our normal formula called a, which we discussed a receivable plus other assets minus outstanding or pay. I'll do in a shortcut method because they ask first to what is the cash balance? What is the cash balance? So this is first we are doing cash balance. First step we want to do opening balance. How to do opening balance? You collected 20 lakh into 100. Can you please 10 rupee? Can you please tell me 20 lakh into 10 rupee? Total you collected will be what? 200 lakh. Total you collected will be what? 200 lakh. But you made an investment of only what? 196 lakh. Take the sum total of all the amount. You have made only what? 196 lakh. That means you have an opening balance of what? You have an opening balance of what? 4 lakh. This you have to first make it. Your opening balance of cash is what? 4 lakh. Now they said that operating expense is 10 lakh. In addition, interest and dividend of 24 lakh. So interest you have to find out 60 lakh 7%. They won't tell what is the amount of interest. We want to compute how, what is the instrument, what is the rate of interest, what is the face value. So how you will get it? So I am doing add interest. This is your inflow. I am doing in a shortcut method here. What is the first one? 16 lakh. In that you are getting what? 7%. Is there any other instrument? Yes. Debentures of 10 lakh, you are getting 9%. So 10 lakh, you are getting 9%. Another one more, it is there. That is also 10 lakh. What is the amount you are getting? 10%. So these are all the dividend, your interest you are getting. Add a dividend. Dividend also they given. If they are not given, we have to find out What is the dividend they have given? 24 lakh. This is the total cash. This is the total cash. In that, there is a one small payment is there. Total cash inflow. Now, what is the outflow, friends? There is a payment of what? 10 lakh. So, what happens, my dear friends? The amount is nothing but 21 lakh 02. This is what amount. Now you can go for your net assets. See, generally net assets on the closing date you have to take the market value. They are not given, so we'll assume that the same value. Your receivable we taken in this formula. See, receivable we taken, other assets cash we taken, outstanding payment also we taken. See, everything is taken, so we can do straight away what? Cash 2102. So you will get an amount called a 196 lakh plus this amount. This is your total net assets. Now what you will do? Units outstanding. There is no issue at all. So your units outstanding, they said in the beginning 20 lakh. So what will be the NAV per unit? This is what your NAV per unit, which is 10.851. Hope you are able to recall. Yes or no, friend? Yes or no, friends? Now, with your permission, we'll go next level advanced. Next, we will go forward. Next level advanced. What is this next level advanced, friends? We have our question number 52, which is a recent previous year model question. What is this 52, friends? A mutual fund has made an issue of what? 8 lakh unit at 10 rupee. No entry load was charged. These are all the investment. During the year, dividend of 9 lakh 60 received. Interest on all debt was paid when they due. Up to this, similar to last question. But now the point is coming. They are telling what is the market value of investment at the end. What is given at the end of the year? Equity shares and 10% debentures were quoted 170 percentage and 90% respective par. Other investment were at par. The operating expense is what? 4 lakh. Find out the NAV. Here they are NAV only asking. But in the previous question, we discussed that if you find out cash, computation of NAV will be what? Easy. But if you refer your suggested answer, if you refer the study material, they won't done with cash. They done with a formula of what? This. But we have learned that if you find out the cash, it will become more easier. So we can go for the same way because one method you learn, you can be able to save a lot of time. One method you learn, you can save a lot of time. So what we will do first, what we will go market value of investment. That is what you have to find out here in this question. First one, equity shares. See, at the time of investment, the value is what? 64 lakh. At the time, the premium pricing at what? 160. Now the premium running at what? 175. The amount is what? 70 lakh. Some friends, what they do now, 64, they take 100 and they do 175. This is wrong. Because when you're investing itself, it is 160 premium. Right now, it is what? 175. Are you clear? How do you find out equity shares? Next one, government bond. These are all not listed. If unlisted are at par only always, that will not change. Only listed shares and listed debentures value only will be changing. Others they won't mention. You want to understand? It is unlisted. If you take a bank 10 lakh loan, after 1 year also the loan will be what? 10 lakh. It will not change. It's a not listed one. So you can go for the same thing. 8% government security. It is what? 6.4 lakh. Next, 9% debentures. What is the amount? 4 lakh. Next is changing. What is that? 10% debenture. They said it's listed 4 lakh. It is selling at what? 90%. It's at a loss. So 4 lakh into 90 percentage. It will come what? 3.6. So they said that 4.6. Are you clear? So now you can get all the market value of your investment. These all are in lakhs. You will get what? 84 lakh. Now you can go for your cash. This is a shortcut method we have learned in the previous question. How to approach the receivable and other things. Are you clear? So what is the opening cash, my dear friends? Here you are collected 80 into 180 lakh. Can you just tell me what is the total of all these amount? 64 plus 6.4 plus 4 plus 4. What is the total, friends? 78. So my dear friends, you collected 80 lakh, but you invested only what? 78 lakh. 70, 78.4 lakh. That means you have an opening of what? 1.6 lakh. You have opening of what? 1 lakh 60,000. Now you have to add. What are all the details you have to add? You have to add your dividend. What is your dividend, friends? They said that dividend, the during the year, the dividend of what? 9.6. Dividend of what? 9.6. Then you have to add what? Interest. Interest is paid on par only. It is not on market value. Very, very important. So in this value only you have to take. Though the 10% dependent value 3.6 lakh, you won't take that. You have to take on what? 4 lakh. Dividend is paid at par only. Your interest is paid on par only. Everything at a par only. So you have to take what interest is. I can do very fast. 6.4 into what is the percentage? 8 percentage. Next 4 lakh into what is the percentage? 9 percentage. Though the market value is different, you have to pay at a your book value only 10 percentage. You will get all the interest is what? 1 point. Now you have your payable. So we make it's payable also we did. What is the expense, my dear friends? Which is called 4 lakh. So what you have to do is you have to add all these items. You have to minus this. If I am not wrong, you will get 8.4 lakh. Now, if you take this total, this is your total net assets value. This is what is called total net assets. How you see, my dear friends? Now, what is the outstanding unit? Your outstanding units are already given, if I'm not wrong, 80,000. So what will be the NAV, friends? This is the value. This is the value. 11.55. Hope all of you are clear. Step by step by, we are moving into our advanced question. Hope you are clear. Yes or no, friends? So this is how we have to approach. This is how we have to approach. Clear? So first case, market value is not given here. Market value is given. Now little more advanced question, which is also one of the previous year question for old syllabus. Question itself is one page is there, which came as a 12-mark question for a previous year exam. Yes, we have question number what? 29. What is this 29? Mr. Bachchi, after completing his MBA, accredited student, joined a reputed house in Mumbai. He has given the following details. So these are all the investment, IT, ITS, everything is given. See the cash they mentioned it even throughout the fund period. Even throughout the fund period means closing cash also. That is what it's a closing cash. The closing cash is already given. How you find out closing cash, my dear friends? Closing cash you find out receivable, dividend, everything after adjustment only. So you don't want to do any much struggle on that. But other twists are there. They given listed bond, unlisted bond, expense payable. That means something you are not paid, which is called outstanding. Then market expectation, number of units. Here come the clue for what? Market value on the expiry, because our first step in net asset is what? Market value. Here they said investment time your value is what? 1750. Now the value is what? 2950. Like that they have given. First they are asking what is the net asset, what is the NAV per unit. Can we start, friends? It's very, very easy. First step, as all of you know, we have to find out what? Market value of investment. First step, we have to go for what? Market value of investment. So which is this question, my dear friends? 29. So how you will approach this question, my dear friends? Market value of investment. Market value of investment, the first step is what? You have to take each item. First one is what? IT and ITS companies. The amount is 28 crore. At the time, this amount is what? 1750. Now the price is what? 2950. Like that, you have to do each one. What is the next item, friends? Infrastructure. Can you please tell me what is the time at the time of investment? 15. Now here it is 1375 into 2475. Like that, you have to do each one. What is the next item? Aviation. What is for aviation at the time of investment? 7. At the time of investment is what? 7. Now 1540 into 25. See, the level of computing that market values keep on changing. So next is what? Automotive. What is investment time amount? What is investment time amount? 32 divided by 1660 plus 2860. Last but not the least, banking. How this banking will come, friends? Banking, what is investment? 8 by 1600 into 2300. You get the value. How interesting, my dear friends. Now, answer is not over. We have bonds are there. Bonds, first bond they tell investment in fixed bearing bonds. What is the amount? Unlisted bond is 8 crore. I will go for first unlisted, which is 8 crore. Next, listed is very, very important. See, very, very important. Listed bond, they are not given any such details here. What is the value at the beginning? What is the value at the end? Not given. And previous question they given listed bonds are selling at 90% or 100. That is also not mentioned. But we know that listed bond, the value will change. So what is the clue they are given? They are given the clue that market expectation on the yield is what? 8.4. So you have to go for yield approach to find out the value. You have to go for yield approach to find out the value. In the regular class, you might have been learned the formula for yield approach to get the value. Why we do yield approach? Clue is not given previous two methods. Clue is not given previous two methods. So how you do yield approach? The face value for listed bond is what? 1000. Or we'll take total 10 crore. In this 10 crore, if your interest is what? 10.5. What is the interest you will get? So 10 crore, if you get a 10.5, this is your interest. What is the market interest is giving? That you have to divide. This is the formula for what? Listed bond valuation under yield approach. We discussed in detail in our regular class also. You will get the value of what? 2.5. Now cash. Cash, very, very easy. We don't want to do anything. Why? Because already they given the closing cash. Sir, in the previous question we multiplied interest. Do you want to do interest here? No. The reason is what? Cash at the end of the, because it's a bigger essay question. They don't want you to take a strain on cash. So you have to understand now, I hope so. When you want to compute the cash, when you don't want to compute the cash. So now they given the cash at the end is what? 2 crores. Now you can take the total net assets. Total net assets is this. Now you have to reduce your outstanding. Here there is an outstanding. If all the expenses are paid, no outstanding will come. But some of them are not paid. Paid amount will be adjusted in the cash. Not paid is there. That is what expenses outstanding, which is 3 crore. So your net assets value will be, this is your net asset. This is your net assets, which is 168. They were asking second part, NAV per unit. This is the total value. How many units you are issued? You are issued. See, they sell very clear. Number of units is what? 5.5. So you have to divide by what? 5.5. Your NAV is nothing but 30.71, my dear friend. How interesting. Bigger essay question in 1 minute we were completed. So this is how you have to approach the market value of investment. This is how you have to approach the market value of investment. Yes or no, friends? Am I clear? Are you able to follow? Next, they are asking a new point. Here, a lot of new point. If the period under consideration is 2 years, the fund has distributed at 2 rupee per unit as a cash dividend. Ascertain the annual return. Ascertain the annual return. So you do dividend plus capital gain plus NAV 1 minus NAV 0. You go dividend. But NAV 1 also given. But NAV 1 we found out now. But NAV 0 is not given. So we have to compute the NAV 0. NAV 0 we have to compute. That is another very interesting point. They are not given the same step we will do. What is the point? Market value of investment. They are given in the question. Just listen, friends. Market value of investment they are given is what? ITT. This is what? Initial value. This is what? Initial value. So take the total. You will get the data. 28 plus 15 plus 7 plus 32 plus 8 plus. Very, very important. Cash, even throughout the fund period. They said fund period it is there. They don't say it is in the beginning. Even beginning, if you assume it will take. I told it's a sedimental question, previous question. They went with an assumption called it is not in the beginning. So you should not take it. They don't use the word called it is in the beginning. Fund period it is there. Fund period starts from day one. It is not from where day zero. So beginning it is not there. So don't take cash. But you can take listed bond 10, unlisted bond what? 8. The expenses and all will not be there in the beginning. It will come later on. You have to take only these 108. So what will be the NAV 0 per unit? It will be nothing but 108 crore divided by 5.5. You will get what? 19.64. This is your NAV. Now you can go for your formula. They're asking annual return. They said very clear that they're distributed 2 per unit as year dividend. So you are computing the holding period is what? 2 years. Again, this thing. If you want to do annual return, what is the formula? Dividend plus. So holding period, annual return only 2. During the holding period, you are given a dividend of what? 2 plus 2. Dividend is what? 4. NAV 1 is what? 30.71 minus 19.64 divided by 19.64 into 100. You will get an annual return of what? This is holding period. This is not annual return. This is holding period return. What you will get holding period return? 76.73%. They are asking annual return. How can you get the annual return, my dear friends? Yes, 76.73 is for 2 years. What will be for? This is what? Annual return. All of you clear? Going further, finally they are asking what? Expense ratio. Total expense is given as 705 lakh. We learned that expense we can do total approach and per unit approach. We'll do now only per unit because per unit both we have. We don't want to take much time on that. The regular class we discuss both the perspective. So what is the expenses per unit? Expenses per unit is 700.5 lakh divided by 5.5. Both are in core. So you will get expense per unit is this. What is the average NAV? Average NAV is nothing but 30.71 plus 19.64 divided by 2. So your expense ratio will be this 1.28 divided by 28.28 into that. So which you will get it what? 5.09%. Hope you all of you are clear. Hope all of you are clear. Yes or no, friends? So with this essay model question also over everything we have discussed in this question. Clear? So you are had an experience on what a essay model question also. Now we will do in the beginning I told the reverse calculation one question which is 4 line only, but it is a essay model question. We'll do that question. That is the last level of what one of the essay model question. What is that question, my dear friends? I think 18. This question. In the regular class, we discuss this multiple questions. Very, very easy. We have to approach this. Are you ready, friends? Question number 18. Very, very interesting. Very, very superb question. Question number what? 18. Are you clear, friends? How to approach 18, friends? If you want to go for 18, very, very easy. You have to go for your invested what? 50,000. So your NAV 0 is what? 50,000. Dividend they paid what? 10%. Annualized yield is what? 120. On 31 3, 20% dividend and capital gain is given. Unit is this. Annualized yield is what? 71.5. Yeah, see this question, you have to be very clear in all the concept, then only you will understand very easily. So you should be very clear on this. I'll do very simple presentation. They were asking first, what is the NAV as on 31 3 2017. My dear friends, so far, all the question we did so far is NAV only. Their data is there. What is the net asset value on this date and what is the unit is given. Here the problem is what? Unit is not given. On 31/3/2017, there is no units is given because it's a dividend reinvestment plan. They are given units only 2 times. Beginning units is given, ending unit is given. That is a test. So you can do the normal formula. That is used to your understand. Why this is a standard question? You can't do the normal formula. That is the reason. If you want to do normal formula, what you require? What is the net asset on this date and what is the units of the days you should know. You don't know the units. So now how can you able to get it? Units, there is a dividend also there. So we don't know that units. So what you done? You have to do reverse calculation. What is the reverse calculation? You know what is your NAV 0. What is your NAV 0? 50,000. They given what is the annualized return during the period. During the period, annualized return is what? During the period, your annualized return is what? 120%. What is the holding period? Your holding period, how can you get it is, your investment is 1/7/2016. Now it is 31/3. So 7, 8, 9, 10, 11, 12. Then again plus 3. So total is what? 6 plus 3, 9 months. So 9 months. It's what? 9 months. So holding period is 9 months. So what will be the holding period? Because we know this is the reverse calculation of our previous essay. That is from NAV 1 only. If you go through this, this is the logic comes from here, from our essay. See, your holding period return only NAV 0, NAV 1. That is your annual return. How you find out? Reverse calculation. Annual return you can get NAV 0, NAV. We want NAV 1 only. So we are coming reverse way. We are coming what? Reverse way. This logic we are coming what? Reverse way. So hope you are ready. So it's a very interesting question. So how we will approach now? Holding period return. Holding period return. How can you get holding period return, friends? It's very easy. If 120 is for 12, what will be for 9? 120 is for 9. What will be for 12? 120 is for 12. What will be for 9? 90%. Your return is what? 90%. Your return is what? 90%. If return is 90%, what is your holding return in rupees? Holding return in rupees. We know this return in our amount 50 into 90 percentage. You'll get what? 45%. We know NAV1. Can you recall what is the formula for dividend reinvestment plan return? NAV1 minus NAV0. NAV0 is 100. So you know NAV0, you know return. So if you add, you'll get what? NAV1. So you can get NAV1. Reverse calculation, we are finding NAV1. What is your NAV0 plus holding return? This will apply only in dividend reinvestment plan. This will apply only in your dividend reinvestment plan. So you have. Now the problem here it is what? You got NAV1 very clear. But the problem was the return include dividend also. If dividend is there, units is changing. So you have to exclude the dividend amount. You have to exclude the dividend amount. So what you have to do? Less dividend amount. What is the dividend amount? See, 50,000, 10 rupees. So your unit is 5,000. In every 5,000, 10 face value is 10. You are getting a dividend of what? 10%. So you want to reduce the dividend amount, which will be 50,000 into 10, which will be 5,000. So this will be called a NAV 0, NAV 1 without a dividend. A very good question. We are excluding the why we exclude dividend? Because dividend, if you take it, you should take units with the dividend. We don't know that. If dividend is not taken, you can take units without dividend. Units without dividend, we know. So what is the NAV without dividend? You have to just minus, you get 90. Now what is the units before dividend? Before dividend, your unit is nothing but 5,000. That is what beginning. 50,000 you invested, 5,000. So this is what NAV as on. See, this first part only lengthy, balance and all very, very easy. First part only lengthy, balance and all very, very easy. So NAV as on 31/3/2007, which will be what? You have NAV 190 by this 80 rupees. Now, on this day, what is the units you get it? Additional unit you received will be now, it will be you are investing 5,000 as a dividend, 80 rupees. You will get an additional unit of what? 2778. So, what is the closing unit on this date? These are all not required for this part. I am doing for the second part. So what is the closing unit? Already you have 5,000. Now you got the dividend. The dividend you reinvest. How can you understand this is a dividend reinvestment plan? Your unit in the beginning is what? 5,000. At the end is 627. Units is increasing. Units is increasing. It is implied that it is a dividend reinvestment. So you are getting what? 527, 7.8. Now, if you go through this data, dividend is paid only two date. One is at 10%, another one is what? On 31. That is 2 date only you paid the dividend. Since you paid a 2 date only the dividend, this is what second part two. They are asking next day question is what? NAV. It's a very essay model question, very advanced day. 31/3/2018. My dear friends, see on the closing date they given unit. Now this is the unit now. Is both the units are different or same? If this 5277 and closing unit 627 but is same or different? The difference is a additional unit you got on this date because in this date only you have got what? Dividend is declared. Only this date, no other date is given. So you can go reverse calculation. Only one simple formula. Units eligible is equal to dividend amount divided by NAV on the date. You know what is the units you got it. You know what is the amount of investment. Reverse way you can get units eligible. That's all. Very simple logic. So how you will get it? First you should know what is the amount for reinvestment. I'll do very shortcut. What is the amount for dividend reinvestment? You have 5277.78 is the unit right now on the beginning. You are 10 rupees the face value. You are getting a dividend of what? 20%. Apart from that, there is a capital gain of what? 6. So 5277.78. You are getting a what is the amount? 0.6. This is the amount of reinvestment. One single line. In the regular class, I make step lengthy. Now I'm telling you a single three-line formula, dividend formula, so that you'll be able to understand the current main point behind that concept. So now what you can do is see this is the amount of reinvestment. What is the units eligible? Units eligible directly we apply formula. Here we'll get reverse way. That is closing unit is 6271.98 minus 5277.78. You will get the answer called a 6271.98 minus 5277.78. The regular class I did a lengthier answer, but now I'm telling shortcut because now you are in revision stage, you know all the relationship. Now you know what is the formula for units eligible. What is the formula for units eligible? Outstanding amount divided by NAV on the date. So reverse way, NAV as on 31/3/2018 will be, you know this, reverse way, it is 13 point. How easy, my dear friends. That's all. So this is the speciality. If you are good in concept, my dear friends, we can able to do it very fast. Next one, last NAV as on. They were asking on what? 31/3/2019. Here, not is at all. Already annual return. There is no concept of closing unit. Here the step we are done because we don't know 5277. Here we know 5277. What is the unit? So we can do in one line. What is your NAV 0? Your NAV 0 is what? 50,000. Your NAV 0 is what? 50,000. What is your annualized return when you are selling? Annualized return when you are selling is, they said 71.5. They said that 71.5. Yes or no? Now you can go for holding period. What is the holding period? The same thing. What we did the same way. What is the holding period? Holding period. You invested in the month of 1/7. So 1/7 to 31st 7, you will have what? 9 months. Then you have again 2 more years. So 24 plus 9, if I am not wrong, 33 months. What is the month? 33 months. So what will be the holding period return? What will be the holding period return? Your holding period return will be 71.5 is for 12. What will be for 33? 196. What will be the holding period return? This amount into this percentage. You will get the answer. You will get this. Now, what is the NAV 1? This 1 plus 5. See how easy we've done this. Now your NAV 1 you got it, NAV 0 you got it. You know what is a closing unit. See why we do here easy, because closing unit we know. What is a closing unit? 6271.98. The first step is become little lengthy because we don't know closing unit on the day. We know only beginning unit. That is why we excluded the dividend. Here we know the closing unit is what? 6271. So we can directly approach NAV. What is NAV per unit, friends? You have the number, you get 23.64. This is how you have to get the answer. Are you clear, friends? If any maths corrections is there, I think I have done proper maths only. So you will get Excel sheet once I scroll down. If any correction, please let me know. So this is how you do what? 23. See how easy. It's a very standard essay model question. Whatever we did is a, that's why we started from reverse way. Now we'll go again reverse way. Next area is what? Computation of Jensen alpha, trainers ratio, sharp ratio. It's not very easy. It's a formula based question. It's a formula based question. What we do now, we'll take a directly one. There are some question all the method are asking. Can anyone tell a question all the method? My Excel some issues, sir. Yes, here yes. If you gone through this 43, if you gone through this 43, a mutual fund analysis has collected the following past report of fixed fund. Following past report of what? Fixed fund. So fixed fund is specifically mentioned only this, and the Sensex also. They were given return directly, standard deviation visa. Risk-free return is what 6A. Based on the information, you are required to fund a tabular form for sharp trainers, Jensen Alpha. Sharp trainers and Jensen Alpha. Yes or no? So we have all the point. We can easily able to approach. In single question, we can able to recall all the concepts. So we have name of the fund. What are the name of the fund? We have from PQ RSE U and market. What is the return of portfolio? Can anyone tell me? 18.5, 16.3, 9, 21.25, 16.8, 12.25. Now you can go for standard deviation. Can anyone tell me? 24.05, 22.37, 14.59, 28.10, 19.58, 40. Now, can anyone tell me the beta? I'm making everything. You don't want to make this percentage. I'm making Excel shortcut. That's why I'm making everything in copy. Beta? Hmm, hmm. 0.9. Hmm. Yes. Hmm. Now let me find here, friends. We'll do each method. First, we can do for sharp ratio. Sharp ratio. What is the formula for sharp ratio? RP, return of mutual fund. minus RF they said what 6% divided by standard deviation. That's all. Now you how you have to rank higher the point better the ratio. So how you will do ranking? Each one you have higher the ranking, you can able to go for what better the position. So you can check it which is the higher the one. So if you consider the market, you can do without considering market or with considering market. If you consider with market, market is 1, this will be 2, this will be 3, this will be 4, this will be 5, this will be 6, this will be 7. You can consider without market also. This is what Sharp ratio. Next we can go for what trainers ratio. What happen if trainers ratio same thing RP minus R of. The only change is what instead of standard deviation we take what beta. Without very directly we can able to go for it. So if everything combined then only they will come for the same point. Here also you can go for what ranking. So how can you go for ranking? The highest one rank 1, rank 2, rank 3, rank 4, rank 5, rank 6, rank 7. Next they were asking is what Jensen alpha. For that you have to find out what CAPM return. Since I am using Excel, I will get all the data here itself. How I will get result R of 6 plus beta of what is the beta of into RM minus RF. RM is market return, which is this point, which is you have to be very clear. Market column minus RF, which is what 6. Since I am using Excel, for me just to scroll down only. This is what market. Now you can go for Jensen alpha. What is Jensen alpha, friends? Actual return minus CAPM return. This is what. You can go for ranking also. What is the ranking criteria? Higher the one is, better the option. Higher the one is what? Better the option. So this will be the rank 1. This will be the rank 2. This will be the rank 3. This will be the rank 4. This will be the rank 5. This will be the rank 6. This will be the rank. I want to tell you one thing. See, there is no logic of ranking market under both Jensen Alpha and trainers. The reason is what? You are comparing with beta. Beta of market is be what? 1. So this will be not have no impact. It will be 0 only. So that will not be a better comparison for market. So you can eliminate market while ranking Jensen Alpha and trainers. You can eliminate. Though the question market is there, you can eliminate. In the class, you might have been taken because most of the question you might have been done as a homework only, or you might have been done. I'll be waiting because one formula if I take, you can able to do it very well. So the reason you understood now, always Jensen Alpha for market will be what 0 because actual return with beta will not be 1, so it will be you will get 0. So there is no point. So it is better you can eliminate market ranking when you go for trainers and Jensen Alpha. Now, how can you give comments if it are coming for a 7 mark? You can give the comments is what. See, if you go through this one, R is everyone, it is what was. So you can able to tell that one of the worst is what R. Like that, you can able to give a better comparison. Are you clear, friends? So this is how we have to approach, friends. So this is a consolidated question on what this method. Now I will tell you one reverse question on this method. What is this reverse question? In this question, if you go through, see here, they are given residual variance. What is residual variance? Now I'm not going to solve this. I'm just telling how the reverse calculation because we did all the same model. Residual variance is what unsystematic risk we discussed in the last periods. Total approach. So if you get residual variance, they were asking you have to find out under sharp and trainers. Trainers, there is no problem at all because you can able to get it very easily. But how to get for your actual return? You first you have to find out your residual variance. This is given in the question itself. They given the market standard deviation which is 25. So mark this is they use the word called variance approach. So your market standard deviation if you take square beta square you multiply you will get systematic risk. If you get systematic risk, if you get unsystematic risk, sharp index model, if you multiply both, you will get what? If you add both systematic and unsystematic, if you add both, you'll get standard deviation. That standard deviation only you have to use for what? Finding out your sharp method, because sharp method, the formula RP minus RF divided by standard deviation. How to get RP? See, they are given the market return RF beta also. Find out CAPM return. Find out CAPM return. You know Jensen alpha concept. What is Jensen alpha concept? Actual return minus CAPM is equal to alpha. They are given alpha. They are given the CAPM return. So alpha plus CAPM will get what? Actual return. So it's a very, very good question. Same thing what we did only, but data is missing. You have to approach the data, reverse calculation. We did all these questions in the class, but I'm just telling because it's just an application of formula only. You can go for different model question. Clear? Now coming here, question number 46 also, same sharp. So traders are, see the first question we did is a direct question. Now what I am taking reverse question. What is reverse? See, they are asking trainer, sharp, Jensen, everything. How can you do? They are given correlation. They are given correlation. So what you have to do? They are asking for trainers. See, trainers, you should get beta. What is the formula for trainers? Beta. What is the formula for beta? Beta, they have to give the question. If not given, you have to go reverse calculation. That is standard deviation of the stock. How you will get standard deviation? Systematic risk, unsystematic risk is given. Both if you add, you will get the standard deviation. So standard deviation of stock divided by standard deviation of the market. Standard deviation of the market, they given variance of the market is what? 25. If you take square, you will get it. So standard deviation of stock divided by standard deviation of market into correlation with the matrix. This is what you have to multiply. Actually, your column alone, there is a small change. It's WXYZ, it's a printing error. It is ABCD. It is ABCD. It is ABCD. It's a printing error. It is a ABCD. Are you understood? Pakka? So this is how Jensen alpha will come reverse calculation. Jensen alpha will come what? Reverse calculation. So we discuss direct method, reverse method. Yes or no, friends? Now we will go for the, I told you now, we come from the backward. Now we can go for 2-mark reverse calculation question also. This role I have already told, time weighted return, and this 37 and all we discuss in the class. You can just put a star mark for 37 just for practice. Just for practice, because it's already we discuss how you do 93 divided by 98 into then 98 divided by 99, then 101 divided by 99. This we did it. So if at all they want to ask you, you can able to get this. Already I have told you how to do. So 37 you can just able to revise it. Both 37 and you can go for 36. This both you can just revise it. Now here there is another question called 33. Expense ratio. Expense ratio we discussed now, but here there is a portfolio turnover. How you will do portfolio turnover? Opening NAV 20, closing NAV, expense. Annual purchase is 250. Annual sale is what? 420. What is the formula for portfolio turnover? We'll do portfolio turnover. Lower of sale or purchase. So lower is what? 250. Then you have to divide by value of portfolio net asset. How you will take it? You have 4 stock. Market value for what? 100 crores. So you have to take everything. I will do this now because we haven't done anything on portfolio turnover. So net asset value. What is the net asset value, friends? You have to take the add 100 plus 300 plus 500 plus 100. What is the total, friends? 1000. So your portfolio turnover. What is the formula for portfolio turnover? Lower. Lower is what? 250 divided by 1000 into 100. You can give what? What will be that? 25%. The meaning is what? Total net asset 25%. There is a movement of your investment. 25% there is a movement of your investment. Are you clear, friends? Yes or no? So already expense ratio we have taken. P ratio nothing, but there are 4 P ratio given. We can just take the average. Now we will go for it. What another role we did similar question only. 2 mark if you approach. 2 mark directly already we discussed. These are all reverse calculation only. See, this is a very good question. In the class we discussed the 19. It's a very good question. What is this 19, my dear friends? Very good question. I'm not going to solve in detail. You can take your notebook. Reverse calculation notes, you have to practice. So, because we already close to 10, 15 questions we solved now itself. Then what is the meaning of revision and this? Now, what is standing? I hope you taken your notebooks so that will be easy for you to understand. It's a very good question because I want to tell you the reverse calculation impact. Are you ready, friends? Yes or no? See, they given sharp ratio, they given trainer's ratio, they given standard deviation. This is the clue for getting beta. This is the clue getting for what? Beta. What is the formula for sharp ratio? RP minus RF divided by standard deviation. So the question is given, standard deviation is what? Sharp ratio is 2. Sharp ratio, very standard question. I'm just solving now itself. I thought of not to do, but I have to tell you this because of important. 2. RP minus RF we don't know, but RP minus RF divided by standard deviation is what? 11.25. So if you go for reverse calculation, you will get RP minus RF. What is RP minus RF? 11.25 into 2, which will be 22.5. Now next you have to go trainer's ratio is given, which is RP minus RF divided by beta. So you don't know beta, but you know 22.5. You know the final answer 5. So 22.5, if you divide by 5, you will get the beta of the XA. What is the beta of the XA? 4.5. What is the beta? Beta is the sensitivity of the stock with the market. Sensitivity of the stock with the market. They said that you have an X fund of what? 17.71. In that 99 is what? Equity. So you take in your calculator 17.71 into 99 percentage. Into 99 percentage. That is what your equity portion. They tell that your market is goes down by what? 5%. We know beta is a sensitivity of stock with market. If your market change by 1%, your security will change by what? 4.5. If you have a beta of what? 4.5. Here you are having 5. So if you take your another calculator, 5 into 4.5. What is 5 into 4.5? 22.5. That means if market comes down by 5, your security more sensitive, that's right, 22.5. So what happened now? We got 70.71. So better since you have to do a lot of in calculator. In that 99 percentage is this amount. This is what equity portion. This equity will reduce by what percentage, friends? 22.5% it will reduce. That means this was the value because market goes down, your security also will goes down. This is your equity portion. Cash we know it will not change. So cash will be this amount into 1%. But the problem is what? You have some expenses 3, which is for 12 months. So that has to be reduced. So 3 by 12 if you reduce, your remaining cash will be what? This is the cash. In that this expense you have to incur. Remaining cash will be what? 4 points. So what will be your NAV? This is your closing plus cash. Your value will be what? 54. In your notebook you will get the answer. You have written a very lengthier calculation, but we did in a 3 stage. So that is the speciality, my dear friends. If you are good in concepts, if you understand the relationship, you can be able to solve very easy. So, friends, so you will get a navy of what? Same thing you have to do for what? This is also reverse because, my dear friends, don't think that direct method because you are in a final level, you are a professional level. So you have to go for reverse calculation, how to approach, you have to practice this kind of question. That is why I'm focusing more on essay model question and reverse model question. Are you clear, friends? So going further back, these are all we discussed. Same model only. That's all. These are all 2 mark model question only. See, this is a again portfolio turnover model. See, this is what I told you the example of desired return. Only this one only we are not done. Then we have done some 2 mark question. Entry load adjustment exit load. I am not revised it. If it is a entry load is there, purchase price will be NAV 0 into 1 plus entry load. If there's an exit load is there, your price will be what? What is your price into 1 minus exit load? That is also we have. I haven't discussed as a 2 mark area only. Now I just recall. They can get a return of what? 16% in equity. Initial expense is 5.7. Recurring is what? 1 point. What is the return if they want to get a what? 16%. These are direct question. But in the class we discussed reverse way also. So 16 you want divided by 1 minus initial expense 0.55, correct? 57. 0.57 plus 1.7. You have to make it. So this is the answer. We did this formula also in the morning. So what was the concept we revised? What is the answer, friends? Yes, 18.67. That will be the answer. So this is how you have to approach, my dear friends. So 18 point. So what I have to highlight you, my dear friends, is what I have to highlight you that reverse calculation is very sometimes comes for this 2 mark also. That I have discussed in the revision time itself. They will give you recurrent we did in the class also. Okay, that I taken from additional material only. So these are all the direct question only. These are all direct question on sharp ratio, trainers ratio. See, we did a direct question, but I giving you that you have to focus more on what? Reverse question. That is what a final standard level question. Because you don't have no 4 mark question. See, this is a question where they are giving return beta everything. They are not specifically asking which method. You have to analyze. So what was the available data? If you can do CAPM, you do Jensen alpha. Otherwise, you can go for what? Sharp ratio. If they are not asking the method, direct method only. Here are all direct question only. Here are all NAV very basic 2 mark model question. NAV very basic. They are given size of the fund. What is the amount? Your amount is 180 lakh plus accrued plus receivable minus liabilities. That's also a very basic model question. So this is how this question only we did a essay model question. What is the NAV? This is also essay model question. Now just read it. So what I have to tell you that this is also basic level on what NAV calculation. So this is how the method of what mutual fund. I told not like portfolio. It is a very lengthy area. It is what mostly testing on you what is mostly testing on you what mostly testing on 7 mark one question, 2 or 3 MCQ model question. So now I will go for MTP for your exam. I'm just taking it. Paper 14. This is the question paper. In the last class itself, we have told you we have see. I told you certain mutual fund return is 17, standard deviation 3.5, sharp ratio is 4. What is the RF? Reverse way. They are not coming as a direct. We discuss now reverse way. Correct or not? Next day, again, second question. A mutual fund is 70 at the beginning, 6. This is a direct question. So if you are lucky, it will come as a direct. We did this also. Our first to second question was this only. This is what we discussed in our second question, where it is that this one, where we started this 24 direct question, 13.3. So 4 mark. This beta of stock, it's a portfolio management question, but based on mutual fund knowledge also we can able to solve it. So 2 mark, as I discussed, minimum 2 question. They came what? 2 question on this. So 2 into 2 will get what? 4 mark. Both 2 mark is easy or very easy. Very easy. Now when it come for essay model question, when it come for what? Essay model question. See, today we started our first question, reverse calculation. We did this question now. See, misplace of document is original document is investment, number of units, net asset value, total it, number of investment. Are we did this? Why? Because see, if you go through what role in this revision today, we did all the previous year recent question. All because we started from the essay model question. As I told essay model, we selected the second question or first question, I guess. This is the first question we started. Yes, today when you start doing the first question, that is what. So we know how the institute is focusing. That is why I am giving you the proper strategy. Don't take any shortcut. Don't think that because in the class mutual fund we started from the base. Students how they study from base. Base if you start 20 questions, then you feel tired and you stop. No, that is not what. Revision strategy I told you. You have to come for backward. Revision how you did? Backward. What is backward? Essay model question. 7 mark question. That I told you the important model question. That you have to start because your learning have a graph. Initial first few time good concentration will be there. So at the time if you start with these kind of questions, balance and all easy. This is a strategy for what? Mutual fund. Are you clear? So mutual fund, as I told, only one question. Yes, they follow the same one question only. So since one question, 7 plus 4, 11 mark. My dear friends, you won't believe that 11 mark in this 1.5 hour we learned. Entire question we are able to do. Correct or not? See this now I am revising. Now when you are going to revise, it will take again lesser time. Again lesser time. Practice, practice. You will take what? Time will getting lesser. That means getting 11 mark from mutual fund is very, very easy than any other chapter. Because if you're strong in portfolio, easily you will be able to get it. If you're strong in portfolio, will be able to get it very easily. Are you clear or not? Even portfolio concept that much not being required in our mutual fund. So this is how you have to approach for mutual fund. Hope you are clear how to approach the mutual fund. We have taken mutual fund almost all the question. So no need to go for any additional questions other than we discussed in the class. That is more than enough for you. Okay. So with this revision on mutual fund, we will wind up, friends. So once again, very, very good morning, friends. So what we are planning to do in this revision today, as we discussed it, we were going with portfolio management. As you requested, we are going with portfolio management revision. Plus in forex, some small additional questions also we are planning for that. So hope all of you have the workbook with you. So hope all of you have the workbook with you. Hope all of you have the workbook with you. So let's start the session. So what is our planning in portfolio management is, first we will learn what all the area you have to concentrate on portfolio management. I hope you're all having that equation page with you. First one, you should be able to know what all area we have to learn. Then we are going to select consolidated question. What is in by consolidated question? See how we learned in portfolio management is step one, we learned what is the formula for computation of return. Step two, what is the computation of risk? Then we learned the systematic risk, unsystematic risk, beta. Like that systematic way we learned. But in revision, what we are planning is we'll learn all the concept. We'll go with the concept in the sense it is we'll revise all the formulas so relevant when you're doing the problem. Then we'll select a consolidated question. So while doing this consolidated question, you will be able to recall all the steps. In portfolio management, what students always make mistake is what they will have lack of practice. In exam, you have to make a proper time management in portfolio management sum. The point is what, as you know, if you want to compute the risk, any one step, if you done error, the final answer will get error. The final answer will be wrong. So what you have to ensure? You have to ensure your all steps have to be correct. How you can ensure that through proper practice? Some friends generally in portfolio management, what they will do now, they might have all the formulas because when we start the portfolio management, we request students that keep all the formulas separate page. So அவங்க கையில என்ன இருக்குன்னா formula full இருக்கும். So they believe what இந்த formula மட்டும் படிச்சு போனா போதும்னு நினைச்சிரும். But that is not sufficient. So what you have to do is you have to go for what? You have to go for revision. So what is our strategy today is first thing we'll revise what are all the important concepts we have in portfolio management and rapid revision. Formula pages இருக்கும். Then நீங்க கூட வேணா you can also write it. Point number 2, what we are going to do is we'll take from our workbook consolidate few questions. We'll take from our workbook consolidate few questions. Then step 3, we'll take recent MTP and previous year additional question. Recent MTP released and previous year question also will solve it. This is what So next we'll go with what? As discussed, MTP questions. Then recent the similar topic, CA final question also will practice. So this is what our strategy in what? Portfolio management. All of you ready? So this revision session will be useful for those friends who already gone through this portfolio chapter. Don't think that நீங்க போர்ட்ஃபோலியோ பார்க்காம அப்படியே வந்து உட்கார்னா you can able to follow it because my speed will be little bit fast because this is not a regular class where we will give time for copy நீங்க காப்பி பண்ணுங்க I will wait அந்த மாதிரி டைம் இருக்காது because we want to do maximum question practice ஓகேவா so portfolio management பொறுத்தவரைக்கும் நீங்க if you just gone through your equation page you might have been taken first you might have been written what the formula for what return the formula for what return correct return what also we are going for a rapid revision of what we are learning in return what all we are learning return we were learning mainly four areas first one return of a security return of a security in the return of a security the first and most formula which will be relevant for your 2 mark also that is realization method what is that realization method so how can you compute the return of security and the realization method there are two type of return are there so dividend plus mps 1 minus mps 0 whole divided by mps 0 into 100 this is what realization method formula then we will have average formula method where the formula is sigma r by n we have average formula called as sigma r by n then we have another type of formula which is called a with the probability which we have lot of area sigma of pa into sigma r by n when we'll apply sigma pa into ra when we'll apply if number of years are given you have to go with what sigma r by n if it is given with the probability you have to given for what pa into ra because this return is the first step for your risk also for beta also because beta if you want to compute you should get the covariance or if you want to get the standard deviation you should get the return so எல்லாத்துக்குமே ஒரு base தான் so when you have to apply the average return formula you have to go for it years are given when there is a given probability you have to go for this then we have our normal formula which is applied for arbitrage course of action unknown which is called as CAPM return we have discussed undervalue, overvalue on the basis of what? CAPM also. So we have the CAPM formula which you are familiar, RF plus beta of RM minus RF. This is the first four formula we might have been learned. Then afterwards we will discuss another type of return which is very very interesting. This is what CAPM. Then you might have been return called a CML. What is the CML return, my dear friends? Similar concept only. Here RF plus lambda instead of theta it will be what standard deviation into here it is stock you go for standard deviation of stock here while finding this RF BF and all you might have been returned sometimes question directly RF may not be given we have to find out the RF நீங்க எழுதி வச்சிருக்கோம் what is the formula you might have been returned for RF RF is nothing but interest amount divided by trading value into 100 so that is also you have to find out this RM minus RF is also called what? Risk premium. Sometimes they won't give RM separately, RF separately. They will give what? Risk premium. Risk premium is called what? RM minus RF. This lambda is nothing but market attitude to risk. Lambda is nothing but market attitude to risk, which can be find out what? RM minus RF divided by standard deviation of here standard deviation of market. The same thing which we can apply for there also that we'll discuss. Now we are discussing stock only. Now we will discuss after these two formula, correct? Return under the two-factor model. What is return under two-factor model? R plus beta factor 1 into risk premium plus beta factor 2 into risk premium. You might have been written this formula also. Yes or no? This is what is called two-factor formula. This may select friends might have been forgot to add this formula also because this we will discuss later on. We told you to add this formula. So some friends might have been forgot this also. This is what is called what? Two-factor model. That is, this is also relevant for your exam. That is, we have discussed that practically your systematic risk can be different factors. It can be your interest rate, it can be your inflation, it can be the market risk. So each one separately given. This is what is called what? Two-factor formula. Apart from, you might have been written, some friends might have been written another one formula called it RF plus or beta into risk premium. This return also. This very rarely comes, not a big matter. Then any other formula you have written? This is the formula you might have been written for risk of security. Yes or no? Yes. So mainly we have to be able to recall for risk and return purpose. Generally, the first two are used. For undervalue, overvalue, we use what? CAPM formula. Now, next, very important. When we will use this CAPM formula, when we will use CML formula. When we will use CAPM formula, when we will use CML formula, if the question is given that fully diversified, இதெல்லாம் எப்படி தெரியலனா you can just written here in the bracket itself. Equation page itself bracket you can written is what? Fully diversified. So that happened now, you can able to make it, you can able to make it. This lambda is also called market attitude to risk. Then you have what? A return of a portfolio. Return of a portfolio. So return of a portfolio, how can you here we have return of a market is there. Then return of a risk-free return, whatever you can return. So return of a portfolio I'm going for. Portfolio which have lot of area are there. Portfolio is a summation of all the securities. So return of a portfolio is nothing but summation of weight of security into return of security. Summation of weight of security into return. Some question this weight will not be given. So how you will find out this weight? What is the value of A into value of the portfolio? Value of A is nothing but number of shares into market price. Portfolio is a summation of all. This is on the basis of weight. This is on the basis of what? Weight. Now you can use the CAPM formula also. What is CAPM formula? The same formula, RF plus. But instead of beta of security, here you use beta of security, here you use what? Beta of portfolio, RM minus R. So parallelly, if you missed any item of formula in your notebook, you can also add this. Because once you get all the area, so what level this area you have to learn, if you understand the revision also for you, it will be very easy. Next, you can go for CML formula. The same CML will come. RP, what is RF plus lambda into, here standard deviation of stock, here will come what? Standard deviation of portfolio. Standard deviation of portfolio. This is how you apply the CML formula. This is how you apply the CFML formula. This is the mainly three formula we'll use for what? Return of the portfolio. Now coming into market. Market now, see there are some questions here. This nothing clue given for market. So we will assume that what is the shares given in the question constitute what? Market. Very important. See, there are this step and all very easy. Sigma of return of market by N. Sigma of PA into RA. These are all we can use for what? Market, which is very easy. I am going to discuss the first part. Question, no clue for market is here. But you have to apply CAPM formula. We'll do that question also today. It is a 2-3 times previous year question in old syllabus. So what you have to do now? You have to assume that this what is given in the question, that is given as a market. For 4 securities given, you have to assume the 4 securities is a market. So then we know summation of all the dividend. The formula is nothing but summation of all the dividend plus summation of MPS 1 minus MPS 0 divided by summation of MPS 0 into 100. I think you have written this formula already. This concept is tells what. So when I'm revising this formula, I'm also telling you where you have to apply. Where you have to apply. So this is when you are applying that question are not at all given. So you want to get RM for CAPM purpose. At the time, you can use this formula. Whatever the security you can constitute a market because we know market is what? Collection of securities. So you can able to apply the same way. You can able to apply the same way. The risk-free return is generally the main area. That is risk-free return. It will be generally will be given in the question. If it is not given, I have told you already what is your interest rate divided by trading value into 100. What is your interest in divided by trading value into 100? This is how you can find out the return different parameter. Yes or no? Shall I scroll down for risk? Yes. Now when you go for risk, Risk in the sense we have might have been discussing different area, mainly three area: risk of a security, risk of a market, or risk of a portfolio. Risk of a security, risk of a market, or risk of a portfolio. In risk of a security, what we were discussed is what? Risk of a security, what we were discussed is called mean with the probability or without probability. In return, I have told you if you can find out with the number of years. This number of years, na, one formula root of sigma d square by. If there is a probability is there, root of sigma PD square. Root of sigma PD square. The same thing only will go for market also. The only difference is what? For stock, you take deviation of stock, whereas market, you take what? Deviation of market. Stock, you take deviation of stock. Market, you take what? Deviation of market. Are you clear on that? So this is how you can able to go for what? Risk of a security and risk of a market, the main two area. Apart from that, this is very, very important discussion, my dear friends. Now what I am going to discuss. Now what I am going to discuss. This you might have not be written in your formula page, but we have discussed a lot of questions. So hope you are able to recall this. See, risk, another one formula. We learned that risk can be split into two parts: systematic risk and unsystematic risk. So there is a one more method for finding risk is what? Systematic risk plus unsystematic. I think you might have been written only two formula there, correct? If you written two formula only there, you can add one more formula called a risk of a security is equal to what? Systematic risk plus unsystematic risk. We did problem on this, but you might have been not written this. What is this concept? Question will ask you to find out risk of a security or risk of a portfolio, but they will not be given this data. How you have to do? They will be given beta. With the beta, you can get what? Systematic risk. They might have been given residual variance, so you have to apply this concept called a unsystematic risk. Are you clear or not? So you have to approach. So this is another one formula for finding the risk. In your formula page, how many equations you have written so far? Two. Yes, you can add over this point because then you can able to recall the point. You can able to recall this. Now we go for risk of a portfolio. Risk of a portfolio. Risk of a portfolio. There are two situations are there. We have written so far. There are two security. Generally, two security will come. Two security. How can you do find out finding friends? Root of. It's very easy only. What is the first step? Weight of A. If you assume A, you can use A or B or X or Y. Weight of A into standard deviation of A whole square plus weight of B into standard deviation of B whole square plus 2 into weight of A into weight of B into standard deviation of A into standard deviation of B into correlation of A. This is how you have to do. Same thing you can use for what? Three security. So what will happen now? Your weight of A, weight of B, weight of B, weight of. Now you have to weight of C into standard deviation of C into whole square. Plus you will have three combination. 2 into weight of A. We'll do one question on these three today. So you have already written the formula. We'll do the question directly. So I'm not taking time for doing that point. Clear. Another one. So one is two security. Next is what? You might have been written this, but the third formula is what? Systematic risk and unsystematic. The third method is what? Systematic risk of a portfolio you are finding out. Then you have to find out unsystematic risk of a portfolio. Both if you add, you will get this also you have to add in your formula page. This if it is not there in your formula page, you have to add in your formula page. Correct or not? Okay. So this is how what is the concept called what? Risk. This is what the concept called a risk. So hope you are able to recall the concept of risk. Now we will go for the next area. Now we'll go for the next area. What is the next area? We have correlation and correlation and coefficient variation. Correct? So first you can go for what? Covariance. First you can go for what? Covariance. This covariance for 1 mark and or 2 mark MCQ also relevant. Covariance can be either positive or negative, or Zero, no value. Positive means both the security tend to together. Negative means both the securities opposite direction. This is what is called covariance. Covariance, you can able to do two methods. That is, you might have written a lot of formula. Each one I will tell you. First one it is you can do without probability. First one you can do what? Without probability. So without probability, summation of deviation. We know covariance you have to find out. So you are doing generally covariance. This is very interesting. If you want to get covariance between two securities, between two security. If it is a two security, now deviation of A into deviation of B divided by. Same thing if you want a security and a market. That is security and market. You know already, but still I am just revising the concept. It will be what? Deviation of A into deviation of market divided by. Are you clear? Yes or no? Now moving next. What is the next point? Summation of probability into deviation of A into deviation of B. Here, summation of probability into deviation of A into deviation of B. Correct. Apart from that, you have written few more formulas. Can you just recall? You have written first one that is covariance of AB equal. These are all very relevant. That is because this formula and all you might have been written later on, but this application only relevant. These are all application only very relevant. The formula is what called a correlation of AB into standard deviation of A into standard deviation of B. Same way you can go for market also. Then you might have been written another one formula, covariance AB. Can you please recall that? If I am not wrong, variance of market into beta of A, beta of B. This is very important. Lot of area this formula also you may be required. Is it there in your formula page? Yes. The problem what happened now, you simply maybe mug up the formula, but you should understand where is the application. Where is the application? அதுதான் main அப்ப இந்த கொஸ்டின் வருது வந்து you can பக்கத்துல bracketல you can put the question number. எந்த கொஸ்டின்ல அது வருதுன்னு you can able to put the question number so that you can able to revise it very well. So that you can able to revise it very well. So covariance AB is equal to what? Variance of market into beta of A into beta of B. So these last two are first calculation formulas. Whenever you stuck, these formulas are used. Whenever you stuck, see if it is a market, what will happen? If it is a market with market now covariance A with market, variance of market into beta. Very important. If you are not written, you can written because there is market of beta, nothing not there. Beta of market is what? 1. So there will not be no impact. So the formula is what? If you want covariance of A with market, variance of market into beta of A. That is A out beta, you have to take it. Are you clear, my dear friends? So this is what covariance. Shall I scroll down? You are able to recall? Yes. Next we will go for correlation coefficient. Correlation coefficient, we have already one formula we just discussed it. That is correlation of AB is equal to covariance of A divided by standard deviation of A into standard deviation of B. This is generally we can able to make. See, there is a 2 mark, just like covariance also will come here. It may be plus or minus. It may be plus or minus. That is plus 1. It will come in a range of plus 1 to minus 1. Plus 1 means perfect correlation. Perfect positive correlation. Plus 1 is what? Perfect positive correlation. Minus 1 is what? Perfect negative correlation. Perfect positive correlation. Then perfect negative correlation. What is perfect positive correlation? Both the security will go together. So when you want to diversify the security, it is better go for negative correlation. Then only the diversification will be helpful. Because some question they will ask you comments. Some question they will ask you what? Comments. So for the comments, you are able to understand this code. So it will come in a range of what? Plus 1 to minus 1 plus 1 means what? Perfect positive correlation. Minus 1 is what? Perfect negative correlation. Are you clear, friends? This is how we have to apply for this concept of what? Correlation. Now, இது பக்கத்துல ஒரு one more point you might have been written. This is very, very important. Some previous questions are there. That is, what is the optimum weight to reduce the risk? Optimum weight to reduce the risk. What is the optimum weight to reduce the risk? Optimum weight, you can go for weight of A. What is the weight of A? Variance of B variance. You have to take variance of B minus covariance AB, variance of A plus variance of B minus 2 variance of. So we have two security only. So weight of B will be 1 minus weight of A. This is very, very important. There are a lot of previous year question also came on this point. This area also will recall one question. Okay. So what I would like to tell you, if some friends want, sir, I want to revise it during the exam days. I want to revise everything very fast now. Each main concept you take a standard one question that you written there, one question number. So that question, if you revise, you'll be able to recall this question so that you can be able to save a lot of time. So we'll work on this optimum weight also, one standard, one question. Then after this optimum weight, we were discussed after correlation question, everything we were discussed beta only. See this beta also 2 mark question will come. So we are also highlighting where and all these 2 mark will come. So beta, you should understand that what all the point of beta. Beta is a measurement of systematic risk or sensitivity of stock with market. Sensitivity of stock with market. Beta can be 0, beta can be 0.5, beta can be 1, beta can be 2. These are all having the meaning. If beta is 0.5, your security will have a return below the market. If your beta is 1, your security will have a return equal to the market. If your beta is 2, your security will have a return higher than the market. If your beta is minus 1, your security will have a return offset to the market. Means market is plus, you will have what? Negative. If you have plus, market is what? Negative. Like that, you will have offset return. So beta can be any parameter. 2 mark theory based question can come on these concepts. Then beta, another one point is called higher the risk, higher the beta. Higher the risk, higher the beta. Correct or not? So beta, we were discussed a different formula for computing beta of a security. Beta of a security. One of the formula which generally we use beta of security is called covariance of stock with market divided by variance of market. This we can able to get it easily. Or else we can get another one formula, both required. Standard deviation of stock divided by standard deviation of market into correlation. So 2 mark sometime reverse calculation on this formula also relevant. This is the formula for getting beta. Yes or no? After this we were revised this what? Characteristics line. After this we were revised this what? Characteristics line. Characteristics line also sometimes come A is equal, y is equal to A plus Bx. This is very, very important. A is return of the stock. X is return of market. This is what? Beta. This is what? Excess factor, which you can also call what? Alpha. This you can also call as what? Alpha. This is how you will make a characteristics line. Lot of previous year question is there on what? Characteristics line also. There is a lot of previous year question on what? Characteristics line also. Yes or no, friends? Shall we proceed? Yes. Then when you discussing the alpha, we discussed the two method of finding the alpha. One is this characteristics method. That is, if your y is equal to a plus bx, a is equal to what? Y minus bx. This is the one method for finding the alpha. There is a one more method we discussed alpha. What is your actual return minus CAPM return? Actual return minus CAPM return. What is actual return? Sigma R by N or sigma PA into RI. Depends. If number of years, na sigma R by N accordingly minus CAPM return. You have to compute the alpha. These are two methods you can able to compute the alpha. Yes or no? Then when we discuss the beta, we will discuss the main area. This is very, very important. That is what I told you in earlier session also. systematic risk and unsystematic risk. Systematic risk and unsystematic. First and most thing you have to understand in the revision stage is what? This systematic and unsystematic risk you can compute two way standard deviation approach and also variance approach. So generally, most advisable method always is variance, or we can do on say standard deviation approach also. But I am telling the main point. See, if you want to find out a standard deviation of a stock, we were learned that the formula is what? Systematic risk plus unsystematic. So we were learned that if you want to approach this formula we were learned it when we discussed the standard deviation of stock. If you want to approach this formula, if you want to approach this formula, we want to go with variance approach only. We want to go with what? Variance approach only. That means you will find out the variance approach. If you go, you will get variance of stock. Variance approach, that is very important. I'm telling you, might have been returned risk of a security, one formula called a systematic risk plus unsystematic risk. How you will get it? Step one, you will get systematic risk and unsystematic risk variance approach. You will get variance. You will get variance of the stock. The variance of stock will be standard deviation root of what? That is, you will get the variance, then you have to take what? Square root. This is the ideal method for finding standard deviation of stock using systematic risk and unsystematic risk. That is how to compute standard deviation of a stock by using systematic risk and unsystematic. Now we will go for systematic risk and systematic risk. As I told, if question not specifically asked, if the question asks a total approach, if question asks a total approach or variance approach, then you can do variance model. Otherwise, we can do standard deviation approach. Otherwise, we can do what? Standard deviation approach. Here itself, we have two ways. We have stock also. We have what? Portfolio also. We have stock also. We have portfolio also. What is for stock? What is for stock? Stock means we can go for systematic risk. Beta of stock into standard deviation of market. Systematic risk is what? Standard deviation of stock minus systematic. Same thing, if you go for portfolio now, beta of portfolio into standard deviation of market, standard deviation of portfolio minus systematic approach. Hope you are having this data clear. Yes or no? Next thing, if you want to do under variance approach, if you want to do under variance approach, what you will do? The same thing, beta of stock square divided by standard deviation. Unsystematic risk is what? You go minus systematic. If you go here, it will be what? Beta of portfolio square into variance. Unsystematic risk is what? So we discussed what? Systematic risk, unsystematic risk, computation of variance using systematic unsystematic risk, then computation of risk by taking square root. Then we discussed this point called alpha. Alpha, however, we discussed the actual return minus CAPM return. Then we were also discussed the CML return. What is CML return formula? RF plus lambda into standard deviation of stock. So stock or portfolio, whatever the case. Correct? Lambda also. Generally, lambda method we learned it at this time only. After this, we discussed our main area, another interesting area, arbitrage course of action. Arbitrage course of action. Arbitrage course of action, we were discussed, we can do two ways. We can discuss what? Two ways. One is CAPM model. Another one is what? One is CAPM model. Another one is intrinsic value model. CAPM model is you have to compute your actual return. If your actual return is greater than CAPM, actual return, very good. Actual return is greater. See, very simple. Actual return is adhigama. You're getting higher return than CAPM is the return for the risk. CAPM is the return for the risk. You are getting more than that. So this you call it as position is called undervalued. So if anything undervalued, you will buy. What you will do? You will buy. Are you able to understand? This is what called buy stop. Now, when it comes for the next point, actual return is less than the CAPM, not best. So, what you will do? You can this overvalued. You won't buy. You will sell the share. You will sell the share. Yes or no? Similarly, you have what? Intrinsic value method. First, you should know how to compute intrinsic value. See, the CAPM model, if you CAPM return is also called equilibrium return. Very, very important. CAPM return is also called what? Equilibrium return. Similarly, intrinsic value is also called equilibrium price. Intrinsic value is also called what? Equilibrium price. So how you will find out this intrinsic value or equilibrium price? You can able to get your market price under intrinsic value method. Intrinsic value D1 by KE minus GR. D1 by KE minus GR. This is the method you can able to find out your intrinsic value. So this intrinsic value you have to compare with your what? Market value. This you can make different way. Some friends may be written different. Depends upon different way. You can either compute, one second, your intrinsic value is greater than your market price. Intrinsic value is above market price, but you're getting more than value. Intrinsic value is above, you call undervalue. The same thing by stock. Here another way, intrinsic value is what? Less than market price. We call overvalue. You have to go for what? Sell the stock. Clear? So you can able to go for two methods. D1 by KE minus growth rate. Are you clear? So this is what is called, you can able to go for what? Arbitrage course of action. Here and all, very, very essay model question we did. If you want to do CAPM, you should find out for CAPM, beta is not given. We have to find out the beta. That much level they may ask you. Clear or not? So this is what the different formulas you might have been written in your notebook. Now, apart from formula, there are some unique questions are there in your book. There are some unique model essay questions. Unique model essay questions are there. That is also you have to recall. What all that unique model essay question? If you go through, see this is a one unique model question. What is this unique model question? We are realizing now itself. See, they are given an investor has two portfolio known to be minimum variance set of population, three securities RS. So what you have done it is they given X and Y proportion. They given 6,000 you invested in X, 4,000 you invested in what? Y. So what you generate is you will find out if you do 6,000, 10,000, what will be the weight? So you get the weight. So what I will do now in this unique model question, I will do now itself. You can able to because it's a revision session. We have weight of R, weight of S, weight of T. We have portfolio X, we have portfolio Y. They said that we are investing 6,000 in X. We are investing what? 6,000 in X. So what is the weight? 0.3. Next to 0.4. What is next? 0.3. See why I am focusing unique model it is formula based. You want to learn that standard one or two questions. That is fine. Because we have around 120 questions, you don't want to go for under 120. But when it comes unique model, you have to go for unique model. This model only one question we have. So we have what? 4,000. What is the weight? 0.2. Next to 0.5. Then we have 0.3. Now you can able to get the total. See now you can get the weight. See 2,600 out of 10,000. Like that you can able to get the weight. If you go for weight, your weight of T is what? What is the weight of T? Can you please reply? 0.3. What is the weight of T here? 0.3. Here also 3. Both are 0.3. That is why here also 0.3. But here the weight are different, here the weight are different. So that is why here the aggregate weight are different. Now they are coming with one question. That is first part is over. Now second part is asking another question. If an investor invests 5,000 out of 10,000 in what? R. So weight of R will be 5,000 out of 10,000. It will be what? 0.5. They are asking what will be the weight of T and F. We know any proportion T will be what? 0.3. The reason is what? Both cases is what? 0.3. So weight of R is given in the question. Weight of T we understood it. Total weight will be what? 1. So weight of S will be 1 minus 0.3 plus 0.5. You will get what? 0.2. That is what answer is over. It's a unique model question. So in this unique model question, I will give you the question number, so which will be able to recall for you very easily. Question number 14. Example, unique model means what? No other formula you can able to get that comparison. Okay. Unique model question doesn't mean that a unique model question doesn't mean that that question is only important. That is, you don't have no formula for that. In your formula page, you don't have no formula for this. So this you have to revise separately. Formula revision will not helpful. See, this is another question, unique model, question number 40. Unique model, question number 40. How we did question number 40? I will allow you to revise now in this session. I'll give you some small session for you to revise. What is the question number 40? We will find out the portfolio beta. They were asking how much they have to reduce the beta should bring in. So this formula you might have been written in your page. That is what is the amount should bring in. So what is the amount you should bring in? Nothing but I think what is your value of portfolio divided by what is the desired beta into what is the existing beta. You have already written the formula. So if you already written the formula, there also you can mention question number 40. So that formula. So this is a one question. That formula you might have been written, but that formula having application only what? This particular model question. This will have particular model. See why this formula comes, because we know beta of government of India security, this risk-free security is what? 0. That is why we go with this reverse calculation. That is why we go with what? This reverse calculation. That is one reverse calculation question. Going next, another unique model that I will show you. This one, 98. This is multiple time previous year question. 98. What is this 98, friends? 98. What are the beta of Q stock? How can you get the beta? This is separate formula. In your beta page, you better return the formula. Change in stock by change in market. Change in stock by change in market. So what is the change in stock return? Change in stock return 38 minus 2. So 40 divided by 25 minus 20. You will have 20. So 40 by 20, you get beta stock for such is what 2. Accordingly, the next one also. You have next they are asking what is the expected return. This is a very good question. We discuss in the class. Very easy only, but this is a multiple time coming question. This is also a unique model question. This is also a unique model question. The next one unique model question, which recently came for your exam also. That is why the speciality of unique model. This one, question number 107, two-factor model. Question number 107, Two-factor model. What is this two-factor model, my dear friends? They were asking factor 1 and factor 2. We did lot of question on this. This is the last question we did on two-factor model. So they are asking, first one it is, if 1 lakh is invested, 50,000 is for Y, 1 lakh 50 we purchase. What is the same proportion? We discussed that. When you have 1 lakh, you sold 50,000. Put together 1 lakh 50 you invested. So for B part, we have learned what? You borrow 1 lakh. So already you have 1 lakh, you borrow 1 lakh. So total amount with you what? 2 lakh. So 2 lakh you will sell. If 1 lakh, if you sell 50,000, 2 lakh you will sell what? 1 lakh. So 2 lakh you will sell 1 lakh. So total amount in your pocket you will get what? 3 lakh. If you ended 3 lakh, you will invest in what? X. So the answer will be what? X, your amount will be what? 3 lakh. For Y, you will sell 1 lakh. RF, it will be what? 1 lakh. If you take the total amount in the beginning will be what? 1 lakh. This will be the weight you have written. This is a very, very good question, which is also a recent previous year question. So this is how the point you have written. In this weight, you got it. Once you get the weight, this is why I'm telling second part. Second part only students will have doubt. First part is easy. So this is how you have to get the weight. Now you can go for factor 1, factor 2. Factor 1 they have given. Factor 2 also they are given. You have to approach it. So these both are what? Unique model question. These are all what? Why it is called unique model, my dear friends? Because you can't, if you learn that earlier formulas and all, in that formula there are multiple questions are there. In this one or two question only in this area. That is why we call it as what? Unique model question. Clear? Now let me tell you some other point. Apart from that, for a safer zone, we have learned one more concept called a asset beta or a firm beta. For a safer zone, we have learned what? Asset beta or a firm beta. What is asset beta or a firm beta? One simple formula only. Asset beta or firm beta is nothing but weight of equity into beta of equity plus weight of debt into beta of debt. If question is not mentioned, beta of debt will assume it as what? 0. Beta of debt will assume it as what? 0. We have discussed two formula with the tax and without tax. Without tax, now directly we can approach. But this, what is this weight? This weight is nothing but what is your equity? Here it is debt plus equity. This is what weight. You have written the formula properly. I know. Then when it comes for with the interest, what happened now? Wherever come debt, you have to put it as what? The same thing only. But wherever come debt, you have to put it as what? Into 1 minus tax. Those tax benefit will be there, you have to put it. This is what is called asset beta or firm beta. Mostly it will come for 2 marks. As if the current trend continues, it will come for what? 2 marks. For 12 syllabus, there was a question for 7 marks also, but mostly for you it will come as a 2-mark question. This is what is the area called asset beta and firm beta. You might have been written separately. In asset beta, firm beta, we have written some assumptions. What are the assumptions we have written? First assumption you might have been written that if 2 or more securities have similar risk pattern, the asset beta will remain same. That is one assumption. This is 2 mark relevant. Next, once the asset beta you find out, any change in composition of debt equity mix will not change the asset beta. Asset beta will remain same. These are the two important assumptions you have to compute while taking for what? Asset beta. So these are, we have the main area in our portfolio management. So now what is our strategy is what? I just want you have to just revise this unique model question. Just revise the answer unique model question. By the time once you revise, then I will join. We will go with what? Random, as I told you. Now, revision point are over. That is our question area, concept area revision are over. Now we will do practice question. Now we will do what? Practice question. I told in each area, consolidate 1 or 2 questions, we'll take it. Then we will practice it. Now we have taken only 1 hour. So this 1 hour we revised everything. Now another 1 hour we will take what? Study material, we take what? Some additional questions, relevant consultant question. Our main intention is what? How to approach the main point. Since that is what first we will do it, practice it. Then we will do recent MTP and additional previous year question. That is what our strategy. Okay. So you can just go through this additional question, or you can just refresh the formula. Now you will also more familiar with the formula. You can also more familiar with the formula. Yes, now we are just practicing our question number 5. Question number 5 is asking return and risk. So we were first doing the return of risk of ABC. We were started doing the probability return. Now this probability return we know as what 12.55. Now you want to find out risk. So we know this question is what with the probability. With the probability in a root of sigma PD square. So PD square is we have. So we have to get what root of square root of 168. This number 167.75. That is. So now if you go for square root, you will get the answer called what? 12.95. See, very important point is higher the return, better the option. Higher the return, better the option. Lower the risk, better the option. Risk is low, is best. Return is higher, is best. So when you want to do sometime, we want to do the comment also. Next, you want to do for but if you say I'm not doing the risky again, but we want to do for the third part. What is the third part? Second part of this question. Same thing. You have to find out the portfolio. You want to find out the portfolio. How can you do this portfolio? Friends, here you don't want to go for portfolio equation alone. Here you want the proportion equal. So we have the data. So what is the shortcut method? You can just directly. We don't want to go for portfolio formula and all. Here we don't want to go for portfolio. Portfolio formula we want to apply if question doesn't give any data. Directly risk is given. Here data is there. So what you can do now, you can just go for a column called what? Return of a portfolio. What is the return of a portfolio? See, first one is 12, second one is what? 16. Weight is given 0.5 into 0.5. You know return of portfolio formula. A weight of security into return of security summation. So you have to do 12. 12 into 0.5 plus 16 into 0.5. So this is another method you can find out the risk of a portfolio. Same way you can do for remaining item. Next will come 12. Next will be minus 7 plus 28. Next, if I'm not wrong, 13. Correct? So this is what return of portfolio. Now our normal step only. You can go for what? Expected return of portfolio. So this is the another method you can find out the portfolio. When we want to approach the formula, that I will tell you on the next day. That is the next second model question. So we will find out the return of portfolio. Now, if you want to get the return of the risk of portfolio, same thing, deviation. How can you do return minus R? This is how you can. Now you can able to go for see deviation is there. You have to take the summation. Now you have to go for risk of portfolio consisting of equal weight that you can write equal weight. What will come? Square root of 6.69. See, that's all. This is how you have to get it. Are you clear? Yes or no, friends? This is how we can able to do it very fast. Next, they were asking what is the proportion of each stock to make a minimum risk of portfolio. For that, you have to approach our formula. We have two security, weight of ABC, so weight of A, variance of B, variance of B minus covariance of AB divided by variance of B plus variance of A minus 2 covariance AB. Here the problem is what? We got the variance. Variance is nothing but standard deviation square only. But the problem is what? We don't have the covariance. That covariance you have to find out. First you have to identify with the probability or without probability. Come on, friends. With the probability. So we have to do for the next security, that is security, one more we have to take. Am I going fast? Are you able to understand, friends? All of you able to recall, friends? Yes. So what is the return of XYZ? What is the return of XYZ? We have 16, 10, 28, minus 2. We can go for expected return. See, expected return. Actually, we thought of we don't do it, but for the second part we require anyway. See, there is a one more shortcut for getting this return. You go 12.55, you go 12.1, equal weight only. So this 12.33 you will get in another way. 12.55 into zero point 0.5 plus 12.1, that is into 0.5. If I do enter, I'll get the same 3. Here we have 325. Yes or no? This, if you get the return of true security portfolio, you can get it. You can, but we can't do that in this case because they are asking risk also. If they are asking only return of a portfolio, don't do this bigger table. You can get in a shortcut method. This you got it, this you got it. They are told what equal. But here why don't you why we don't end so far? Because they are asking risk also. So anyway, risk you have to get this data. That is why. Okay. Now you notice our deviation of x r minus r bar. So we are doing an experience for covariance also. Covariance also we are practicing in this question. So we done this. So we got. Now we can go for. Can you recall the covariance formula? Covariance formula I will recall for you. Summation of with the probability only. Summation of probability into deviation of x into deviation of y, whatever it is. So here I am doing everything into one line. Probability into deviation of a into deviation of x. So probability is the same. Deviation of x is this. Deviation of a we have here already. Since I am using Excel, I can take it directly. Are you able to recall this? Yes. So if I go through this, I am getting the data properly here, which is 509. This is what my covariance. If I want to get the correlation, correlation what is the formula? Covariance by standard deviation. So here in this question they are not asking correlation, but if you want we can do that correlation also. How? It's 508 divided by standard deviation of first security into standard deviation of the second security. The question is not asking the correlation, but we did the correlation for this, which is no. This into this. Once again, here probability we are not done. This is one small correction in this risk calculation. We got probability, we got return, so we got deviation r minus r bar. Not that reason. Okay, okay. Why this different? Because this is portfolio. We should get risk of what? We should get risk of. Can you just tell me? You might have already written the risk. What is the risk of XYZ? You might have already computed. What is the risk of XYZ? 11.27. The reason, because why I put this error, because we know correlation coefficient will come within +1 to -1, but we are getting some 33. Why it is wrong? Because I have taken correlation standard deviation of x, but for y purpose I wrongly taken what? Portfolio, because we don't find out the security. Now you just see this correlation. What is the correlation coefficient formula? Covariance divided by standard deviation of security into standard deviation of second security, which is 11.27. This 11.27 we were not dead because time saving purpose we thought we'll do for one security. So that is the reason. Now, just for understanding for you the correlation concept also we are doing. So we are getting once again. Here, what happened it is, when I'm taking the Excel, I will just, this is how, whenever if you make mistake, that is also there's a shortcut for you to get, whether you get the wrong or not, if you're correct in concept. Probability into deviation of X I have taken correctly. For deviation of A, I should take this column, but I have taken wrongly this. So this is how. That is why in the beginning of the portfolio chapter, I told one area, if you do one mistake, everywhere you will get a mistake. Are you understood? So that is why you have to do proper practice. So I'm just putting enter. Now I am just taking the scroll down. This variance will change 144. See, now I am getting this answer correctly. What I'm getting 0.988. Is it coming within +1 to -1? Yes. The point is what? It's a offsetting vector. இது இங்க பார்த்தாலே தெரியும். இங்க பாருங்களா, here minusனா இங்க plus, இங்க plusனா இங்க minus. That is why we are getting an offsetting return here, minus 0.98. Are you able to understand, my dear friends? So this correlation coefficient they are not asking at all. Correlation question they are not asking at all, but we are doing that practice also in this question for a better understanding. Now we will go for this area. Weight of A is equal to variance of B minus covariance AB. Variance. So how you will approach, my dear friends? Variance of B. Variance of B means just now only we did this variance. Okay. This variance also GX square. This is what variance. It's total. Before taking square root, that is what variance. See, this is the variance. What is the variance, friends? 126.99. Yes or no? 126.99. So we are doing that. 126. This is the homework question we did in the class. We did in the class. Yes. 126.99 minus covariance. What is the covariance? See, here we getting covariance of minus 144. Minus will become what? Plus. Minus will become what? Plus. So you will get what? Plus 144.26. Then again the step starts. Variance of B. What is the variance of B? Now only we find out 126.99. 126.99 plus variance of A 167.75. Now minus only, but you have to multiply with minus. Minus will become what? Plus. So 2 into 144, which will come 288.52. If you do this, what you will get the weight of A, friends? It will be 126.99 plus 144.26 divided by 126.99 plus 167.75 plus 288.52. You will get 0.47. Or you can take decimal if you take 0.46. Now, what is the weight of B? Balance. Weight of B will be 1 minus. Hope all of you are clear. Hope all of you are clear. So, this is a question where we were applied which all the concept, how to compute risk with the probability, then how to compute the risk of a security, how to compute risk of a portfolio with this kind of method. This is a method one. This we have not written any formula. It is a formula we don't written at all. Then we are also find out correlation coefficient. We will find out covariance. We are also discussed that optimum way. That is why one question you are calculating everything. You might have been written when they have selected wrong column. My question get what? Error. We know that correlation coefficient plus or minus it should be, so we identified it's a error, but sometimes it will not work out. Covariance if I taken wrong, I can't identify because the covariance if I taken wrong, it will be plus or negative. Any number can be. There is no clue. So don't think that always you can check whether you are getting wrong or so. How to practice, then you can be able to eliminate the errors maximum. Yes or no? Shall I proceed next? Shall I proceed? So if you are time permit, you can also parallelly practice also, or it is your wish. Okay. But my point is what? To make you understand the concept how to approach. Now we'll go for next one question. Next question, case 2 model question. What we will do now? Question have all the data. We will just go for it. How? This question number 9. What is the point, my dear friends? European has been specifically formed to undertake two investment opportunities, risk and return as given below. See, the question itself is risk and return is given. What is the difference between previous question and this question? Previous question, risk and return is not given. We only find out. This is second model question where we may find out what? Risk and return. Here, risk and return is given in the question itself. The weight also given 80% and 20%. Then correlation is what? 1. Then they are asking return of the portfolio, risk of the portfolio. Here you have to approach the formula. You can't go for table method because if you want to get table method, the full data must be there, yearly or probability data. Then you have to do forward the formula method. Are you ready, friend? So for me, I can able to do very fast. What can we go for it? First, you can go for return of the portfolio. We are expert on return of portfolio, weight of security into return of security. So 12 into first security weight is what? 0.8 plus second security weight is what? 0.2. So what will be the answer, friends? 13.6. This is how you have to get. Next, you want to find out risk of portfolio. How can you get risk of portfolio, my dear friends? You have to go for square root of. We'll do everything directly the formula. Weight of A, which is 0.8. Weight of A is what? 0.8. You have to multiply with the risk of A. What is risk of A? 3. See here, you can give directly 3 itself. If you give 0.03, then everywhere decimal mistake will come. You can give 3 itself. Final answer you can go for what? Percentage. So 3 whole square. Next weight is 0.2. What is the risk difference? 7 whole square plus 2 into weight 0.8 into 0.2 into 3 into 7 into correlation they said what? 1. Now you can able to approach. See what is the first item total? 0.8 into 3 square. What you will get? 2.4. No. 5.76 plus 1.86 plus 1.96 plus 6.72. If you take the total, this is what method 2. Okay, final answer. What is the final answer? 3.8%. This is how you have to find out the risk of portfolio. Method 2. Correct? Now, what is happened next, my dear friends? Suppose the correlation coefficient is -1. What is the company to obtain? 0. Just now only we did it. But the problem is what? Previous question we did to minimize the risk, where covariance we find out with the formula. First formula with the probability. Here we ought to do second formula. You can't go for the first formula. What is second formula? You have to go for covariance. Covariance you have to go for, that is correlation of two security into, they are given data, which is what data they given? Standard deviation of A into standard deviation of B. That is -1 into 3 into 7 You have to get minus 21. That means you have to apply different formula. Previous question you did what? That is with the raw data you are getting. Here already standard deviation is there. With the standard deviation you are getting. Correct or not? This is what we need practice. Your application will keep on changing. Are you clear, friends? Now you can apply the formula. What is the formula? Weight of A is equal to B. 7 square. Minus minus will become what? Plus 21. You will have 3 square plus 7 square plus 42. 49 plus 21 divided by 9 plus 49 plus 42. You will have, if I am not wrong, 70 by 100. You will get 0.7. So weight of B will be what? 0.1. See how interesting? Are you able to get it? This is what case 2 mode. This is what case 2 mode for optimism. Yes or no? So this question also over. See now what is this question number 10? We are not practicing. I'm just telling you. See here the same data return is given, standardization is given. There is proportion of investment to minimize the risk. So what you have to do? You want to do the same step. Covariance you have to apply. Then you have to apply this formula. That's all. This data of return is given for confusion. This data is given for what? Confusion. You want to apply only this 18 and 15. Just now we applied. Are you able to clear? Yes. Here also this is also same point. This is also one of the previous year question. They were given 5 situation. Risk is 3 and 9. Just now in the question we did what? 3 and 7 with a correlation of -7. Here what? Situation 1. You have to assume correlation coefficient is what? -1. You have to go for minus 0.3, 0, 0.6. Like that you have to change in each situation. So each situation covariance is not given. Everywhere they are asking what? What is the proportion for minimize the risk? So you have to approach our formula called the weight of B square, that is variance of B square minus covariance AB divided by variance of A plus variance of B minus 2 covariance AB. So how you have to approach? Covariance is not given. They are given only what? Correlation. For each case you have to find out what? Covariance. How you get covariance? Correlation into standard deviation of 2 security you have to multiply. When you do this question, the last method is 0.6. If I am not wrong, you will get greater than 1. You get greater than 1. You can check your answer. So if you get greater than 1, what is the meaning, friends? You can't diversify. You can't diversify. You can't diversify. That is how the question. Are you clear? So we are able to. These are all same points. See this question number 13. If you take your notebook, see the first 2 parts. இப்போ நம்ம டிஸ்கஸ் பண்ண அதே மெத்தட் தான். A and B இப்போ நம்ம டிஸ்கஸ் பண்ண அதே மெத்தட் தான். ஆனா C ஒரு reverse calculation. Can you just take your notebook 13? What is 13 happening, my dear friends? 13 எடுத்துட்டாரா? So hope all of you taken the 13 question. 13 question. Let's C part. A and B same thing. C part what they are asking now. If correlation coefficient is -1. No. This 13 same question only. What is the how the company should obtain? No, this is same model only, not 13. Let me take another one. Yes. This question number. Question number 18. What is this question number 18, friends? This only reverse calculation. See, they were telling, suppose the third part only we are solving now. Third part only we are doing now. Suppose the investor want to reduce the portfolio risk to what? 17. They want risk to what? 17. What is the correlation they have to bring it? That is risky, you should get what? 17. So you might have been written this. Your final answer should be what? 17. Then you have to do what? Enter in formula. You have 30 and you have 26. What is the weight? Equal proportion. What is the proportion? Equal. So you have to go for it what? 0.5 into 30. First two part is risk and return, we know already. So 0.5 into 30 square plus 0.5 into second security, what is the risk? 26 square plus 2 into 0.5 into 0.5 into 30 into 26 into, here we don't know. This is how you have to. We don't know correlation, that you have to put it as X. We don't know correlation, that you have to put it as X. Are you clear, my dear friends? Now you have to go for the formula 17 square is equal to. If you put 17 square in the series is equal to. If you put 17 square. So what is the first answer? 225. 2, next one 169 plus 396, 390 correlation AB. So if you solve this, you will get correlation AB as what? Minus 0.27 or 269. Are you understood? So this is another method of what? Reverse calculation. This is another method of what? Reverse calculation. Are you clear, friends? Yes. Shall I proceed now? Good, thank you. Now, if I am proceeding now, I will go for this question number 16. See, I think question number 16 I have given as a homework for some batch. So question number 16 is a homework. What is question number 16 difference? Question number 16, you have three security. They are asking what is the risk. So you have to approach the formula of what? Three security. You have to approach the three security formula. So what is the three security formula? The same thing. You have to go for what? Root of. We have three security A, B, C. So here you have to approach three security formula. First security, this weight is what? 0.3. Standard deviation is what? 8. So you have to go 0.3 into 8 square plus. Next one 0.5 into 12 square plus 0.2 into 6 square plus. Now you have to go for 2 into. First they are giving here AB. So we'll go for AB. 2 into 0.3 into 0.5 into 8 into 12 into correlation they have given in the question 0.5. This is for only for first one. Now you have to do for next page. Second one. What they are going next second one? AC given. The same order we will go for it. So if it is a AC, so I think in the regular class I given this as a homework. Now I am solving because I want to revise all this area for you. So what will be then here? 2 into AC, so 0.3 into 0.2 into 0.3 into 0.2 into 8 into 6 into minus 0.4 plus 2 into 0.5 into 0.2 into 12 into 6 into 7.5. This one. If you solve this, you'll get a final answer what? 8 point. This is how. 8.13. Okay. So this is how. This is the third one. That is two security. Now this what? 3. See how and all we find out the risk of portfolio. First method we revise is what? They given detailed A, B. Weight is given. So we made it weight and accordingly we applied. Second method already risk weight is given. So we applied to the formula called 2 security. Next we did now what? 3 security. Are you able to recall now? Yes. Now we will be able to go for this. One of the previous year question 17. I'm not doing this, but what they are asking is they were given correlation coefficient as 0.16. They are asking what if 5 situations are there. Each situation what is the risk and what is the risk and return, and which is best in terms of return, which is best in terms of what risk. We know higher the return, better the option, lower the risk, better the option. So all funds in M, all the funds in M, no problem. What is M return 20? That will be the, what is the M risk that will be? Now 50-50. So 50-50, how you know? 20 into 0.5 plus 25 into 0.5. For risk, you have to approach our main formula. Root of weight of A into weight of A into standard deviation of A whole square plus weight of B into standard deviation of B square. I think you have that. So it's also a previous year question, relevant question. So I think you can able to approach this. We did the same model now revised it. So this is also the same point. Are you clear? Yes. Now இது வந்து இப்ப இருக்கிற நம்ம ஃபார்மேட் வந்து ஒரு 7 மார்க் கொஸ்டின் 14 மார்க் மாதிரி கொஸ்டின் வந்தா இந்த 20 மாதிரி கொஸ்டின் வரும் 20 question 20 question is consolidated question 14 mark. First we do the what is the return, then we find out the risk, then next year what is the return, then next year what is the risk, then we find out the risk of portfolio. We did this little bit last portfolio was ending other scope. So this is also good question, but if this will come, if it is a 14 mark, they want to test you. If they want to test you on a 14 mark, if they want to test you at 14 mark. Are you clear, my dear friends? Yes, same thing, not a new model, but it's a same thing. These are all direct questions. Directly we are asking correlation. These are all directly we are asking. Now, this is another previous year also came on this 23. A very good question. Very good question, 23. Shall we discuss 23? Very point 23. Are you ready, friends? Yes. 23. A study by a mutual fund revealed the following data: PQR, standard deviation, correlation of stock with market. Index is another name for what? Market. They were asking standard deviation of market is what? 18. What is the sensitivity of the stock with the market? Sensitivity of the stock with market is called beta. So beta கேட்டிருக்கு பீட்டா எப்படி அப்ரோச் பண்ணுனா full formula இங்க வராது beta means standard deviation of stock divided by standard deviation of market into standard deviation correlation of stock with market. You have to go for this. இது வந்து ரீசன்ட்டா ஒரு previous year question last exam கூட வந்ததுனால we'll just do it very fast. So you can do, you understand very easily. So beta of P, beta of security P எப்படி வரும்னா standard deviation is 20, standard deviation of market is 80 into correlation. எவ்வளவு correlation வருது 0.66. அப்ப நமக்கு எவ்வளவு வரும் beta of portfolio? எவ்வளவு வரும் 0.73. Next QR. Yes, beta of Q 18 by 18 into correlation, which is 0.95. We'll get an answer called what? 0.9. Are you able to understand? Next, beta of R. QR 12 by 18 by 0.75. இது ரொம்ப ரொம்ப இன்ட்ரெஸ்டிங் கொஸ்டின். லாஸ்ட் எக்ஸாம் வந்து எல்லாமே கேட்குது 7 மார்க்ஸ் தான் வந்து, so they ask 3 or 4 only, but we'll discuss everything. Clear? So this is how you find out the beta. Am I able to clear? Yes or no? Yes. What is next? Covariance among the stock. See there, you can't approach this. Here you want to do the new formula we were discussing, because among the stock they are asking. So you have to go for covariance if you want A beta, variance of market into beta of A into beta of B. You have to approach like this. Then only you can get the covariance. Covariance among the various stocks. Some friends may be thinking you can go with correlation. No. Your question they are given what? Correlation of stock with market. But they are asking now correlation among the stock. So you have to approach this formula. That is covariance, standard deviation of market into beta of A into beta of B. So if you approach this, 18 square will come into beta of A 0.73, beta of B 0.95. What is the answer, friends? AB in the sense it is called PQ. You might have already, the answer will be there, friends. What is the answer? 225.6. Are you able to understand? Am I going fast? புரியுதா friends? இந்த மாதிரி questions பார்த்தா you should understand how to approach the formula. Next, if you go for covariance PQ na, P will come 0.95 PQ. PQ. PQ is over. Now PR. 0.95 P means 0.73 into 0.5. What you will get? 1126. Are you able to understand? Yes or no? Now next they are asking QR. Next they are asking what? QR. So QR what will come? 18 square into, we have again Q. Q na 0.95. R na 0.5. What you will get? This is how you will find out the covariance. Yes or no, friends? Are you able to follow? This is how you will find out for QR. Now we will go for risk of among consisting all stocks equally. That is only now we discussed the same formula will go equally. Now you can go 1 by 3. You can go for what? 1 by 3. You don't go with 0.3 because 0.3 into 0.3 will get 0.99 only. You want to get total as what? 1. So you better you go 1 by 3 into, then accordingly you can do. Then you will get the same answer. So now only we did it for 3 securities. If I am not doing, so if you approach the formula, you will get standard deviation of portfolio as what? 14.3. புரியுதா எப்படி வருது? Logic clear? Already for this, if you want to find out this, you should get correlation. You should get what? Correlation. Correlation எப்படி கிடைக்கும்? Already we have covariance. Already we have what? Covariance. So இந்த covariance வச்சு நம்ம correlation கண்டுபிடிக்க முடியும். எப்படி? So இதோட correlation எப்படி வரும்னா 225.6 is the covariance. So PQ. So P யோட standard deviation எவ்வளவு இருக்கு? 20. Q யோட எவ்வளவு? 80. So you have to multiply 20 by 80. What is the answer, friends? This is how you have to find out correlation coefficient. Am I going fast, friends? Now, they are able to recall a very standard question. So, what is the answer, friends? 225.6 divided by 20 points. 0.625 or what are 62. So, like this, you have to find out for, because if you want to do standard deviation approach, you should get a point called what? That area. Yes or no? Are you clear? Now, next what you have to do is beta of portfolio consisting of equal weight. Beta of portfolio consisting of what? Equal weight. This is your beta. So equal weight now 1 by 3. You can take shortcut method. 0.73 plus 0.93 plus 0.5. What is the answer, friends? You have to take all the three and divide. 0.726. This is one shortcut method which I have done. Or you can do proper method. 1 by 3 into 0.73 plus 1 by 3 into 0.95 plus 1 by 3 into 0.5. That is also you can able to get, but final answer will get always what? 0.726. Yes or no, friends? Good. So this is the another method. Let's finally total. Total means you have to do what? Variance approach. They are asking systematic risk and unsystematic risk. So systematic risk and systematic risk we know. We got beta already. What is a beta, my dear friends? 0.726. Now you have to do, I am doing the first method under variance approach. Systematic risk is equal to standard deviation of market, which is 18 square into, you got the beta, what is the amount? 0.726. You have to take 0.726 square. Why you take this square, my dear friends? Because the word is called total. We are doing what? Total approach. What is the 18 square, friends? 324 into 0.726 into 0.726. What you will get? 527. So if you do this, what is the answer for systematic risk? 17 0 point. Now, very important. If you want to do unsystematic risk case, we are doing variance approach. The formula is what? Minus systematic risk. So you should find out what is this answer. We got the answer here, which is 14.394 P. So you have to take 14.39 square. What is 14.39 square, friends? Sorry, 207.07 minus 170 minus 170.74. What is the answer? 36.33. So, my dear friends, this is how you have to do what? Unsystematic risk total approach. Paka. So, very, very important. This is how you have to do what? Unsystematic risk. So, we did both the method. So, very good question. It's a recent previous year question. It's a recent previous year question. Shall I proceed, friends? Okay. So, this is a question for what? Characteristics line question. This is a question for what? Characteristics line question. So I will take little smaller question for characteristics line. We'll take later. See this question number 28. We did the same point. Again, number changing is repeating. Now I will do that same. In this question itself, we will do characteristics line. We'll do this question itself, characteristics line 24. How you will do characteristics line, my dear friends? We have A and we have market. We know Y is equal to A plus BX. We have Y is equal to A plus BX. Characteristics line 16 syllabus regularly came for exam. 22 so far not came, but 16 syllabus it came regularly question. So period. We have 1, 2, we have up to how many periods are there? 10 periods are there. We have two column will be there. First one, it is return of A. Can anyone tell what is the return of A? 22, 20, 28, 16, 28, minus 6, 5, 6, 11. See, now we are doing another method. Tell my dear friends, this is year or probability is given. Year or period is given. No probability. So what is the method you do find out return here? Sigma R by L. Previous both example probability. Here we are doing with what? Period. You have to take total divided by number of period. How many number of period, friends? 10. So you will get the number called what? 13. You will get the number called what? 13. Now you can go for, see, you have to understand, you are asking characteristic line only, no beta. But what we will do now in this question, we'll do a beta also asking. For beta, what you require, friends? Beta you require variance of market, covariance divided by variance of market. For covariance, okay, so we'll do covariance. So we have deviation of A. What is deviation of A, friends? Here, this is your R. Here, you don't want to go for two R, confusion not there. Here only one R. So this R minus this 13, this is what deviation. Here, this is the reason lot of students will get errors. See, in this method, this column, that is, if you want this G column answer, you are taking data from where? F column. But the problem is what? If you want in this question, if you have gone through here, if you want deviation, you are not taking from H column, you don't taking from G, your column from what? F column. This is what lot of students are making when you are conducting class test. Only few students are participating, but when you are conducting class test, lot of students are making mistakes here. That is, for probability, you have to take this return. That is the simple point. Return which is given in the question you have to take. R minus R bar, you take question which is return which is given in the question. Actually, this is 12 only given in the question. This 2.4 is expected only. You should not take that. I have already highlighted the reason it happened mistake because in period method, next column you will take, but probability column you take what? Next to next column. Since I am using Excel, for me just to scroll down. Here they are not asking anything about other than anything. So we can end with this. See what we will do now. We will do in this question systematic risk also. We will do in this question. So we learn everything here itself also because there are questions in this that they will ask what? This is systematic risk and unsystematic risk. They will ask you systematic and unsystematic. I think we did in the class also. Am I going fast, friends? No. If you want to do systematic risk, you should get a Standard deviation of stock also. So we'll do the standard deviation of stock also. Deviation of A square. What is deviation of A square? See, now we are doing stock risk, risk of stock on the base of year. We discussed right now one method called risk of stock on the base of probability. Now we are doing on the base of what? Year. Year, what you do? No, there is nothing called a PD square. Here, D square by year. So you have to take the sum total, then you have to divide by what? N. What is your NA? 10. So now you can get the standard deviation of A will be square root of only what? 91.6. This is so. That is, you don't have nothing to multiply with what? Probability. This is what? No, this is return of A. This is A. This is market. Okay. My friend A is given a column for market only. Anyway, no problem. This is return of market only. So anyway, don't worry. He know that we require variance of market. So he given that we can just exclude him. So this is market. Anyway, we require this variance. So now we'll go for return of A. What is A? Can anyone tell, my dear friends? A data 18, 20, 24, 26, 18 minus 5. Yes. 17, 17, 9, 17, 9, 19, minus 7, 20. The same thing. Here also what you have to do now, your return will be sum total divided by 10. So here what you find out is return of market is 13%. Return of stock is what? 15%. Now you can go for deviation of stock. What is deviation of stock? R minus R bar. The same thing. So we can able to. Here we are doing without a probability. Now deviation of stock square. You have to take the sum total. This is what? Variance. This is what? Variance. Now you can go for each data. Are you ready, friends? First we will go for beta of security. Beta of security, here we can go for shortcut method, where covariance of stock divided by variance of market. So covariance, I will do one column, deviation of A into deviation of market, deviation of market, deviation of A. So this is the column. We have to take total divided by N. So you will get 42.5. So covariance is 42.5 divided by, you get variance of market. Variance of market, we got already 91.6. If you do this, 42.5 divided by 91.6, you will get what? 0.464. Small decimal correction may be there based on the numbers you round off. Since I'm doing Excel, I get the correct answer. I'm going fast. Are you able to get it? So beta, they are asking first, we got it. In the question, they were asking first beta, we got it. Now we have to go for characteristics line. We know characteristics line formula. What is the characteristics line formula? Y is equal to A plus BS. What is this Y? Standard deviation of stock, which is we have already found out 15. What is A? We don't know. We have to find out. What is the B? B we have find out 0.464. X is market, which is 13. Now you have to apply. You will get A called a 15 minus 13 into 0.464. What you will get? 5.98. So you'll get A factor as what? 9.02. Now, how you have to return this characteristics line is, you have to return this Y is equal to 9.06 into, what is the beta? 0.464B. This is the characteristics line. If they ask only characteristics line, this is the answer you have to return. This is the answer you have to return. So keep on your beta changing. your return also will change. A is what? Alpha constant factor in this case. Are you clear, friends? Am I clear? Hope all of you are clear. Some friends are little fast, so they are giving me the answer little fast. Some friends are little slow, so they may be how to recall it. That is why I'm just giving some little more time for you to recall. A standard question. Shall we proceed the third part or little bit wait? Okay. Any doubt, my dear friend? Okay. We'll proceed. Okay, friends. Yes. Now they are asking systematic. We told one question everything. Systematic and unsystematic risk. We know standard deviation of market. What is standard deviation of market? We do standard deviation approach. Already we did one variance approach. Now we do one standard deviation approach. So we'll go standard deviation of market. We know what is the variance of market. This is what variance of market. If I take the square, this is what. So we'll go for the square root. The standard deviation of market is what? 9.571. Now we can go for beta formula. B systematic risk is equal to, what is the formula? Standard deviation of market 9.571 into beta of stock. Beta is 0.464. What is systematic risk, friends? So in this question we are not asking, but we are learning everything in one question. 4.44. Now we will go for unsystematic risk. What is unsystematic risk? Reverse way. What is unsystematic risk? Reverse way. What is the standard deviation? So standard deviation of stock. Standard deviation of stock is nothing but square root of, we have what? This one only, correct? This one. Square root of 117 is 10.84. So what you will get? 10.84 minus 4.44. What will be the answer? 6.39 or 40. This is how you will get it. Are you clear? So if you want to get unsystematic risk, first you should understand, you have to find out what this 10.84 you have to find. That is why we did this column additionally. Are you clear? So one question, all the consolidated data we are there. You will find out how to find out characteristics line, how to get standard deviation, how to find out systematic risk, how to find out unsystematic risk, everything. Yes or no? Are you able to understand? Now, this is one a standard question, a recent previous year question, a very good question. I'll show you. This are already discussed. Yes, this one. Here only we do reverse calculation 28. So you can take your notebook answer also for a little bit time saving purpose. Okay. 28 is a very good question. You can also, since this came recently, one previous year question, I don't know if it will come again, but it's a very good question only. Shall I start, my dear friends? Here come the reverse calculation. Here come the reverse calculation. Shall I start? I hope all of you have the data. Here, everywhere they are taken decimal. So we taken decimal also. Question number 28. Are you taken the answer? Yes or no? 28. Because it's more data is there, so we'll have a revision. Okay. So 28, they were given each security A, B, C, three security only they given. Weight is given, beta is given, expected return, total variance is given. Variance method. So if the variance is given, you have to go for what? Variance approach, total variance. Total variance. Standard use of the market is what? 10. See now, very, very important. Here variance is given in decimal or in percentage. Variance is given in what? Decimal. Where market is given in decimal or percentage. So both will not work. You have to follow anything one. So here in the majority of data is given decimal. So we have to convert market also in decimal. Otherwise, you have to convert everything into percentage as you wish. In the class, we did market into decimal. So 10% we convert into what? 0.1. Now we'll go for your given the data. Covariance of AB is given. Covariance of AC given. Covariance of BC is given. First, they are asking what? Portfolio beta. Portfolio beta is a very easy. How can you do portfolio beta? The weight is there, beta is there. You just multiply. 0.4 into 0.2 plus 0.5 into 0.5 plus 1.1 into 0.3. You'll get the answer. What is the portfolio beta? You got it. 0.666. Next is residual variance of each of the three shares. Here come the main point, my dear friends. Residual variance is another name for what? Unsystematic risk. Residual variance is another name for what? Unsystematic. This is for each of the shares asking. So how you have to do now? Total variance is given in the question. Very, very good question. Total variance is given in the question. So step one, we find out systematic risk. Step one, we find out what? Systematic risk. For that, what you have to understand first is, here the variance is given what? Variance approach. So systematic risk also you have to find out in what? Variance approach. So you might have been done first one. Beta you taken square. Beta square you might have been done. What is the beta square? 0.4 into 0.4. So how it will be? If you want parallel also, I'll just make it. So we have A, B, and C. The beta is given in the question. What is the beta? 0.4, 0.5, 1.5. So if you want to do variance method, you have to go for what? Beta square. You want to go for what? Beta square. So I have taken the beta square. Now, once you did the beta square into variance of market, so you can go for unsystematic risk. You can go for what? Unsystematic risk. Variance of market is 0.1 into 0.1. What is the 0.1 into 0.1? 0.01. So you will get the answer called 0.016. Yes or no? Now this is for one security. This you have to take for what? All the security. Now this is variance approach. This is systematic risk. This is what? Systematic risk. Now the question is given total variance. Total variance is given in the question. What is the total variance? Which is 0.015. 0.025. 0.1. So what is the residual variance or unsystematic risk, friends? This is your total. This is your systematic. If you minus, this is what is called unsystematic. This unsystematic is under variance approach. So this part is over. Next, they were asking portfolio variance under sharp index model. How you did this now, my dear friends? We have two methods. One is Markov. So sharp index model, we have to do what? This is your answer. This is what you have written in your formula. You can just go through. Risk of a portfolio is equal to systematic risk plus unsystematic risk. Systematic risk plus and now they were asking portfolio variance using sharp index model. So portfolio variance. This is what stock only. So now you have to do what? This is under variance approach. This is under variance approach. So you have to do what? Weight of square. We have to take what? I will take weight one column, then weight of square. What is the reason we taken weight of square? Because when you do variance, everywhere you have to take the effect square. Weight is given in the question, which is 0.2, 0.5 and 0.3. But if you want to do under that method, you have to take what? Weight square. Now you can go for Unsystematic risk of a portfolio. Unsystematic risk of what? Portfolio. What is unsystematic risk of portfolio? Weight into unsystematic risk. Weight into unsystematic risk. If you take, this is your unsystematic risk of portfolio. Very good question. Under variance, unsystematic risk under variance method. Okay. Next, you want to do what? Systematic risk of portfolio. Systematic risk of portfolio, very easy. Now only you just find out the beta of portfolio. What is beta of portfolio? 0.66. Can you tell beta of portfolio? 0.66 square into variance of market 0.1 square. Variance of market. If you do this, can anyone tell what is the systematic risk of portfolio? 0.66 into 0.04. Small decimal will be there. Now you are getting your final answer. Portfolio variance. Portfolio variance. A portfolio variance, how you got it? Systematic risk plus unsystematic risk. Now, if they ask a standard deviation, they are not asking standard deviation. What you do? You take the square root. You take the square. If you take in percentage, this will be 13.57%. Like that. Are you able to get it? So this is how you have to make it. Are you understood? This will be 184%. So this is how a very good question, my dear friends. So you should be able to understand it very well. Yes or no? This is what we have did in the first method. How to do systematic risk and systematic. So what I'm telling is, when I'm doing this question in the regular class, I did similar model 2-3 questions. So you want to identify which one of the together question and you have to practice it properly. Clear or not? It's a very good question. You have to understand. This is how we have told that how to find out under sharp index model. Are you clear? This you written the formula. This is a very good example for you to revise. Very good example for you to revise. We did few more questions also. Yes or no, friends? Yes. In the drive, we have added, if you are old batch students, in the drive, we have added few more additional questions recently. You can go through in portfolio management. We are added it few more additional questions recently in the drive. So you can able to go through that also in the drive. Okay. Now on this concept. Now going further, we have last one method called it modern portfolio theory by what? Markowitz. So, my dear friends, if this is the modern portfolio under Markowitz, our normal big formula only. But in exam, you have to do in a table method. Exam, you have to do in a table method. I hope you can able to recall. We written like this: weight of A, weight of B, weight of C, weight of A. So now, how we go weight of A, weight of B, weight of C. Correct? Are you able to recall? How you will do, my dear friends? You might have been done this. You have to go for here weight of A, weight of A. Both are together. So your formula will be what? Weight of A into weight of A into weight of A. So you will take what? Covariance. You taken what? Do you have the table, my dear friends? Will you make it? That is standard deviation of A, standard deviation of B, standard deviation of C. How you written? I have that pen. Same thing. Weight only, na? Correct? Now you have to take it. There are three areas. Let me highlight it. Here, here, here. What is speciality there? Both are shortcut. I am telling. Both are what? Variance. So in this column, your formula will be weight of A into standard deviation of A whole square. But when it comes here, what you have to do? Weight of A into weight of B into covariance of AB you have to approach. This is the only point. Correct? Yes. Next, what you have to do for this area, friends? Weight of A into weight of C into covariance AC. This is how you have to approach. Am I correct, friends? So if it is same area, if this area, how you will do? Weight of B into weight of B into there is no covariance. Right? There is no covariance. Both are same. So there is no point of what covariance. If you do this, you will get the final answer. I hope you have did this. Correct? In your book, you have already done this. Shortcut only, I have just told you. This is if they ask this question, then you have to do like this only. So we'll continue the discussion. So this is however very standard question. We have similar few more question like that. So this is an example for what? Our CML method. This is an example for what? CML method. What is the CML method? A portfolio fully diversified. See the point? Fully diversified. Standard deviation 6, Nifty is 16.5. Accepted expected return. See here RF is not given. 5.800 is selling at what? 116. So how you do this? One part alone we will discuss now. Here you want to do first RF. How to do RF, friends? 100 rupees 5.8. Your interest is 5.8. But trading value is 116. So your RF will change. Yes or no, friends? 5.8 by 116 into 100. We will get an answer called what? 5%. We'll get an answer called what? 5%. Now you have to go for lambda. What is the lambda formula? RM minus RF. What is RM, friends? RM is Nifty, which is 16.5. RF, just now we find out by standard deviation. So RM is 16.5, 5 divided by 4. You will get lambda. What is the lambda? 2.87. Now you can go for the answer directly. What is the return under CML, friends? RF plus lambda, which is what? 2.875 or 87? 2.875 into for that particular standard deviation. The portfolio has a standard deviation of what? 6. So you have to multiply. You will get the return under CML. The same way only remaining thing. These are all are CML only. 31. They are asking to find out what? Lambda. So the same method of lambda application only in all the case. 31 is lambda. These are all the same method. These are all basic question. How to compute the beta. See, these are all we discussed now. Beta, characteristics rate, systematic. So these are all one standard question we do. We are able to see. We discuss correlation coefficient beta, total risk and systematic risk. So all we discussed the method. See, this weightage also we discussed. Now going further, these are all the same point only. So these are all method we have discussed here. Here we have to find out the return on the basis of return, which is getting higher the return the stage, lower the risk is. These are all normal problem. Find out the expected return. Here return is given. They are not given the weight, the amount only given. So you have to take the sum amount, then you have to convert it to weight, then weight into return, then you can find out the expected return. These are all normal question only. If you revise, you will be able to get it. Again, here comes the next question. They were asking what is the expected return. Same model question only. Now, they're all same. Here they are asking beta, same model only. Now here onwards, they were asking that that our intrinsic value concept. They were giving standard deviation is 5a, correlation is 0.8a, market standard deviation is 0.4. These are all relevant for 2-mark question. Return of government 5.2, market is 5.2. They want to know what is the return. So for the return, you have to approach CAPM method. For CAPM, you should find out beta. Beta is not given. You have to find out the beta. How you have to find out the beta? Standard deviation of 5 is given for the stock. Standard deviation of market is 4. Correlation is what? 0.8. So beta, what is the formula? Standard deviation of stock divided by standard deviation of market into correlation. You'll get the beta. Once you get the beta, RF is given in the question 5.2. Beta you find out, RM is 9.2. You will get the return under CAP. That's all. This already we discussed the beta characteristics line concept. Yes or no, friends? Going further, these are also we discussed beta, characteristic, systematic risk, and this floating and all will not come for your exam. Graph paper and all they won't give you. Here also the same thing, expected return, systematic risk. Here come the point. See whether the stock is underpriced or overpriced. This is only we discuss the point arbitrage. So for this, what you do now 62. If you have the notebook, you can also take it. See the point is what you have to first to find out the beta. First you have to find out the beta. Once you find out the beta, see they given RF is what 6.5. They given RF is what 6.5. This is the market. So market into probability will get return of market. Market into, so if you want, I will do this final answer around 62. How can you go for 62, friends? If you go for 62, return of x, if you do x alone, return of x is what? 0.46 into 0.32, 0.38 into 0.26, 0.25 into 0.24, 0.15 into 0.18. What you will get, friends? What you will get it? Already you have the answer, 62. Can anyone tell me? I just want to tell the final analysis. What is the answer? What happened here? 62. Don't you have the answer? What is the return of x? 33.33% is the return of x. Return of market also we have to find out how. 0.25 into 0.32. 0.25 means 25. 0.18 means 18. So 18 into 0.26, 11 into 0.24. What you will get return of market? 16.67. 16.5. 16.5% is the return of market. Now, RF is given in the question. What is the RF? 6.5. Let me check whether your answer is correct. 25 into 0.32 plus 18 into 0.26 plus 11 into 0.24 plus 7 into 0.18. Correct. I was just testing whether it is correct. 15.58. Because when your analysis should not get wrong now. So you get RF is what? 6.5. Now you have to find out beta. Beta they are not given. You have the data. You have to find out what your covariance by market. Accordingly, you will get beta of x as what? 1.67. You will get beta as what? 1 point. Small decimal correction may be there. So this you know. We are discussing this already. We know how to find out this. We revised today also. My point is what? Arbitrage discussion only we are doing it. How can you do? First one you have to do CAPM return. How can you do? RF plus beta of RM minus RF. So if you do this, you will get one return under CAPM. What you are getting, friends? 33.33%. See what is the return for the security? Return for X 33.33. See for the risk K, you should get minimum 23.33. You are getting is what? 33.33. Super. So the comment is what? Undervalued. Your action is what? Buy the stock. Your answer is what? Buy the stock. Same way you have to do for next one also. Next one you will get a CAPM return of what? What is the answer? 20.31. The return of Y will be what? 22.56. Here also undervalued. Here also it will come what? Undervalued. This is how you have to approach. Hope you are clear. Yes or no, friends? Now moving further, this is also the same point we discussed today morning. Covariance, the same approach. Yes. Here comes the normal covariance correlation. Yes. Here they are asking variance into systematic and unsystematic, our normal. See, this is comes another method of what? Another method of what? Our sharp index model. Unsystematic is given, systematic is given, alpha is given. So unsystematic, systematic, if you get total, you will get total. From total, if you go for alpha, you can get what is the return of the security, reverse model questions. Here comes next. This is a 67. Again, the same model question they were asking. What is the standard deviation? What is the constitute a portfolio? What is standard deviation? Here also, you want to do which method, my dear friends? Sharp index model. That is, you have to go reverse way. Question is given unsystematic risk. Can you just go through the 67 answer, friends? The question is given unsystematic risk. So you have to go for what? Systematic risk you have to find out. So unsystematic risk you find out, systematic risk you find out. Both you take total, you will get what? Risk of security. They are asking portfolio stuff. They are asking non-systematic risk of portfolio. So here also you have to approach the same formula. Which formula, friends? Unsystematic, systematic method, residual method. Clear? So these are all comes under our normal method of what? This intensity. These are all 2-mark model which we have discussed already respectively. This is another one question. What is a short-term portfolio? Short-term portfolio is nothing but beta. We have to find out the beta. Whether you change or not, this is the return of stock. Now you have to find out CAPM. Then you have to compare. What is your return? What is CAPM return? If actual return is higher than the CAPM, undervalued buy. If actual return is less than CAPM, overvalued sell. These are all that model question only. But it is given in a essay model question. Here comes the normal. Here you have to find the return here and all normal way CML curve and these are all 2-mark question. These are all 2-mark question. Here and all equilibrium return. What is equilibrium return? Equilibrium return is what? CAPM return. You have to apply reverse way. You have to find out the beta. Once you get the beta, you have to apply your variance model. So you can get the correlation coefficient. Accordingly, you will get the market return. So very very good question. But this is all we have to apply with our formulas. Here comes the concept of what? Our asset beta. Here comes your study material having only one question on this asset beta, but we taken separately in the part after the portfolio chapter. We taken separately asset beta problem, but your study material having only one question. They given what? We'll do this question alone asset beta. They are given 40% and 60% unlevered beta. What is the unlevered beta? Equity beta. Unlevered beta is what? Equity beta is 0.9. So how you will get it, my dear friends? Tax rate is what? 0.3. So you have to find out your asset beta as your asset beta will be. The class I may be given this as a homework because we did lot of question on asset beta. So what is asset beta, friends? Your asset beta will be, you have equity beta is what? 0.9. So 0.9 into 0.9 into, you have to take the weight. Equity is what? 60. 60 divided by 60 plus you should not take 40. You have to take tax effective. What is the tax, friends? 0.3 plus. See, actually here also there, but here the beta of debt is not given. Beta of debt is what? 0. 0, if you anything you multiply, the answer will be what? 0. So you don't want to go further there. So you will get here 0.9 into 60 by, what is the answer, friends? 40 into 0.3. If I am not, sorry, debt is 60. Okay, so equity only 40. So we have to correct, this is 40. and this 60, this 40. So you will get this 40. So 40. So you will get 82. Correct? 0.9 into 40 by 82. What will get the answer? Very good. 0.43. This is what? Asset beta. We have discussed different concepts. Once asset beta found, debt equity proportion changes, it will not have no impact. These are all normal portfolio question. Okay, these are all question. These are all intrinsic value. We'll do one question on. We did a undervalue, overvalue on the perspective of what? CAPM. This is another on the perspective of what? This is another on the perspective of what? Market price. See, they are telling that beta 1.4, companies maintaining 8% growth rate. Last dividend is 4, rate of return is 12, 18%. Current market price is what is the equilibrium price? We will discuss this equilibrium price formula is what? Intrinsic value is equal to D1. What is the D1? The last dividend is 4 rupee, growth is 8%. So 4 into 1.08 divided by K. K we have to find out a CAPM method. What is the CAPM method? K RF plus, hope all of you are on track. RF plus, one second. RF plus, what is the RF? 12. Beta, what is the beta, friends? 1.4. What is the RM? 18 minus 12. Tell my dear friends, what will be the K? You will get it. We'll do one intrinsic value. We want to do all the method, one at least one question. So what will be the KE, friends? 20.4. You will get the KE as what? 20.4. So you will make it here 0.240 minus growth rate 0.08. You will get an intrinsic value. What is the answer, friends? 34.38. This is your intrinsic value. Market price selling right now is 32. That is given in the question. Yes or no? Market price right now selling is what? 32. So if you right now market price selling is 32, tell my dear friends, undervalue or overvalue, your intrinsic value can go for up to 34, but market is only 32, so it is called undervalue. If it is undervalued, what you will do? You will buy. Are you clear, friends? So this is how the method of what? On the base of shares. See, this question number 85 also on the base of share only. Question number 85 also, see, they are telling buy, hold or sell. When you will do hold, my dear friends? That I forgot to tell. Undervalue, overvalue at all. If both are same, it is called correctly priced. Then you will do what? Hold. See, this question again, it comes CAPM point. You want to find out what? Beta of equity, then you have to find out what is the CAPM return, what is the actual return. Just like our previous question. We did one question here the same way. This question. Here we did this question. CAPM return the same way we have to do this question. Correct? So if you gone through here, these are all the same. This is all comes under what? Reverse calculation. What is the return? Actual return minus CAPM return you have to compare. These are all three cases are there. M and O. Each case you have to do what? Actual return minus CAPM. Then you have to give undervalued or overvalued. So these are all the same point. Here comes from question number, if I'm not wrong, question number 91 onwards. Here come the APT model. What is APT model? Arbitrage pricing model. In your 22 syllabus study material, it's a separate chapter. So that it can come one question separately also. Last exam, one question came from RPT model. So this 91 is onwards RPT only, direct formula. RPT model is a direct formula. What is the direct formula? RF plus beta factor 1 into sensitivity. Beta factor 1 according to your group. So from 91 onwards, this is just now telling the revision time. 91 onwards, this all are RPT in your study material, separate chapter. So this all comes under RPT that end with what? that end with a question number 94. So the 94. So you can just revise that little bit, because if they ask separately one question, because two questions will come from portfolio. So one, if they ask from RPT, that last exam trend continue, any one question from there it will come. Last exam, the question they came, it is what I told you. Now these are all additional question. You have already written as a separate question model. Okay. Last exam, this is all this question on asset pricing. See, last exam, this is a RPT model. This is also RPT. 103 is a RPT model question. Then 104 is a RPT model question. This 105, very, very good question. You have to do two formula. Accordingly, you solve it. It's all not a new concept. They were asking equilibrium return is what? Simply, what is the RM and RF? That's all we revise. That's not a new concept at all. This 107. Last exam in RPT model, they came. The exam is what? 107. So this is how you have to understand, my dear friends. So if you go through, first we started discussing with what? First we started discussing with what? Unique model question. What do you discuss? Unique model. Do you able to recall the unique model? We can four question number. What was the question number, friends? What was the question number? 4, 3, 14, 40, 98. These are all unique models. So that once is over, then you have all the concepts we related there. See, now what I have to tell you that we did all the method at least one question. We revised all the formula. If you go through your formula, all the formula we did application. That for you to revise and understand very well. Now, what we are going to do is we are going to go with your MTP now. Now, if I go through MTP itself, you will tell me whether I have to do or not. That is what speciality of MTP. This MTP, see, let me tell you one main point. Current MTP, you just easy questions only, but you practice better, because the first exam of 22 syllabus, MTP around 24 for in this SFM, they came close to 25 questions. Some network issue. Now, my dear friends, I will tell you separate strategy for 2 mark. So now, as I told already, I told the same question only will come for 2 mark also. See, if you go to question covariance, 2 mark. Covariance is given, market is given, what is the beta of stock? Like that direct. When you do the essay, you can able to do the 2 mark as far as this chapter is concerned. Then I have told you, see this, the certain mutual fund, standard deviation, that is mutual fund related only. Portfolio. This is the first question on portfolio. The covariance of the stock market return, we have to find out the beta. Directly we can approach. Type of risk, we told theory purpose they will ask. Portfolio, systematic risk, like that. Two questions they came from what? Portfolio management. Only two questions they came from what? MCQ. Now coming for what? Our MTP. We are looking now MTP only of what? We are looking now MTP only of what? Our portfolio right now. In this session, we are doing only portfolio right now. So if I am going through portfolio, let's see. You taken with the answer, that is the way to getting more data. We need only questions. This mutual fund. See, you will wonder now, the first question, MN, we discussed this question today. Yes or no? See, our strategy today is what? One second. Yes. So where we are right now? This question we discussed today or not? We discussed old MNA, you take 20%. Risk will be what? 60. The same question only came, which we discussed today. Am I right? So what we are focused in the revision session, the same question only came. Now will we go for A? See, from the following information, ascertain market price of risk index. Are we revised this question today? I told market price is nothing but lambda. Just 5 minutes before, if you just back the video, you'll be able to find this question. This is on the base of this 5A on the base of what? CML return. 5A on the base of what? CML return. So you have to find out first CML. What is CML formula? RM minus RF. So 18 minus 16 divided by 6. You will get lambda. Then you have to approach the formula. RF is 6, lambda into this portfolio. Correct or not? So this 5A, 5B, both we discussed it today. Same ditto question only, but exam it won't be ditto. That is different perspective. Okay. So this is the answer. So 2 questions, that is 7 into 7. Sorry. Here, next day, see, we discussed another portfolio question. This is not portfolio. This is from forward. So we don't want to go for forward now. So 2 questions came from forward. 2 questions came from no, sorry. 2 questions came from where? Portfolio. 7 and 7. What is the mark? 14. Every exam, this 14 mark minimum will come. 14 plus 2 mark MCQ. So 18 mark. So close to 20 mark it will come. So my dear friends, this are you clear? Yes or no? So MTP also we completed. Now, as I told when you doing the question, I told you 2-3 questions. Recent previous year question. Recent previous year, I can't take the issue website, some error is there. So recent previous year question also we discuss in what? Portfolio chapter. So that is why portfolio only area we were covered. So what our approach today is, we are winding up today. We are winding up today. We will continue tomorrow with mutual fund. We will continue tomorrow with what? Mutual fund. You requested me 2 areas, portfolio and mutual fund. So tomorrow we will go